this is ultimately driven. We were so over-provisioned or so well-provisioned, weren't we, going into this? The most provisioned since 2008 during the pandemic.
Yeah, that's right. And that gap between the European and the U.S. banks, the dividend picture obviously is going to make a difference in who can release them, but also all these banks have their own idiosyncratic issues that they're dealing with as well. I think one of the most important ones from here on out is also going to be loan growth. Are we finally going to see consumers and businesses taking out loans again, or is everybody just going to chuck all their money in the bank, pile high those deposits, let them sit there, much to the chagrin of those banks?
Absolutely, and you still got the stimulus checks to spend. And that housing market, yes, prices are up 23, 24%, but we're just seeing that roll off in terms of the number of sales. So every market corrects itself. Let's have a quick sweep through the market. Stocks are higher. Yen in and of itself, you know, it's poised to unwind some of its pandemic-driven gains. That seems to be the view. You've got dollar-yen in there at 110.84 this morning. Cable 139.56 with a hawkish tilt, well, an outgoing hawkish tilt from Andy Haldane at the Bank of England. But it's going to take more than a little bit of a hawkish narrative, according to Jane Foley over at Rabobank, to get the pound back to those pre-Brexit highs. We're still 6% below where we were 5 years ago when we announced the Brexit referendum. 10-year government bond yields 148.85. My favourite line is from Mashreq Bank this morning with me an hour and a half ago, saying that you have dissonance, but not a mutiny. There you go. Let's talk about those stress test results at the US Federal Reserve. They stress test the banks, and they're scheduled to release the data after the close today. Now, it's an annual ritual, and the tests for the banks themselves, how do they fare in various hypothetical economic downturns? And it's usually followed by statements from the banks saying how much capital they can release from dividends and buybacks. Let's get to our finance managing editor for EMEA, Michael Moore. All things banks. Michael, what are we likely to see from the stress tests?
Yeah, I think you're likely to see some pretty strong results from the banks. They have argued they went through a real stress test last year with the pandemic, and they passed it with pretty flying colors, even having to set aside tens of billions for potential loan losses. They managed to stay profitable and build up those capital buffers. And so this time around, perhaps will be less stressful than that. So the banks have a lot of excess capital because of the measures put in place last year to freeze payouts. And so I think it becomes a little bit more of a math problem this time around rather than a judgment call. So I think you will see some clearance to give major payouts.
So clearance for major payouts. Well, what are the expectations exactly at this point in terms of the degree of that? Is JP Morgan going to get to give out over $140 billion back to shareholders, for example?
Yeah, so the expectations are the six biggest banks will give out more than $140 billion. I mean, JP Morgan, obviously the biggest of that, approaching $40 billion itself. So these are, obviously huge numbers between the dividends and stock buybacks. But the banks have argued, we stayed profitable during the pandemic. We've got a ton of profits built up, and we should be able to give that back to some of our shareholders who've been patient over the last year.
Well, we'll certainly see if all the banks pass the test. And, of course, question over whether their employees can come back into the banks without having a COVID vaccine. Definitely one of the more interesting stories as well today. Michael Moore, thanks so much for joining us. That's Bloomberg's finance managing editor for EMEA. Now let's get to the first word news with Annabelle Jewelers. Good morning, Annabelle.
Thanks, Danny. Well, women are more likely to develop persistent symptoms after a coronavirus infection. That's according to a study of 500,000 adults by Imperial College London. Overall, about 1 in 3 people reported at least one symptom lasting 12 weeks or more, with the likelihood increasing with age. Sources say Bullish, that's a cryptocurrency exchange backed by a group of billionaires, including Peter Thiel, is in a SPAC merger talk with Far Peak Acquisition. The deal could value Bullish at nearly $12 billion, with an agreement possible in the next few weeks. The final valuation could change depending on the price of Bitcoin. John McAfee's been found dead in a Spanish prison cell shortly after it was announced he would be extradited to the US to face charges of financial crimes. The creator of McAfee antivirus software had been in jail in Spain since October on US tax evasion charges. Spanish newspaper La Vanguardia reported that he appeared to have taken his own life. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Manus?
Annabelle, thank you very much. Annabelle Drew is there. And, well, a little bit more from the Qatar Economic Forum and a conversation with Blackstone CEO Steve Schwarzman. He says the risk of an increase in US capital gains tax has led to an explosive growth in the potential targets for his alternative investment firm, as corporate owners seek cash ahead of the legislative changes.
We've been through these periods of higher multiples, and it leads to a certain type of caution, but it also presents a lot more opportunities because prices are higher, more people will sell. What we've learned is because we're fundamentally in the private markets, is that the only reason to buy something is to make it much better. We're in the business of accelerating growth of companies and of real estate that we own. And so it's unlike stock investing where you buy it and you hope it works out. We're change agents. We believe for good. And if we can put more money to grow businesses, then we can deal with some of the issues of higher prices by accelerating growth, which gives us more protection on the downside. With the prospect of the United States potentially increasing capital gains taxes very significantly, it's really like an avalanche now of opportunities of people want to sell things before their taxes are much higher for selling the same thing potentially next year. And so it's giving us a lot of opportunities. And what we have to do is be careful, always have a very exciting plan for growth. By the way, that results in us hiring more people. So this is good for society, and hopefully it's good for our clients who typically are large institutions like QIA.
Your Excellency, how far along is the QIA in actually try to diversify its portfolio? So I know you've planned to boost investments, for example, in technology and healthcare. Is that done to a level that you're satisfied with now?
Not yet. I think we have been deploying and focusing in technology and healthcare. Within the last 2 years, we have deployed in technologies more than ever before. I think the sectors is promising, especially if you really targeted a certain segment within technologies. And I think it's the sectors have grown to stay. I don't think so. There is a risk, perhaps in the short term, with the inflation in mind. Even though I'm not really concerned about it, I think it would be a temporary basis. But as you know, it's the era of technologies, and a portfolio without a huge component of technology is not really a balanced portfolio.
That was, of course, Blackstone CEO Stephen Schwarzman, alongside the Qatar Investment Authority CEO, speaking at the Qatar Economic Forum. The Qatar Ministry of Commerce and Industry, Investment Promotion Agency Qatar, and Media City Qatar, all underwriters of the forum, powered by Bloomberg. Coming up, the Boston Fed's Eric Rosengren says inflation will ease next year. But what does UBS Chairman Axel Weber think? We're going to find out next. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Daybreak Europe. I'm Danny Berger in London, Manus Cranny alongside me in Dubai. A Bloomberg scoop now. The U.S. is set the bar for some solar products made in China's Xinjiang region, marking one of the Biden administration's biggest steps, of course, set to bar them, rather, to counter alleged human rights abuses. Joining us now with the details is Bloomberg's chief Asia economic correspondent, Enda Curran. Enda, what exactly is the significance of this move?
Well, look, good morning, Danny. The Xinjiang region actually is a source of around half of the world's polysilicon. That's a very important component for semiconductors and solar panels and the like. And now, as you mentioned, this is one of this potential ban is probably the most sweeping move yet by the US government against China for the allegations of human rights abuses and forced labor in Xinjiang. So it's potentially a significant move. It may also, of course, have broader ripple effects in terms of the supply chain, because if you have this ban on certain solar products coming out of China, then those companies that need to source these kind of products, polysilicon and the like, will need to look elsewhere. So there is clearly a political significance to it, which is US-China tension. Then there's the industrial side to it in terms of how it spills over to the global supply chain. So it is a significant event. China, of course, hasn't commented yet, but it has in the past rejected the allegations in Xinjiang. The details on this are expected to be announced out of Washington, possibly later today.
And good to see you as always. I mean, contextually, we saw Biden warn Putin very, very clearly over cyber. China was very much in that communique as well from the G7. What does this say about the wider US-China relations?
Well, I think, Manus, on the one hand, some critics are saying today that this initial push against China over Xinjiang isn't perhaps as broad as some lawmakers are pushing for in the US. It's kind of narrow in scope, but others will say, look, it's still early days in the administration. They're still mapping out their China strategy. In fact, we don't really know yet where they're going to go on the China road, because so far they've only had the kind of basic courtesy calls with their fellow officials in Beijing. We haven't really seen the full meat on the bones of the US-China policy yet. But nonetheless, there are signs that it's coming, and a hint so far that it's pretty hawkish. Not much of a mood change from where we were under President Trump's administration. You mentioned the G7. The US did go there earlier this month and try to push a fairly hawkish line against China. It had some success, but there was some pushback from the EU side of things too. They weren't necessarily buying the full-bore attacking line against China. So I think all the indications are we're still waiting for the Biden administration to map out where it's going with the China story. There are expectations of ongoing talks between both officials over the months ahead. There will be some summits at a G20 level, for example, where there might be opportunities for the two presidents to speak. But when you base what's happening on today's actions, for example, this move against Xinjiang, clearly it's still a pretty hawkish outlook.
And always great to have you on the show. And Enda Curran there, our chief Asia economics correspondent on the Sino-US relations. So plenty of Fed speak overnight. We've updated you some of the comments from Boston Fed's Eric Rosengren that he expects inflation to ease next year. Bloomberg's head of economics, Stephanie Flanders, tackled the subject with former Bundesbank president and current chairman of UBS, Axel Weber. Let's listen.
The risk is that the coming back of the economy, that the normalization in prices combined with bottlenecks and base effects will lead to inflation readings we've not been used to for a decade or two. And that may unnerve some investors and consumers. And you need to monitor it very closely so it doesn't become ingrained and embedded in wage price dynamics. We're already seeing positive price dynamics as a result of bottlenecks. If wage demand continues to fall in line with that, there's a risk that this might become more sustained than just transitory. And that's really the risk everyone's focusing on. I see the nervousness in the central bank community really starting to come up.
And just to come back briefly on that, I guess there's two issues here. There's whether the global economy is looking to an era in which there's somewhat more inflation than there's been in the last 10 years, but also whether there's a specific issue around the US and the US potentially compounding the problem with its stimulus. So I'm interested, given your background at the Bundesbank and other places. We spoke to Larry Summers earlier this week for this forum. He has said he thinks that the US macro policies at the moment are the most irresponsible they've been in 40 years. Do you agree with that?
They're definitely the most expansionary they've been in decades. The US had a massive fiscal stimulus. Monetary policy actually hasn't been as expansionary when you look at the balance sheet alone as, for example, the ECB. But look, it's an unusual environment if people like Larry Summers, Olivier Blanchard, or Paul Krugman are on the same warning side as I have been traditionally on warning about inflation risk. So I think both the economists, a community that always advocated massive stimulus, both fiscal and monetary, is getting a bit nervous this time around that we might have overdone it. And I think that first and foremost holds for the US. But there's also a broader issue on there's going to be very mixed signals. And this is a once in a decade or century event. And it's very hard to calibrate this against our models from the past. So I am concerned about inflation overshooting by more and for longer than is currently being priced in inflation forecasts of central banks. They're notoriously unreliable when it comes to medium to longer term inflation trends. And I'm also worried that we'll see a second half of the year where the economy is running really hot, first and foremost the US economy, and that will have spillover and spillback effects into the global economy. The ones that are really at a very difficult point are emerging markets, because the US might tighten and impact on their environment before they actually fully recover. So I think the fallout this time around is more focused on the emerging market spillovers of a premature or even of a late tightening in the US, because it will have effect on certain countries.
That was Bloomberg's head of economics, Stephanie Flanders, speaking with former Bundesbank president and current chairman of UBS, Axel Weber. Now let's stick with that risk of themes to the global financial systems. And of course, if we're going to talk about that, we have to talk about Bitcoin. Though the cryptocurrency had been touted as a possible inflation hedge, institutional investors are starting to turn away from it, of course, after initially starting that adoption. Now, among them is BlackRock chairman and CEO Larry Fink, who did speak with us at the Qatar Economic Forum powered by Bloomberg. Let's listen.
Long-term investors are very unfocused on the tick-tock of the market, the tick-tock of the ups and downs of crypto. I think it's fascinating to watch crypto because it's inspiring a lot of young investors. I think that's fantastic. I think if that inspiration leads to long-term investing, that is a great outcome. But with our focus on long-term investing, and with 2/3 of the assets we manage are for pension funds, the conversation about crypto is a minor percent of any dialogue we have with any company worldwide. It's just not terribly important. Could crypto become a really important asset class one day? Sure. But right now, the bid-ask spread, the volatility, it has not led to widespread conversations worldwide. Where conversations I have with governments and leaders is about, should there be a digital currency, true digital governmental currency that will change finance in a very substantial way. If there was a digital dollar, a true digital yuan, that will change however, that would be much more impactful than any other, like a crypto. But it's something that we look at, some of our investors use as one tool for investing. But it is really about the tick-tock of the market, and that's what public media does. You focus on the moment, the markets and the ups and downs. BlackRock is focused on the long-term, building long-term portfolios as a fiduciary for our clients. And if we deem crypto or any asset in the world is a great long-term asset on behalf of pensioners worldwide or people building pension funds, then it'll be one of the tools for asset composition. But the tick-tock of the market, the ups and downs of what's going on in any one individual stock or a crypto, it's really unimportant.
The BlackRock chairman and CEO there, Larry Fink, speaking at the Qatar Economic Forum. Coming up on the show, Saudi Arabia's energy minister says that OPEC Plus, the alliance, has a role in containing inflation. We discuss. This is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kayleigh Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
It's Daybreak Europe with Manus Cranney in Dubai, Danny Berger alongside me at London HQ. Danny, as if on cue, His Royal Highness Saudi Arabia's energy minister really came to the market yesterday and said, we have a role. It's about taming and containing inflation. Of course, we know Prince Abdulaziz bin Salman quite likes to anchor his role and his heft in the oil market as being that of the Alan Greenspan, the central bank of oil. So, you know, oil popped above 75 bucks, bang, in they came. This is about acknowledging the risk from rising oil prices, Annie, isn't it?
Right, it definitely is, but I do wonder, Manus, and of course you know this space so much better than me. If they want to have a role in containing inflation, let's say they want to put more supply out there to make sure prices don't get too out of whack, do they actually have the ability to do that? Especially something like U.S. shale, are they able to really ramp up enough supply to meet the demand?
Well, look, they have a plan, and that's why I think next week is going to be so pivotal, Danny, when we get into the OPEC Plus meeting. I'll cover it from a beach somewhere, but
I'm jealous.
It's going to be about the ability. It's going to be because you said shale, but shale is more interested in preserving cash than it is perhaps borrowing and ramping up. I'm going to leave you. I think you're driving and steering and changing the gears on your own next week. Enjoy it. Don't break anything.
Thanks, Manus.
excluded from the workplace, especially when you've got skills and motivation and things to give, can have a really detrimental effect on people's well-being. They can become isolated, of course have the financial stress of not being able to support themselves. That might be their first entry into the broader community where you're building relationships with workmates, and so that's your exposure to culture and you're starting to feel like you belong.
Some people might need to practice their English more. They might just need just some practical experience in an Australian kitchen.
I have not from Australian friend now, but in the kitchen I have many friends.
Valuations, particularly, sort of technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Good morning. Welcome to Bloomberg Markets, the European Open. I'm Anna Edwards, live in London. Mark Cudmore, our Markets Live managing editor, joins us shortly in Singapore to take us through all of the market action this hour. The cash trade is just less than an hour away. Here are your top headlines. Talking tightening, the Fed's Raphael Bostic sees a rate hike next year. Robert Kaplan agrees, saying the Fed might taper sooner than you think. And there's a ton more commentary to come from FOMC members today. The Hawks' swan song, the Bank of England says goodbye to Andy Haldane at today's meeting as it looks to balance the recovering economy and inflation concerns. And a Bloomberg scoop, the US will block some solar products from China in one of the Biden administration's biggest moves yet to counter alleged human rights abuses. Welcome to the programme, everybody. Welcome to the European Market Open. It's just gone 7 o'clock here in London. Mark Cudmore, our Markets Live managing editor, should be with me from Singapore. We will see. Yes, I understand that he is. Mark, you are there. What are the markets saying to you then?
Good morning, Anna. Well, it's been a really quiet day in Asia. It's been a very directionless session, and it's a little bit surprising in one regard because we were meant to kind of now be getting clarity post-Fed. On the other regard, we are kind of entering summer markets, and importantly, there's a big slew of data today in the US, which should help provide some fresh direction. So I think the market's kind of waiting for that in the short term.
Lots of data, lots of Fed speakers to come. Let's have a look, an hour to go until the start of cash equities trading then. Let's have a look at where we are on futures. And it was a really interesting picture, given we are in this period of sort of relatively quiet markets, I suppose. You can still get some big moves, as we know. So European stock markets actually off quite substantially in yesterday's session, more than 1% in some cases. It was a pretty broad-based sell-off, luxury, industrials, chips, tech, various sectors represented in some heavyweight moves to the downside. The US equity markets look more mixed, but futures don't look all that different, actually. We've got European equity market futures flat to positive, US futures, if anything, slightly more optimistic, but still flat to positive, I guess you'd describe this as. In terms of where we are then on the broader global picture, Mark, what does the GMM say?
Well, as I was saying, Anna, it's been a largely directionless session, and there's not kind of any broad takeaways to kind of get from the GMM. As you can see, almost every column there is kind of mixed with those green and reds. There's not just like one central theme. One thing that we are kind of maybe trying to draw attention to, if you're trying to reach a theme there, is the idea that there's a little bit of EM weakness still there versus the dollar. And you're seeing that the Indonesian rupiah, the Chinese renminbi, both slightly weaker today in Asia. And that's probably the only theme you get from the GMM. It's really, really directionless out there at the macro level.
It's directionless, but I like the line by, I think it was Simon Flint, one of your Markets Live colleagues, saying that there are about 1,000 Fed speakers set to speak today. Sometimes it feels that way. Today is one of those days. We've got a lot of voices to hear from. And I suppose we've reset, haven't we, from assuming that the only surprise could be hawkish to Now, I'm not sure. We could get surprises in both directions, although Williams, the only real, slightly more dovish voice that we're going to be hearing from.
Yeah, I think that whole point of that new slight level of uncertainty is just a massive change. It's only marginal in terms we've gone from absolute certainty to a little bit less than absolute certainty. But the impact for markets will be very, very large. And we saw that yesterday. We had a couple of speakers who came out in the slightly more hawkish side of the spectrum. Now, we know that the core generally is dovish, and Williams is part of that group, and we expect him to reiterate the kind of dovish message again when he next speaks. But we are going to have this theme into next week as well of many, many Fed speakers, and I think people will continue to parse these statements as they kind of recalibrate exactly where we are in terms of Fed expectations and the inflation path going forwards. Importantly, markets haven't yet seized on a new narrative, and they are kind of waiting to kind of build into that new narrative in the rates market.
Yeah, and looking at Chinese markets, I'm looking at what's been going on in the Asia session whilst you were busy working and I was busy getting ready for the programme. We've got the Shanghai Composite pretty flat. Chinese equity markets broadly not staging very big moves, even though we saw Chinese authorities stepping up liquidity action in the market. And some interpret that as a sign that the PBOC is maybe further away than we thought from any tightening activity. How do you interpret those moves?
Well, one of the big things we got today in China was that they injected more liquidity for the quarterly end and the month end coming up. And that should have been a positive for markets. But as you said, Chinese stocks are generally, pretty unmoved by that extra liquidity. I think the focus here, or the talk here of why it didn't kind of support the market more was this idea that the White House, the US administration is again talking about some focus on Xinjiang in a negative way in terms of boycotting some firms there. And I think this is emphasized to people that the US-China tensions remain. And there's several events that we're expecting in the next couple of weeks where this may be kind of in focus, and then it hasn't gone away. There was this big talk 6 months ago that with the post-Trump administration that maybe those tensions would be much better. They haven't really gone away, and that means there kind of will be a slight concern under the radar for markets.
Yeah, I'm sure there's room to find differences in the handling of the dealings with China, the negotiations with China between the two administrations, but certainly this headline plays in the same direction as those geopolitical tensions that we became so used to during the previous administration. There is something else on the radar today, and that is the stress tests that the Fed is running on the banking sector. And I wonder how much this is getting into the market psyche. Mark, it doesn't seem to be the kind of event that has had a huge build up with much market narrative around it in the way that maybe it was in years gone by.
Yeah, I've been trying to work it out myself. I mean, it seems like we've largely ignored it. But one reason it's come into focus is because of the Fed impact on banks and cyclicals over the last week and how that's kind of played out in financials. And therefore, everyone's kind of going, ooh, this is a very crowded trade. Is there a change in the backdrop here? And oh, wait, we've got the stress test. That's an extra catalyst. But ultimately, I think this is expected to be good news. Now, is it largely priced? Probably, but it should hopefully be confirmation that a lot more capital can be released back to financials investors, and that will be positive news overall, even if it's not going to be a surprise to the market. OK, lots to talk about then as we go through the next hour. Remember, you can get analysis and insight from Mark and the Markets Live team. Go to MLIV Go on your terminal. Coming up then on this programme, it's a tricky day for the Bank of England. It has to balance powering an economic recovery with rising inflation. We'll be discussing that throughout the show. Just how loud would the voice of Andy Haldane be in his last meeting in terms of rate setting at the Bank of England? Plus, the US is set to ban some solar products made in the Xinjiang region, as we mentioned in our headlines, and as Mark was taking us through there. It marks the nation's biggest step to counter alleged human rights abuses in China. We'll bring you the latest on that story. Plus, up next, we'll get back to the markets and discussions of what the Fed's tapering timeline could look like from here. Claudia Panseri from UBS joins us. If you have any questions of your own for our guests, then please do send them to us. IB plus TV Go is the...
Greetings from The Edge, where doctors keep pace with patients, stores have psychic powers, and industries transform before your eyes. All made possible by HPE's Edge to Cloud platform.
The U.S. economy is really on fire.
Developed markets like the U.S. and Europe are further ahead.
Worried that we'll see a second half of the year where the economy is running really hot, first and foremost the U.S. economy.
I do think that prices are going up, and we do see it in our companies.
And that will have spillover and spillback effects into the global economy.
But I don't think it's anything to be alarmed about at this point.
The chances are higher as opposed to lower that this is ongoing inflation and that the Fed will need to adjust.
This is, in our view, a transitory phenomenon.
I am concerned about inflation overshooting by more and for longer.
I think if you see break-even inflation rates go above 3% or something like that, and you see that spurt, then you have the dilemma of the tightening of the monetary policy.
Leaders and CEOs weigh in on markets and the economy at the Qatar Economic Forum, powered by Bloomberg. They see the US economy recovering quickly, while the debate over inflation risk, of course, continues. We're joined now by Claudia Penseri, equity strategist at UBS Global Wealth Management. Claudia, we heard a lot of enthusiasm there for the US economy. No doubt some of those voices also have enthusiasm for other locations too. But in terms of the US, and it does seem as if the US is ahead of other parts of the world when it comes to this recovery, is the market fully pricing in the extent of that recovery? Are there still opportunities in US stocks, or do you have to go looking elsewhere globally?
No, we look at outside US as well, but even in US there is still opportunities. I don't know if you know where we are, how we are positioned, but we still like, for instance, at the global level, financial, energy, and even in US, this sector are really linked to the reopening of the economy. We also like small and mid cap in US, which have been performing extremely well last year. But since March, we have been underperforming the Nasdaq and the S&P, and valuation is still very attractive. Earnings are recovering, and there is still more to go, considering that we expect an announcement about the fiscal package. Outside the US, we see also a lot of opportunities. We are positive, for instance, on China. We are positive on Asia, Japan, and we are also positive on Japan itself. Japan is quite interesting case because Japanese stocks has been underperforming global markets since the beginning of the year, despite the fact that Japan has high operating leverage, high earnings growth. The fact that the main problem relative to Japan is the slow vaccine rollout. But now we have seen 1 million of people to be vaccinated daily. And so I think Japan is a nice and cheap opportunity to continue to run the market.
Good morning, Claudia. I want to follow up on that kind of Asia outperformance element. I understand the longer-term macro arguments, but many people in the region, and I'm based in Singapore, are very concerned about the slow vaccination rollouts in many countries throughout the region, not just Japan, but Indonesia, Pakistan, Bangladesh, Philippines, and what this means for kind of the regional trade. Are you not worried that with the rise of the Delta variant, the slow vaccination schedule, that it might be a little bit too early for this trade, or do you think this is absolutely the right timing?
I think it's the right timing. When you look, the performance is really weak. And when you invest into Asia and Japan, essentially you invest into India, Korea, Taiwan, and China. And when you look into the growth situation of this country, it's really, really strong. It's true that the vaccine rollout has been slow, and this is the also reason why US and Europe stocks have been performing so well since the beginning of the year. But the market is pricing a lot of negative headwinds on this market. So one set of evaluation is relatively cheap. When you look into Asia or you look China, you pay the market 15 times, while you have potential growth not only for this year but also next year, which is relatively strong. The Chinese market, for instance, just to give you an example, has 18% EPS growth for next year. This is why you have the US and Europe and other countries which are only high single digit, around 10%. So clearly there are a lot of positive elements which are not pricey, but the negative ones are already in the price, especially in China.
Right. Thinking about where we are in Europe then, Claudia, I see some lines coming through from the German Chancellor Minister Braun talking in German media saying that the Delta variant will be dominant in Germany within weeks. I wonder how much this gives you pause for thought at all on the pace of the recovery across the Eurozone. We've already seen the Delta taking off in places, in some parts of the Eurozone, and here's the German assessments of how dominant it becomes. What we know about it in the UK, did it lead UK stocks to stumble? Will it lead certain Eurozone stocks to stumble, just pricing in a slightly slower recovery?
I don't think so, because even if you have the Delta variant and will have an increasing number of people which are affected, I think you will not get back to the restriction we had 1 year ago or also at the beginning of the year. Most of the people are now vaccinated, and I think that makes the big difference. The fact that the health impact will be lower relative to the previous month. Now, it could bring some volatility, it could bring some noise into the market, but when we look into the data, and we had the PMI yesterday in the Eurozone and UK, you clearly see that the economy in Europe and worldwide is recovering quite quickly. And I think people are back, will be better traveling. We have seen Switzerland yesterday again easing restrictions. So I believe that these elements are not fully discounted in the market. Of course, there are sectors, still cyclical sectors, which are expensive now because they run a lot, but there are still plenty of opportunity in Europe, globally, and in Asia.
Claudia, I completely want to buy into your optimistic view, and I think it makes sense. Just to go back to the China element, as you say, it looks discounted relative to many of the stock markets in the world, particularly in the US, on a forward-looking PE ratio. Some of the profit gains are really incredible there. But one of the problems with China stocks forever has been that it's been more of a liquidity play rather than a growth play or even a company profits play. And while the stock market looks cheap compared to the US, it is expensive compared to historicals. If the Chinese government is clamping down in liquidity, are you not worried by that signal?
I think, listen, what we have observed so far, the Chinese government and the central bank have been the only one which have reduced support. And also on the liquidity side, we have seen the different credit measures have been slowing. Now, the data has been choppy when we compare the Chinese data, for instance, to US data or European data. And that is also the reason why people have been a bit scared about buying into China. But now that the economy is getting choppy signal, you will have some relaxation. Probably you may see the second half of the year with relaxing credit restriction, with more support. And this is the reason why I believe China and Asia overall are a good opportunity now. The performance is flat since the beginning of the year, while you have global equities which are up 11%. True, you had plenty of negative news flow. We spoke about the vaccine rollout before. We spoke about the tightening credit condition. We spoke about also US and China, some tension. But really, when you see the valuation, and you mentioned probably the price earning, but we also look to other variables, is high in historical term. This is the case of every single market, but it's cheap relative to other markets which have been performing very strongly since the beginning of the year.
Claudia, thank you very much. Claudia Panseri from UBS Global Wealth Management. She stays with us a little bit longer. Let's get a Bloomberg First Word News update. Here's Laura Wright. Good morning, Laura.
Good morning, Anna. President Biden has ousted the regulator of mortgage companies Fannie Mae and Freddie Mac, replacing a Trump administration appointee. The move follows a ruling by the U.S. Supreme Court, which rejected a core part of a lawsuit brought by the investors in the companies. Shares in Fannie and Freddie each plunged the most in intraday trading since 2013. Sources say the U.S. is set to ban some solar products made in China's Xinjiang region over suspected human rights abuses. The move, expected later today, would mark the Biden administration's biggest action yet against Beijing's alleged crackdown on the Uyghur Muslim minority. Xinjiang produces roughly half of the world's polysilicon, a key material for solar panels and semiconductors. John McAfee has been found dead in a Spanish prison cell shortly after it was announced he would be extradited to the US to face charges of financial crimes. The creator of the McAfee antivirus software had been jailed in Spain since October on US tax evasion charges. Spanish newspaper La Vanguardia reported that he appeared to have taken his own life. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Mark, Anna.
Laura, thank you. Laura Wright in London. Now, coming up on this programme, it is Bank of England Day, and it's going to be a tricky one that the central bank has to balance the need to keep the economic recovery going while limiting inflation. All this while contending with a departing chief economist who's absolutely made no secret of his very hawkish views recently. We'll get into that conversation next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Welcome back to the European Market Open this Thursday morning, and we still have 40 minutes or so to go until the start of the cash equities session, and futures actually increasingly positive as we work our way through this morning. Now, the Bank of England is set to announce its policy decision today against a backdrop of rising inflation, a building global debate on the path for monetary policy, and a slowly reopening UK economy. For more, we're joined now by Bloomberg's UK economy reporter, Lizzie Burden. Lizzie, very good to speak to you this morning. There's certainly been plenty of commentary of a hawkish nature from certain parts of the Bank of England just of late. But give us the lowdown. What are we actually expecting to hear then from the BOE?
So we're expecting a unanimous decision to keep interest rates at a record low 0.1%. On bond buying, an 8-to-1 split with Andy Haldane, outgoing chief economist, again the sole dissenter in favour of paring back stimulus. He'll note the jump in consumer price growth above the bank's 2% target. The question is how temporary that'll be. We've had a number of economists changing their positions on when the first rate hike post-pandemic will be. Bank of America, Credit Suisse. And it'd be interesting to see how the bank deals with that tension between its position and markets. We've had so much positive economic data recently. Housing, manufacturing surging ahead, payrolls rising, consumers upbeat. But at the same time, we don't know what's going to happen to unemployment when the furlough scheme ends. We don't know if the government will get the Delta variant under control in time to reopen the economy. So they may want to wait until there's clearer data in August to give a more concrete signal of what lies ahead.
OK, which takes us to the longer term then, Mark.
And Lizzie, what's the Bank of England's preferred course of action further down the line in the longer term?
We had a really interesting note from Berenberg this morning, hot off the press. They see a roughly even chance that the BOE could surprise markets today by signalling that it'll end planned asset purchases in August instead of December. There's that, but also, the unemployment factor, the Delta variant factor could limit how hawkish the bank's prepared to be down the line.
Yes, I like the line coming from, I think it was George Buckley, wasn't it, that you cite from Nomura. There will be a little less action and a little more conversation, a sort of opposite of Elvis meeting we expect today then. Thank you very much, Lizzie. Lizzie Burden, Bloomberg's UK economy reporter. Claudia Panseri, listening to that from UBS Global Wealth Management. Claudia, briefly, your thoughts then on the Bank of England and the tough messaging they've got to get right here. What are you expecting?
They will probably be hawkish. This is what the market is expecting, but we are not expecting any change in the monetary policy. As you mentioned, I think it's still too early. There is uncertainty about the employment market. It's true the manufacturing and services are getting strong, but I think it's just too early to change monetary policy, considering that worldwide we central bank are still very accommodative. It's probably something that we will announce in the month to come, but probably not today. The tone will be probably more hawkish than in the previous meeting, but no action.
OK, so maybe a change in tone then, not necessarily any action. Claudia, thank you very much for joining us. Good to speak to you. Claudia Panseri, equity strategist at UBS Global Wealth Management. So as I said, we have heard a lot of hawkish commentary, a lot of it coming through from Andy Haldane, the chief economist. He is leaving, though. He is going to be departing the central bank shortly, and this is going to be his last monetary policy meeting. So we'll see whether there are any more moves to his camp. From what Lizzie was saying, that is not the baseline expectation in markets, but there could be, as Claudia was saying there could be some slightly more hawkish commentary coming along with that sort of no changed on paper stance. Coming up then here on this programme, weighing the Fed's message on stimulus, we'll discuss the potential taper timeline and dive back into the markets. We'll think about what's driving the markets this week, whether we're heading towards a summer lull. Could sport have anything to do with that, we wonder? We'll get into that conversation shortly. Lots more to come here on the European Market Open. This is Bloomberg.
The G7 today need to wake up and listen to the science. There isn't room for discussion on this. Scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated! Our world is possible!
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to the European Market Open. Half an hour to go, in fact, until the start of the cash equities session. European equity market futures pointing to the upside, up 0.2% on FTSE 100 futures, CAC futures up 0.6%. We've been following very closely all of the talk about inflation and economics at the Qatar Economic Forum. It was not all talk of inflation and economics. There was time to talk about, well, it's Qatar, and we know what's coming up there. Time to talk about football. As the country gears up for the World Cup next year, we spoke to the footballing legend that is David Beckham about the power of sport.
That's one of the things that I've always said about soccer, about sport. You know, being around the Olympics, being around World Cups, I've seen the way it changes people's lives. No matter what the world is going through, no matter what individuals are going through, when you're watching a soccer game, when you're watching the Olympics, nothing else matters for that amount of time, and that's why sport is so strong.
The importance of sport, then, you'd expect David Beckham to think that sports is very, very important, of course, and I'm sure there's something in what he's saying, Mark. And interesting to think about the summer of sport. We often have a summer of sport in the Northern Hemisphere, and certainly in Europe it can become quite dominant. And certainly with the year we've had, with the year and a half we've had, perhaps many people do need a break and need something else to watch, something else to think about. And we've been thinking about low levels of volatility, whether we're heading towards a summer lull, and the role that sport perhaps plays in all of that.
Absolutely, Anna. As you said, important thing here, this is not a new situation, so therefore we can look at precedent to know how we should kind of interpret what's happening into markets. Now, markets aren't the only things that excite me out there. Sport also excites me, so I'm going to rob this moment to say it was a brilliant night for football. There was 18 goals amongst 4 matches in the final round of the knockout stages, and I think this is important. This sets us up in Europe to be very distracted by the knockout stages that start on Saturday. But it's not just football. Wimbledon starts on Monday. It was 20 years ago that we saw Federer knock out Pete Sampras as one legend passed over to another before Federer was knocked out by Henman. So, look, Wimbledon is on, the football is on, we have the Lions Tour starting at the end of next week. So in Europe in particular, we are right in the height of summer sporting season. Now, this matters. This is why almost every year volatility declines into the summer. It's not just because of sport, but that plays a part into it because the normal extended European summer holidays are in August. But if you look at this chart on the screen, this is the past 20 years of G10 FX volatility. So that blue line is the average. You can see it's kind of pretty consistent. Now, the range there you can see is the high and low over the years. Now, you can see on that chart that the highs over the last 20 years, we basically never get a volatility spike from mid-June till the end of August. And that is because we're in summer holidays, we're in the sporting season. So that's one thing, this is the dead period for FX traders, and FX traders are primarily in Europe. London is the FX capital of the world, not anywhere in the US or Asia. There's an extra point here to note, though. We are on that yellow line. That is this year. We're right at the bottom of the long-term ranges. We're literally kind of dredging the bottom already. So while I think we're in that summer lull, I think in the context of Fed making data more live last week, making speakers more live, we do have potential for spikes from this base. They just won't be the big spikes of the year, but they can certainly surprise people who are distracted watching the knockout soccer games.
Yes, not that you would ever be distracted watching the knockout soccer games, Mark, but for those of us who have been, and of course I managed to catch at least the first half, depending on the time of day, catch the first half of some of these games. I was drawn to a piece by our colleague John Authers, who was talking about the activity bias of goalkeepers. It holds, according to John, important lessons for traders as well. Sometimes it is actually better to stand still and do nothing than to dive in either direction, is the interesting metaphor that he is using when it comes to thinking about markets and thinking about sport and and football. Mark, let's pause our thinking around sport there for just a moment and get back to the bigger picture. Asian stocks are steady and US and European futures are edging higher as traders weigh the Fed's message on stimulus. At the Qatar Economic Forum, we got Blackstone CEO Stephen Schwarzman's take on the US economy.
The U.S. economy is really on fire. Almost everything is growing much faster than almost anyone anticipated. We've had almost a perfect storm here of massive government spending, central bank accommodation, record low interest rates. And that's a recipe to really power an economy.
Stephen Schwarzman there. We're joined now by Patrick Thompson, JP Morgan Asset Management's EMEA CEO. Patrick, it is really nice to speak to you. Nice to have you here on the European Market Open. We heard enthusiasm there for the US economy, for the US recovery story. Are you interested in increasing exposure to US assets at this point, or are you following the vaccine rollouts through Europe and into Asia? What's the strategy?
Anna, thanks for having me. Yes, I mean, we're clearly interested in the rollout. The data from the US is incredibly strong. Growth really does look very compelling. You know, there's a lot of talk about inflation, and, you know, that's definitely a very important factor. I was interested in Mark's analysis of FX volatility, and it brings to mind the notion of sell in May and go away. We actually think there is a risk to volatility on the upside because central bank accommodation has been so pronounced. Inflation definitely a challenge, and the balance of risks are shifting.
Good morning, Patrick. So if you're generally pretty constructive overall, but you're worried that there's a little bit of a complacency on the volatility side, does that mean that you expect positive returns for stocks in the second half of the year, just not matching the first half returns?
Well, we do. I mean, I think, but it's very important that you decide what area of the stock market you're looking at. And we firmly believe that actually, you know, this rotation to value is something that we're very interested in. We see, you know, central banks accommodation beginning to tail off. I mean, the Fed obviously making some announcements. The Bank of England, in fact, meeting today, as your correspondent noted. And we'd expect a change in tone there, not necessarily a signaling of higher interest rates, but perhaps, you know, an end of QE or the beginning of the end. And so what that tells us is that there is a path to normalization of rates, and that has an implication for stocks that, you know, need higher rates. And one thinks here of particularly financials, which of course, you know, a very large part of the index here in Europe. And so as they can generate more sustained profits, that has clearly a factor that we need to weigh and consider.
Let me ask you about the search for uncorrelated assets then, Patrick, at this point, because that's something we talk about a lot with guests. We've recently seen some volatility, certainly in equities and in fixed income, but it had been calm for a little while. And so talking about uncorrelated returns, I know has sent you with an ESG hat on into new areas, and timber management, forestry management is one of those, Patrick. What does that kind of asset bring to a business such as JP Morgan in Europe?
Sure. So yes, we announced partnership with Campbell Global, which is one of the leading timber asset managers in the world, and we're really thrilled to have that capability because for a couple of reasons. I mean, to your point, what investors want is they want a diversified source of return. So timber does generate a yield, and that's very important in a very low yield environment. It acts potentially as a hedge against inflation, but I think most interestingly, there's a whole component around carbon sequestration, and particularly in the context of all of the things that are going on in ESG at the moment. Our clients really want an exposure to asset classes that meets some of those goals. And I think forestry, obviously natural carbon storage. So we're delighted to welcome them and their team as one of the leading timber asset managers into our fund.
You're speaking on a panel later on today on the role of City Week panel on the role of recognition and incentives in promoting healthy cultures. Can you give us a quick sneak preview of how that kind of role of incentives has changed due to the pandemic?
Sure. I mean, I think the panel's really about culture, and I think culture starts with leadership. And I think it's really important that not only is it sort of setting a tone and setting an example at the top of the organization, but also making sure that managers know how important culture is. So we spend a lot of time and effort thinking about that at JP Morgan. Because it really defines, the purpose for the company. And that's particularly important for an asset manager where we're a fiduciary, so we act in clients' interests first. So culture, an incredibly important part of what we do. And incentivization, that covers many things. That's not just pay, it's also career development, recognition, career mobility. So an incredibly important part of what we offer to employees here. And I think, to your point on COVID, I think putting employee welfare really at the top of the list and making sure that you've got all the resources available to look after employees, I think has been a really incredibly important part of what we've offered to employees through this period.
Patrick, with that in mind, what's the return to office plan for the EMEA region? We've got a story out overnight that talks about JP Morgan warning employees it may require them to be vaccinated. Perhaps that's more of a US story at this point. I wonder what reflections you've given to that here in Europe. It must be very difficult to manage global businesses with very different vaccine rollouts in different parts of the world.
I mean, I think it's challenging for all businesses. I mean, I think our view is, look, we look at government guidance first. And of course, that's very different in each country. The UK just announced, obviously, potentially a change in stance on July the 19th. That's very different to what's happening in France and very different to what's happening in Italy and Germany. And Germany, the vaccine rollout now, I think over 50%. So we're really looking at government response first. What is the government guidelines? Then, to my earlier point, looking at employee welfare and what are the main things that we need to do to make sure our employees are safe. Clearly, we want to encourage people back into the office in a measured way. So we're going to be just evaluating, as I said, all of these factors to come out with, a set of policies that really meets all those requirements through time.
Patrick, thanks very much. Thanks for your time this morning. Patrick Thompson, JP Morgan Asset Management's EMEA CEO. Thanks for spending time with us here on the European Market Open. Let's get up to date with all the corporate news flow. Lots to cover there. Here's Laura.
Thanks, Anna. Sources say Bullish, a cryptocurrency exchange backed by a group of billionaires, including Peter Thiel, is in a SPAC merger talk with Far Peak Acquisition. The deal could value Bullish at nearly $12 billion, with an agreement possible in the next few weeks. The final valuation could change depending on the price of Bitcoin. Europe Car Mobility Group has rejected a bid from Volkswagen, valuing the car rental firm at about 2.2 billion euros. A consortium led by the German car maker offered about 44 euro cents per share for the Europe car earlier this month, as it bets on the future of mobility services. Earlier this year, Europe Car completed a debt restructuring that handed control of the company to creditors. Sources say VW isn't currently planning to raise its offer. The world's biggest maker of Bitcoin mining rigs is suspending sales of machines for spot delivery globally to prop up prices. Bitmain Technology says it has stopped selling new equipment after top-tier rig prices plunged by about 75% since April. China's crackdown on crypto mining is causing more and more miners to abandon their operations and dump machines on the market. That's the Bloomberg Business Flash. Mark, Anna.
Thanks very much, Laura Wright here in London. Coming up on this programme, the Boston Fed's Eric Rosengren says inflation will ease next year. What does UBS Chairman Axel Weber think? We'll bring you further from Axel Weber next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may
be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Market open 15 minutes to go until the start of cash equities trading, and some red headlines across the Bloomberg that are worth noting as we look at futures pointing to the upside this morning here for European equity markets. Let's get to the Siemens news. Siemens raises its midterm profit target and plans a €3 billion share buyback. They're raising their annual revenue growth to the range of 5 to 7%. That was against 4 to 5% previously. This is over the cycle, and giving us some other guidance. This is under a new CEO, of course, over at Siemens, and the company pivoting away from previous exposure towards software, aiming to boost shareholder returns. Digitalization, automation, sustainability, these are the growth engines of this business, according to the CEO, Roland Busch. As he's calling the business now a focused technology company, saying it wants to strengthen its position in all markets. So a new update from Siemens. We'll keep an eye on shares there. Plenty of Fed speak overnight, including comments from the Boston Fed's Eric Rosengren that he expects inflation will ease next year. Bloomberg's head of economics, Stephanie Flanders, tackled the subject with former Bundesbank president and current chairman of UBS, Axel Weber.
The coming back of the economy, that the normalization in prices combined with bottlenecks and base effects will lead to inflation readings we've not been used to for a decade or two. And that may unnerve some investors and consumers, and you need to monitor it very closely so it doesn't become ingrained and embedded in wage price dynamics. We're already seeing positive price dynamics as a result of bottlenecks. If wage demand continues to fall in line with that, there's a risk that this might become more sustained than just transitory, and that's really the risk everyone's focusing on. I see the nervousness in the central bank community really starting to come up.
And just to come back briefly on that, I guess there's two issues here. There's whether the global economy is looking to an era in which there's somewhat more inflation than there's been in the last 10 years, but also whether there's a specific issue around the US and the US potentially compounding the problem with its stimulus. So I'm interested, given your background at the Bundesbank and other places. We spoke to Larry Summers earlier this week for this forum. He has said he thinks that the US macro policies at the moment are the most irresponsible they've been in 40 years. Do you agree with that?
They're definitely the most expansionary they've been in decades. The US had a massive fiscal stimulus. Monetary policy actually hasn't been as expansionary when you look at the balance sheet alone as, for example, the ECB. But look, it's an unusual environment if people like Larry Summers, Olivier Blanchard, or Paul Krugman are on the same warning side as I have been traditionally on warning about inflation risk. So I think both the economists, the community that always advocated massive stimulus, both fiscal and monetary, is getting a bit nervous this time around that we might have overdone it. And I think that first and foremost holds for the US. But there's also a broader issue on there's going to be very mixed signals. And this is a once in a decade or century event. And it's very hard to calibrate this against our models from the past. So I am concerned about inflation overshooting by more and for longer than is currently being priced in inflation forecasts of central banks. They're notoriously unreliable when it comes to medium to longer term inflation trends. And I'm also worried that we'll see a second half of the year where the economy is running really hot, first and foremost the US economy, and that will have spillover and spillback effects into the global economy. The ones that are really at a very difficult point are emerging markets, because the US might tighten and impact on their environment before they actually fully recover. So I think the fallout this time around is more focused on the emerging market spillovers of a premature or even of a late tightening in the US, because it will have effect on certain countries.
That was Bloomberg's head of economics, Stephanie Flanders, speaking there with the former Bundesbank president and current chairman of UBS, Axel Weber. You also saw in that piece His Excellency Sheikh Abdullah bin Saud Al Thani, the governor of the Qatar Central Bank. So worth mentioning, he was obviously involved in the wider conversation at the Qatar Economic Forum with Stephanie Flanders. Coming up on this programme, then, we'll look at your stocks to watch, including the travel sector. That's as the UK announces its latest decision on tourism restrictions today. More on that next. This is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open. 8 minutes until the start of Thursday's cash equity session, and things have generally been improving, certainly for the CAC 40 and the DAX, in terms of the futures picture as we've gone through the last hour of our programming. Let's get stocks to watch then. Individual movers in contention. Sam Unstead joins us from our equities team. Good morning to you, Sam. Siemens, an update from Siemens. I see, though, a headline says Siemens confirms its full year 2021 profit guidance. This despite we've got some new targets midterm for them.
Yeah, that's quite right. Again, good morning. I think the midterm targets are very likely to be what's in focus this morning. So, yes, they confirmed this year, but Siemens has been, over the course of the last few years, trying to shift their business, and in particular to capitalise on the rise of industrial automation. So their software business in particular has been a major growth driver over the last few years. In addition to those higher midterm targets, there's also a buyback, so likely to be taken, I would think, pretty well.
And Sam, you're also watching travel stocks with the infamous UK green list set to be updated. What's going on there?
Yeah, quite right. And actually, this is coming after a week in which the travel operators throughout Europe and particularly in the UK have been pushing very hard for some kind of relaxation of curbs, because we're coming, of course, into the summer holiday season. It's a major time, especially for carriers that fly to Europe. So they'll be looking for some kind of some kind of positivity on the outlook about and some kind of dates at which things can start to improve again. So not just the green list, but also whether there might be a change in allowing fully vaccinated travellers to avoid quarantine for countries that are on the amber list.
Yeah, that'll be really interesting, won't it, Sam? Whether we get that today or whether that comes at a later date. Let me ask you about solar stocks, because we've been covering this story at Bloomberg about how the United States is going to block some Xinjiang solar products, blocking some, requiring permission to import others. What's the read across into Europe?
Yeah, I mean, so for Europe, what we'll have to see is that as the day goes on, we saw a little bit of reaction yesterday in some US solar stocks, but it'll be interesting to see as this feeds through, because it's not just those bans. There's also been a targeting, or there's expected to be a targeting of one of the major Chinese polysilicon producers. That could cause a bit of a disruption to the supply chain for solar companies, especially in the US. So we'll have to see how that's taken, but certainly it would appear that there's potentially more opportunities for a lot of European companies in the US solar market.
OK, Sam, thanks very much. Sam Elstead from our stocks team. And Mark, European equity market futures have seen something of a recovery over the past hour or so. Is that broader? I see US equity market futures fairly stable, MSCI Asia fairly stable as well. But we had a big sell-off in Europe yesterday.
Yeah, look, I was thinking during the show there that it's quiet today, but it's actually a very healthy quietness in markets. And what I mean by that is that generally we're seeing a sign of a market that feels economically robust. And what I point to is there that we've got yields slightly higher, but stocks slightly higher, the dollar slightly slower, which means people are kind of leveraging out into other assets away from the world's reserve currency. So all those signs point to a slightly more positive market. Oil is higher as well. So I think it's a healthy market out there. And it was also helped by that Siemens news is kind of very good news, bullish all round, higher growth, they're going to invest externally and they're going to return cash to shareholders.
Yeah, indeed. Are we back to that negative correlation between bonds and stocks? We talked about that a little bit yesterday. We'll see if that carries on. Mark, thank you very much for spending the past hour with us. I'll be back with the European market open. We'll keep an eye on those Siemens shares that Mark was just referencing there. Got an update to guidance, stronger guidance from Siemens. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Welcome back to the European Market Open. A minute to go until the start of cash equities trading for this Thursday morning. Here are your headlines. Talking tightening, the Fed's Raphael Bostic sees a rate hike next year. Robert Kaplan agrees, saying the Fed might taper sooner than you think. And there's a ton more commentary to come from FOMC members today. The Hawks' swan song. The Bank of England says goodbye to Andy Haldane at today's meeting as it looks to balance the recovering economy and inflation concerns. And a Bloomberg scoop. The US will block some solar products from China in one of the Biden administration's biggest moves yet to counter alleged human rights abuses. Good morning, everybody. Welcome back to the second hour of the European Market Open. Let's have a look at how we could open this morning. Let's have a look at futures. FTSE futures, a little bit of a laggard today. DAX futures and CAC futures suggesting some movement to the upside. Euro Stoxx 50 futures up by 0.4%. Let's remember, we had heavy selling on European equity markets yesterday, down by more than 1% in some cases. It was pretty broad-based, that sell-off. So have we set the stage for a broad-based recovery in some cases? Today, we saw selling of luxury stocks, industrials, chips, tech. It was pretty broad, as I say. Let's see what is on the move this morning. So European equity markets just opening this Thursday, getting into their stride, and the FTSE 100 is up by 0.1%. The IBEX over in Madrid up by 0.7%. The DAX opens in Germany up by 0.5%, and the CAC 40 up by 0.4%. So we're digesting the latest commentary coming through from the Federal Reserve, and there's going to be plenty more of that. But we do see a little bit of a rebound from losses of yesterday here on European equity markets. So a little bit of positivity for the European equity market open. That's as traders assess the latest messages from Fed officials. Dallas Fed President Robert Kaplan said the threshold for tapering might be met sooner than expected. His Atlanta counterpart, Raphael Bostic, said the Fed could decide to slow purchases in the next few months. Joining us now is Ben Gutteridge, Invesco EMEA Director of Model Portfolio Services. Ben, a very good morning to you. So we've all had a week to digest what the Fed did and didn't mean by the what it was signalling, what that's going to do to markets, the flattening of the yield curve, actually a lot of volatility but lack of overall movement in stocks and in 10-year yields. Thinking about what we know about the Fed now, Ben, have you reassessed, rethought when we're going to see the taper and when we're going to see a rate hike?
Well, yeah, I mean, there is a lot of information to digest and seemingly some conflicts within the Federal Reserve about the timing of these moves. And these sorts of things, of course, can unsettle markets and create a bit of volatility. But when we're thinking over the medium term, I don't think we can move away from the fact that actually policy tightening, policy normalization will be a very slow and will be executed at a very slow and gradual pace. And of course, in the face of any negative market reaction, the Fed may well dial back on some of its hawkish rhetoric. So, yes, markets could be unsettled by a sooner than anticipated move on tapering. But overall, having reassessed over the course of the week, still feel pretty positive about equities, and we would see Fed-induced language that creates weakness as a potential buying opportunity.
And what's going to be the dominant fixed income or the dominant Treasury market impulse, do you think? Because clearly we watch the Treasuries market for because so many things price off it, and it does have the ability to influence other asset classes, Ben. So do you think the dominant impulse is going to be, you know, we'll just be watching the 10-year yield and seeing how high that gets, or we'll get higher across the curve because of slightly more hawkish commentary from the Fed? Or will we see, in keeping with that, some ongoing flattening? If we hear more hawkish messages from the Fed, will that lead to some flattening of the yield curve? Would that be your expectation?
Yeah, it does depend on individuals here, and it's hard to know exactly what any one person's going to say. But I would have thought hawkish messaging in the short term, which we do seem to be seeing this pivot, don't we, away from extremely generous policy to just generous policy. But that type of pivot is putting pressure on the short end, sending yields higher at the short end. But that flattening's happening because it seems the market's onto the idea that the Federal Reserve's more cautious about an overheating economy, inflation running away, and therefore the longer end stays tied. But I think as the market adjusts to the idea that whilst the Fed is moving away from what is tightening at the margin, it's still going to be very generous policy for an extended period, and they're certainly committed to this average inflation target. So whilst they might see some flattening over the sort of the coming months, shorter end higher, long end pegged, I think in time we'll see that long end move higher as the Fed shows its tolerance for higher inflation, trying to hit that average inflation target over time.
OK, that's interesting. Yeah, the role that new reaction function from the Fed plays will be interesting to watch. Ben, in terms of the sectors that are in focus, we had seen banks under pressure because of that flattening of the curve in some of the recent sessions. Today, we see banks rebounding up by 0.7%. In terms of the various sector exposures that you prefer to go for at this point, Ben, are you going for cyclicals? Are you going for defensives? Are you going for growth sectors? Where's your bias?
Well, we feel have a pretty high conviction view about equities. Within equities, there is more of a barbell approach. I think that flattening of the yield curve, the way that long end of the yield curve is pretty anchored at the moment. It's hard to get too excited about the banking sector, but of course we do see the reopening trade in front of us, see what's happening in the States, not just in the data, but anecdotally about the pace of reopening. And that does enthuse you towards some cyclical sectors, particularly retail, leisure and travel and such. But as I said, the barbell approach seems more appropriate for us at the moment. So pockets of cyclicality, but really do still like those growth sectors, technology, healthcare, not just because of the way they're disrupting businesses and continue to disrupt consumer and business activity. But of course, we think, as I said, I think that long end of the yield curve is pretty anchored for the time being, and that should support those parts of the market.
Ben, thanks very much. Stay with us. Ben Gutteridge, Invesco EMEA Director of Model Portfolio Services. He stays with us on the programme. We'll be sticking with the central banking story because it is Bank of England Day, and it's a tricky one at that. The central bank has to balance the need to keep the economic recovery going while limiting inflation threats. All this while contending with a departing chief economist who certainly has been pretty hawkish with his views. We'll get more on that next. This is Bloomberg.
countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
We don't have plans to close full offices and tell people to work from home. No, we want people to come into the office. With the vaccination rate as high as it is now, and the measures that people have taken, while clearly COVID-19, looks like there's going to be another wave. But hopefully that doesn't translate into hospitalizations or more serious illness.
That was the Barclays CEO, Jes Staley, there, giving the Qatar Economic Forum his thoughts on returning to the office and the current state of COVID-19. Speaking of the state of COVID-19, let's get to some live images coming to us from the Bundestag over in Berlin. Chancellor Merkel speaking there. She is saying that they can be cautiously optimistic in Germany on the pandemic. In fact, in Europe, she says. But the pandemic is not over. Vigilance is still needed. The pandemic can only be beaten through global cooperation. And she goes on to talk about the work that is needed on the global vaccine production. She reiterates that vaccine patent waivers are not the right response, and that's what we've heard previously from Germany and other voices here in Europe. Other breaking news for you across the Bloomberg. We've got lines coming out of China, or in relation to China, Australia. China is taking action against Australia at the WTO. So China is suing Australia over some anti-dumping measures at the WTO. This is seems to be in connection, filing a complaint on Australia's measures on wind tower, a complaint on Australia's measures on railway hub. So a few lines here coming through with regards to China and Australia, that well-known geopolitical line of tension coming on the day where we're carrying reports of tension, of course, between the US and China ongoing as we watch the fallout over alleged human rights abuses in Xinjiang and solar power there. So clearly, all of these themes very much in the market's minds right now. Thinking about other things that are on our radar, let's get a look at what we are watching out for today. This morning, EU leaders are set to arrive in Brussels to discuss migration, COVID and the economic recovery. Then at 12 noon UK time, the Bank of England announces its decision on interest rates and its quantitative easing programme. More on that in just a moment. In the United States, Fed chiefs are speaking, plenty of them, Patrick Harker and Raphael Bostic, at a Fed Week virtual panel discussion. Then James Bullard speaks in St. Louis, and New York Fed President John Williams also in action. So lots of Fed voices. And tonight, the Fed releases the results of its stress tests on America's largest banks and financial institutions. Those that pass with sufficient capital will be freed from pandemic dividend limits. So a lot in focus. Let's get back to one of those stories, and that is the Bank of England policy decision due today. It comes against a backdrop of rising inflation, building global debate on the path of monetary policy, and a slowing reopening of the UK economy. For more, we're joined once again by UK economy reporter Lizzie Burden. Good to see you again, Lizzie. So let's talk about what we're expecting then, because there's going to be a difference perhaps between the rhetoric and the conversation and the signalling and the actual voting that we see from members.
We're expecting a unanimous vote to keep interest rates at 0.1%. On bond buying, an 8-to-1 split. Andy Haldane, the outgoing chief economist, set to be the sole dissenter again in favour of paring back stimulus. He's likely to cite this jump in consumer price growth above the bank's 2% target. But the question is how temporary that'll be. We've had a growing minority of economists bringing forward their forecasts of when the first post-pandemic rate hike will be. Bank of America, Credit Suisse, Suisse, money markets are betting on a 15 basis point increase by June next year. So it'll be interesting to see how the bank deals with that tension between its recent position and the market.
Yeah, interesting to see if it tries to push back at all against those building expectations of rate hikes. And so what do we know about the sort of longer term and the preferred course of action down the line then from the Bank of England?
Yeah, it's not as if nothing's happening today. Investors will be scouring the MPC statement for signs of what's down the track. We've had lots of positive economic signs recently. Housing, manufacturing roaring ahead, payrolls surging, consumers upbeat. But at the same time, we don't know what's going to happen with unemployment when the furlough scheme ends. We don't know if the government will be able to get the Delta variant under control in time to reopen the economy as planned. So those are two factors that will limit how hawkish the bank's prepared to be. And it may be that it wants to wait for clearer data in August to give a more concrete sign of what's in the pipeline.
Lizzie, thanks very much. Lizzie Burden, Bloomberg's UK economy reporter with the latest on the Bank of England. Ben Gutteridge, Invesco EMEA Director of Model Portfolio Services, is still with us. And Ben, let's think about whether we see any more hawkish voices joining the departing voice of Andy Haldane when we get to the Bank of England a little bit later on. I was drawn to some commentary from Andy Haldane just recently in the New Statesman. He talked about if central bankers wait to see the whites of the tiger's eyes before acting, they risk having to run like the wind to avoid being eaten. A fairly graphic description or justification for his more hawkish stance. Would you expect any more hawkish voices to emerge at the BOE?
Well, I mean, it's hard to tell. I think there's certainly scope for more hawkish dissenters when you know the vast majority are dovish. You know, I think it's much harder to become a hawk when you're going to be a marginal, going to have and end up having an impact on the overall decision that's taken. You know, if it's evenly split and you turn out to be a hawk, then that's it. You've got hawkish policy on the table. So we could easily see dissenters when there is a clear majority amongst that cohort. So I wouldn't be, too disturbed to see dissent. It's sort of healthy for debate, but sort of make no mistake, this is still a very sort of dovish a collection of economists and academics.
One of the reasons for being dovish, Ben, that we often hear cited is we don't know what's going to happen with the labour market. And we were just hearing this from Lizzie earlier on, not knowing what's going to happen with the labour market because, of course, we're coming to the end of the furlough scheme, what that will do. Does that justify the dovishness? Inflation has been picking up, of course, but there are clouds on the horizon when it comes to how sustainable, of course, that inflation move is.
I mean, I think it does. I would agree with the report that you just gave. I mean, there is so much uncertainty about how the lapsing furlough scheme will impact the employment and labour market statistics and demand, etc. So I do think that patience is required, and amidst that patience, dovish policy. But that doesn't preclude the idea of paving the way for a tapering, that talking about tapering and recognising that there are certainly lots of positives and signs of life in the UK economy, as building demand, the vaccine programme, and of course the housing market. No, the UK is not alone actually in a strong housing market around the world, but certainly, a strong housing market. So paving the way for a more hawkish notes in policy as we move through the year, but conditioned with lots of with patients' commentary around that.
So patient commentary. So we'll look for that. In terms of the European assets, then, Ben, where are you? We talked about the various sectors you were looking at. The debate at the moment around growth versus value and whether we're back to favouring one over the other. You've given us a few thoughts, but pick up on some of the individual sectors that you like at the moment. Where is it that you're actively pursuing? Communications, technology. What's the focus for you?
Well, I think because of the conditions we're dealing with, I think one thing I haven't mentioned, of course, what's happening in China is the slowing, the tightening of policy and the slowing growth and demand in pace of growth in China, and that will steer you away from certain sectors at the moment. I think like materials, not that we want to sort of zero weight those areas, just have a sort of an underweight, and that the way that would sort of weigh on growth. You know, we're not talking about a downturn. We're just talking about a deceleration in growth. And when you have a slowdown like that, that leans you towards more defensive, higher quality areas. So areas such as technology and healthcare, we think can perform in this environment.
Ben, thanks very much. Thanks for joining us this Thursday morning here on the European Market Open. Ben Gutteridge, Invesco EMEA Director of Model Portfolio Services. Ben will be continuing his conversation with us on Bloomberg Radio at 9 a.m. UK time. Coming up on this programme, it's a busy agenda for today's EU Leaders Summit as concerns over the spread of the Delta COVID variant look set to dominate discussions. Chancellor Merkel busy giving her lines on that, and also about migration and Russia. No doubt these things will also be on the agenda when leaders meet in Brussels. We'll get a detailed update next from Brussels. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
The European Commission has given green light to Belgium's recovery and resilience plan.
The European Commission has today given the green light to Germany's recovery and resiliency plan. 25.6 billion euros will flow to Germany.
Italy will receive the largest share, 191 billion euro.
That was Ursula von der Leyen, the European Commission President, on a victory lap of the EU as most of the bloc's recovery funds are announced and approved. We saw her there making various appearances, giving us the good news. Now, sticking with Europe, EU leaders today for their last summit before the summer recess. The bloc's green stimulus, the so-called sausage wars, and the risk added by the Delta variant will all be high on the agenda. Let's get more now. Maria Tadeo joins us from Brussels, where this summit is going to be taking place. Our Europe correspondent, of course, with details. Maria, good morning. So how big a risk are variants of the coronavirus, the Delta variant, of course, high on the list amongst those? How big a risk is this for the European reopening story?
Yes, Anna, good morning. Look, there's a lot happening today in this European summit, but the number one priority is still very much coronavirus and the focus on those variants. And Anna, yesterday there was a report by the European Disease Prevention Center that said this is a variant that is much more transmissible than any other variant, but also warned that by the end of the summer, 90% of all new cases in Europe will be the Delta variant. So for European leaders, they're really balanced between reopening and taking off some of those restrictions. Remember, there's been a real push in Europe to reopen for the summer, to save the summer season and attract tourists into the European Union and contain this new variant. Now, remember, Anna, a lot of this, European leaders have told the population across the EU that this would be the final lockdown, that back in September it was back to normal life. But of course, as we've seen in the United Kingdom, that could be problematic if the variant spreads too quickly.
Yeah, absolutely. It does seem to change the dynamics, change the maths, basically, on the amount of vaccination that you need to remove certain lockdown measures. Certainly that has been the UK experience. Sticking with the UK, left the EU, but still it seems hanging over this summit, parts of those Brexit negotiations, which we, of course, much of that long gone, long behind us. But trade tensions over chilled meat going between GB and NI, Great Britain to Northern Ireland, the so-called sausage wars. We seem to have seen action to, or at least messaging to take some of the heat out of that situation. Are we expecting a resolution?
Yes, Anna, you know, the famous sausage war, or infamous, you know, you can characterize it as you want. But, you know, it does seem that now, based on the reporting that Bloomberg has done, that European governments are now leaning towards extending this grace period into that deadline that is coming up at the end of the month. That is, of course, related to that meat trade rules going into Northern Ireland. The question really now for European leaders to decide is just how long this extension should be. You know, we know the UK wants 3 months, but some of the European governments actually believe that they will need much longer. And the criticism from this side of the channel has been for weeks that the UK government is not doing everything that it can in terms of the infrastructure, the personnel, the staff to implement this Brexit deal. Of course, the flip side is the United Kingdom arguing that a lot of the details on paper look great, but they're very hard to implement in real life.
OK, we'll watch that then, and the movement on those two very important issues and beyond. Maria, thank you very much. Maria Tadeo, Bloomberg's Europe correspondent, joining us there from Brussels. Let's take a look at some of the stocks that are on the move this morning. Broadly speaking, we are seeing stronger moves in equity markets, moving to the upside. In terms of the individual movers, Berkeley Group, the house builder, up by 2.4%, a far cry from yesterday where we saw this stock under pressure. Profit outlook disappointing, broker downgrades, but the stock up by the most in 15 weeks in a sort of rebound style this morning. Old Mutual up the most in 7 months, up by 5.9% in today's session. Trading volume surging on that particular South Africa financials business. And we also put in here Tecan Group. This is Swiss-based, of course. They've done a deal to buy Paramit, which some brokers are cheering about, and the stock is up by more than 12.5%. A life sciences and diagnostics business, as I say, based in Switzerland, a market cap of around 5.8 billion Swiss francs. So we'll watch that one with interest. That stock clearly making solid moves to the upside. Coming up, we'll get back to the geopolitical tensions between the United States and China. The US is set to ban some solar products made in China's Xinjiang region. We'll bring you all of the details behind the story coming up next. Bloomberg has been closely tracking these particular developments. Interesting to see the US has decided to bar some businesses from being imported and impose difficulties on importing others from China. This does have read across for other manufacturers in other parts of the world, of course, as well. And we've seen some producers of solar technology here in Europe on the rise today as a result of this ban being put in place by US authorities against Chinese solar manufacturers. We'll get more details next. This is Bloomberg.
delayed 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly, and later this week we'll get unemployment, inflation and retail sales data that should all further illuminate the economic recovery.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open. Half an hour into Thursday's trading session, and European equity markets broadly on the front foot, certainly in Paris and certainly in Germany. We've got European equity markets up by 0.4%. The DAX and the CAC both up by more than 0.3%. The FTSE a bit of a laggard. Let's have a look at the sector breakdown. Gives you a sense of why we are seeing that as the situation. To the upside, consumer products and services and luxury stocks and consumer products seem to be rebounding well today after a heavy selling yesterday. So luxury names like LVMH and L'Oreal moving to the upside. That helps the Paris market. Autos and parts helps the German market. Both of those sectors moving strongly to the upside. To the downside, though, you'll see a couple of sectors that have pretty heavy representation here in London. Certainly in telecoms, Vodafone and BT under pressure, lending some points to the downside when it comes to movement here in London. Let's get a Bloomberg First Word News update. Here's Laura Wright. Laura.
Thanks, Anna. Boris Johnson's government is to convene a London summit to help tackle the lagging COVID vaccination rate in the UK's capital. The latest regional data shows 60% of Londoners have had at least one dose of a vaccine, compared with 73 to 79% across England's other regions. A surge in cases of the Delta variant is continuing to push UK infections to levels not seen since the winter. Daily fatalities, however, remain low. President Biden has ousted the regulator of mortgage companies Fannie Mae and Freddie Mac, replacing a Trump administration appointee. The move follows a ruling by the U.S. Supreme Court, which rejected a core part of a lawsuit brought by investors in the companies. Shares in Fannie and Freddie each plunged the most in intraday trading since 2013. John McAfee has been found dead in a Spanish prison cell shortly after it was announced he would be extradited to the US to face charges of financial crimes. The creator of the McAfee antivirus software had been jailed in Spain since October on US evasion charges. Spanish newspaper La Vanguardia reported that he appeared to have taken his own life. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you. Laura Wright here in London with your First Word News update. Now, the US is poised to bar some solar products made in China's Xinjiang region, marking one of the Biden administration's biggest steps yet to counter alleged human rights abuses against the country's ethnic Uyghur Muslim minority. Joining me now is Bloomberg's chief Chief Asia Economics Correspondent, Enda Curran. Enda, good morning. So what is the significance of this move? The Trump administration and China, of course, clearly were at loggerheads over this. This has been part of a series of disputes between those two leaderships, if you like. But there's some continuity then into the Biden administration, at least on this front.
Well, indeed, Anna, as you mentioned, it's been considered a fairly aggressive strike, or a significant strike, at least by the Biden administration, against China over the allegations of human rights abuses and forced labor in Xinjiang. And of course, Xinjiang is home to around half of the world's source of polysilicon, and this is crucial for the making of mobile or for semiconductors and solar panels and the like. So China, of course, rejects those allegations, but the thinking is that this move by the US may have knock-on effects, not just for the political relations between the two countries, but for the supply chain on the industrial side of things. Some companies will now need to source solar products from elsewhere, and you might see some kind of a shuffling of the global supply chain for solar products. Now, the move isn't as broad as some were pushing President Biden to do, but nonetheless, it is another strike against China. And to your point, it does seem to be a continuation of the narrative that we left off with when President Trump left office.
Yeah, so some of these products banned from the US and some of them just made more difficult, if you like, to import. We are seeing some response from the Chinese authorities today saying that China opposes US punishment of its companies, will protect the rights and interests of its companies, and obviously objecting to the moves we're seeing here from the United States. What does this say then, Enda, about the wider US-China relationship?
Yeah, well, I think it will be expected that China will push back against this measure, and no doubt about it. And of course, we'll have to wait and see what kind of details do come out of Washington on it. But at the very least, it does speak to the idea that President Biden is pursuing, continuing a broadly hawkish push against China. We don't yet have the full specifics or contours of his administration's policy on China. I mean, so far they've only had fairly official level courtesy calls other than that meeting in Alaska. But we saw some of what he might be thinking about at the G7 summit earlier this month when he tried to get that alliance against China and to take a pretty hawkish stance. I mean, he made some progress there, but as we could see, Europe didn't quite go to full distance with President Biden on that. So, as I say, we don't yet have the specifics on how he will approach China. There are expectations that the two leaders may speak at least over the coming months at one of the international summits, such as the G20. But at face value today, when you look at these proposed measures that they're planning when it comes to Xinjiang, it does suggest that President Biden is not stepping away from the hawkish approach towards China. He might just be changing the mood music a little bit, but the end result looks like being the same.
OK, thanks very much, Enda. And there is a read across into European companies here because, as Enda says, we're seeing a rejigging then of the supply chains. And companies such as Wacker Chemie, which is a basic and diversified chemicals business, supplies polysilicon for the electronics and solar industries. That stock up in today's session on these particular developments. Thanks very much to Enda Curran, Bloomberg's Chief Asia Economics Correspondent. Coming up here on this programme, the Fed releases its stress test later today. After a year of constraints, will US banks begin to buy back and will they begin to repay or pay out those dividends once again? We discuss up next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
The stock market is detached from reality, and I feel bad for my hedge fund friends because it is. I don't know how I trade it. I mean, I have some. I invest and I don't sell. I don't. But I mean, my housekeeper is day trading and getting rich.
That was the Starwood Capital CEO, Barry Sternlicht, speaking at the Qatar Economic Forum, giving his thoughts on the lack of connection or the disconnect between equity markets and the real world. And these are your equity markets this morning. This is the picture for European equity markets, making some moves to the upside, recovering a little bit of the loss of yesterday, but not all for European equity markets. Now, results from the Federal Reserve's bank stress tests, they will be released after the close today. The annual exercise, which tests how banks fare during various hypothetical shocks, is usually followed by banks saying how much capital they will release in dividends and in buybacks. Joining us now is Bloomberg's finance managing editor for EMEA, Michael Moore. Good morning to you, Michael. So what are we likely to see then in these stress tests? Is everybody going to pass? Will there be a sort of fine bill of health?
There is an expectation that most of the big banks will pass, and pretty easily, partly because they've been forced by the Fed over the last year to maintain higher capital levels than they would otherwise have. There was a freeze on buybacks and dividends kept lower. So there certainly is an expectation that the floodgates will open a little bit and allow these banks to start paying out payouts to their shareholders who've been waiting for these for a while.
Yes, indeed. So if that is the pivot we often see, or that is the declaration we often see on the other side of these Fed stress tests, is a declaration from these banks about what their intentions are. So what are we expecting this time then, given it's a little different, isn't it? We're coming from a period where payouts were unusually low.
Yes. So it was artificially low over the last year, and the banks have made the argument. We went through a real stress test last year with the pandemic, and we passed that. Maintained profitability in most cases. So I think this will be a more typical year, and there were some changes to the process that came into effect last year, but last year was such a strange year that this is the year you'll really see them come to the fore, and they make it less of a guessing game and more of a math exercise.
Okay.
There used to be the banks would put in what they hoped to pay out, and then the Fed would say yes or no, but then they had a mulligan. If if the Fed said no, they could try again. Now it's more, here's your number, stay above that, and if you want to make payouts above that number, you're welcome to.
Okay.
James Gorman described it as treating the banks more like grown-ups. Yeah.
Okay, all right, more grown up, a bit more about the maths. What are the stresses that they're testing against? Because to your point there, Michael, and the point that these bank executives have made, they have been through an incredible stress, and perhaps one that was not necessarily simulated by the Fed, or not in the precise dimensions with which it hit markets. So what are the kind of tests that they are being put to?
Yeah, so it's a broad-based recession with a market shock. The banks have made the point that, you never can predict what the next one will look like. And certainly, 2 years ago, no one was talking about a global pandemic. So, but in many ways, the market side of the test, it can be harsher than what we actually have seen the last few times there have been a ripple in the markets, because last year, it looked like the markets were going haywire, and then the Fed stepped in, and the banks actually made a ton of money in trading. But this test tends to assume that they will do poorly on the trading side, and that's why you see Goldman and Morgan Stanley often hit the hardest in terms of their capital ratios in that test, even though they've stayed above the minimums.
Okay, so the err on the side of caution, as you would expect, I suppose, from a testing regime. Michael, thank you very much. Michael Moore, Bloomberg's finance managing editor for EMEA. Thanks for bringing us the update. Let's get a Bloomberg Business Flash. Corporate stories in the news this morning. Here's Laura.
Thanks, Anna. Siemens has raised its financial targets and announced its first share buyback since 2015. The German industrial giant will buy back as much as €3 billion of stock over a 5-year period, starting from next year. That's as the company's new chief executive pivots towards software to boost shareholder returns. Europe Car Mobility Group has rejected a bid from Volkswagen, valuing the car rental firm at about €2.2 billion. A consortium led by the German car maker offered about 44 per share for Europe Car earlier this month as it bets on the future of mobility services. Earlier this year, Europe Car completed a debt restructuring that handed control of the company to creditors. Sources say VW isn't currently planning to raise its offer. Blackstone CEO Steven Schwarzman says the risk of a hike in US capital gains tax has led to explosive growth in potential targets for his alternative investment firm. Speaking at Bloomberg's Qatar Economic Forum, he also described the US economy as really on fire, with everything growing much faster than almost anyone anticipated.
It's really like an avalanche now of opportunities of people want to sell things before their taxes are much higher for selling the same thing potentially next year. And so it's giving us a lot of opportunities. And what we have to do is be careful, always have a very exciting plan for growth.
The world's biggest maker of Bitcoin mining rigs is suspending sales of machines for spot delivery globally to prop up prices. Bitmain Technology says it has stopped selling new equipment after top-tier rig prices plunged by about 75% since April. China's crackdown on crypto mining is causing more and more miners to abandon their operations and dump machines on the market. That's the Bloomberg Business Flash. Anna.
Laura, thank you. Laura Wright here in London. SEC Chair Gary Gensler says trillions of dollars worth of assets may need tighter rules, a problem highlighted by this year's market disruptions. He spoke exclusively to Bloomberg about what the SEC is doing to review rules on everything from meme stocks to blank check companies.
I'm going to be animated every day in this job by working families. And working families need the protection. And Franklin Roosevelt knew this in the 1930s. We know this now. President Biden knows it. It's about working families, ensuring they get the disclosure so they can make their choices in the markets. And there's a cop on the beat protecting against fraud and manipulation. That helps companies raise money, too, by the way, by lowering the fraud manipulation, ensuring that there's consistent disclosure to those investors. I think companies benefit as well.
Disclosure is a broad concept, so let's narrow in on that. Where specifically do you think we need more disclosure?
Well, I think there's trillions of dollars of assets under management now calling for greater and consistent disclosure around climate risk. And when I've also asked staff to take up disclosures around human capital, the most important, really fundamental asset of a company, the people that work there.
Gary, thank you so much for joining John and I this morning. I'm going to go broader here, Gary. I have never seen a primal cry for an SEC commissioner to just do something. You mentioned something I mentioned an hour ago, which is FDR. I'll go to the Commonwealth speech early in the Depression. There is a primal scream, Chairman, to do something. What is the do something you want to do to help us with meme stocks, with SPACs and other things I don't understand?
Well, Tom, you're being a little immodest. I'm sure that you understand them a little better than that, and your listeners have listened to you for years. But look, what I think the important thing is investors want to know there's somebody looking after them. Working families, pensioners, people that have 401ks. So you mentioned special purpose acquisition companies, or so-called SPACs. It's really making sure that the sponsor who's behind that is fully disclosing their take on it. These are very expensive, dilutive products. I mean, the sponsors take out a chunk at the beginning, then there's more being taken out later when they merge with a private company in what's called a de-SPAC. I just call that a target IPO. And it's those disclosures ensuring that the retail investors get the right disclosures and are protected and somebody's not misleading them. And secondarily, that they're participating just like the institutional investors. And a lot of the big institutions buy into these SPACs later during that target IPO, and they do so at a preferred price rather than the price the retail public's getting.
That was the SEC Chair, Gary Gensler, speaking with my colleagues here at Bloomberg, Jonathan Ferro and Tom Keene. 48 minutes into our trading session, coming up on this programme, taking flight, the short and long end of the Treasury curve are expected to outperform if market volatility continues. So says our Market Live team strategist, Ben Ram. He joins us next. This is Bloomberg.
Valuations, particularly, sort of technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
It's very hard to calibrate this against our models from the past. So I am concerned about inflation overshooting by more and for longer than is currently being priced in inflation forecasts of central banks. They're notoriously unreliable when it comes to medium to longer term inflation trends. And I'm also worried that we'll see a second half of the year where the economy is running really hot, first and foremost the US economy, and that will have spillover and spillback effects into the global economy. The ones that are really at a very difficult point are emerging markets.
That was the UBS chairman, Axel Weber, speaking to Bloomberg and speaking at the Qatar Economic Forum on concerns about inflation overshooting and the spillover effects it may have on the economy. European equity markets rebounding from some of their losses from yesterday. In today's session, European stocks up by around 0.5%. The FTSE lags a little bit. Exposure to some of the more defensive telecoms names in particular under pressure in London. Let's just get to some of the geopolitical tensions we've been tracking this morning, certainly between China and the US and between China and Australia. We saw the Chinese announce they'll take action against Australia at the WTO earlier on. And today we hear from Australia saying that they will will vigorously defend against Chinese duties. This according to the Australian Trade Minister speaking to reporters. So that's some of the geopolitics we're dealing with and the market moves of this morning in terms of equities. Let's get into a broader conversation of positioning now, though. Ven Ram, Bloomberg Markets Live macro strategist, is with us. And Ven, you've been writing a lot about the exposure that you want to get in Treasury markets. If you think we're going to see volatility in Treasury markets, where on the curve should we be positioned? What's your thinking?
Morning, Anna. I think that, we have seen huge bouts of volatility, as you mentioned, in the past week since the Fed meeting. And if that position, if volatility is going to continue, you want to be in a combined trade where you're both long the front end of the curve and the back end of the curve, and you're short the middle, the intermediate maturities. Why would we say that? We would say that because that kind of combination gives us a lot of convexity, and you want convexity when volatility is up and running. And with all the Fed speakers that we've got pretty much every day these days, there's bound to be sharp changes in prices, and volatility is going to be up, and you want to be long the wings of the trade, long the wings of the curve.
And so what does that tell us about what your expectations are for either flattening or steepening then, Ven? If we're set for, at the margins, a little more hawkishness coming through from the Federal Reserve as we go through into the second half of this year, if we are set for that, does that lead to flattening of the curve, or what does the picture you just painted tell us?
It does point to a flattening of the curve over the next 6 months. But beyond that, it could be a steepening. But for the next 6 months, definitely we are talking about a flattening of the curve. And this particular trade that I mentioned, where you're along the wings of the curve, is actually a position adjustment in search of, in preparation for what the Fed might do later next year, and in terms of tapering and in terms of raising rates.
I was talking to our colleague Mark Cudmore earlier on this morning, Ven, and we were talking about how football and summer sport can distract the FX market in particular when it falls into European time zones. We've seen low volatility in FX markets in recent periods. Is that something you're expecting to continue? Are we seeing that already? Is it already the summer lull?
Well, it's been a summer lull, if you ask me, for a long time now in the FX markets, because the central bank actions in the markets have kind of quelled volatility in the FX markets for a long time now, because there is, every time there is a big dislocation in the market, the central banks are there, ever willing to support the markets by, unleashing stimulus and even more unleashing stimulus. And that kind of makes bidding volatility not a very profitable trade. So I think that FX volatility is going to be in the doldrums for a long time now. And if anything, it will only get accentuated into the summer.
Yeah, well, yeah, maybe that central bank activity then made that summer lull come early. At least we now, at least in London, have the weather to go with it. Ven, thanks very much. Ven Ram from our Markets Live team. Thank you very much for joining us on the European Market Open. That is it for the European Market Open. Surveillance Early Edition is up next. European equity markets to the upside. US futures also pointing higher. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The U.S. economy is really on fire. Almost everything is growing much faster than almost anyone anticipated.
The conversation about crypto is a minor percent of any dialogue we have with any company worldwide. It's just not terribly important.
We don't have plans to close full offices and tell people to work from home. No. We want people to come into the office.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Thursday, the 24th of June. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Sooner rather than later, the Fed's Raphael Bostic and Robert Kaplan say the Fed could start tightening by the end of 2022. And there's plenty more commentary from Fed speakers today. The hawk takes flight, while the Bank of England's chief economist, Andy Haldane, is likely to use his last meeting as an MPC member to push for a reduction in asset purchases. And JP Morgan warns that it may require employees to get COVID-19 vaccines as big banks push to get staff back to work. We'll hear from our discussion with Barclays' Jess Staley and much more from the Qatar Economic Forum. So the Fed may tighten by the end of 22 and decide on trimming bond purchases in the next few months. That's according to Atlanta Fed President Raphael Bostic. Now, he was echoed by his colleague Robert Kaplan, who said he sees a decision on tapering coming sooner rather than later. Some of our top guests at the Qatar Economic Forum weighed in also on the risks around inflation.
The U.S. economy is really on fire.
Developed markets like the U.S. and Europe are further ahead.
Worried that we'll see a second half of the year where the economy is running really hot, first and foremost the U.S. economy.
I do think that prices are going up, and we do see it in our companies.
And that will have spillover and spillback effects into the global economy.
But I don't think it's anything to be alarmed about at this point.
The chances are higher as opposed to lower that this is ongoing inflation and that the Fed will need to adjust.
This is, in our view, a transitory phenomenon.
I am concerned about inflation overshooting by more and for longer.
I think if you see break-even inflation rates go above 3% or something like that, and you see that spurt, then you have the dilemma of the tightening of the monetary policy.
Well, joining us now to talk about inflation is Klaus Bauder, Societe Generale Global Chief Economist. Klaus, I have many questions for you. First of all, it doesn't seem that the market is, repricing what we heard from Fed officials yesterday, which is actually we could have an interest rate increase early as next year. I mean, that's pretty soon and pretty unexpected.
Yes, it is. We've had the last FOMC meeting offered big surprise because not only was there a move of the median expectations towards a rate hike in 2023. That wasn't the case previously. And there is a not insignificant minority on the FOMC, which now sees an interest rate hike in 2022. Now, the difficulty, this may still seem a long ways away, but it has immediate relevance because if that were to be the case, then the Fed's tapering would have to be very quick, much quicker than, for instance, we expect, I think, much quicker than most people in the market expect, simply because you want to have finished asset purchases by the time you raise interest rates. That's at least been the preferred strategy, and I think breaking that strategy could potentially instill a lot of uncertainty and a lot of volatility in markets.
All right, Klaus, keep that thought because we're also going to talk about Bank of England. Klaus Bauder of Societe Generale stays with us. Let's also bring in Lizzie Burden about what we're expecting from the Bank of England, set to announce its policy decision today against the backdrop of rising inflation, a growing global debate on the path for monetary policy, and a slowing reopening of the UK economy. Lizzie, there's actually so much going on for the Bank of England, and they really need to try and, I guess, walk the path of not freaking out the markets, while at the same time, making sure that they kind of, juggle everything in terms of growth and inflation.
Exactly. Well, so we're expecting a unanimous decision to keep interest rates at 0.1%, but an 8-to-1 split on bond buying with Andy Haldane, the chief economist, again, the sole dissenter, the lone hawk in his swan song, to pare back stimulus. He's likely to cite this rise in inflation above the bank's 2% target, but the question is how temporary that'll be. We've had lots of economists bringing forward their forecasts of when the first post-pandemic rate hike will be. Bank of America, Credit Suisse. Interesting note from Berenberg this morning. They've said the bank could surprise markets today by signalling it'll end planned asset purchases in August instead of December. But as you say, the bank will have to deal with this tension between its recent position and the markets.
So, Lizzie, is there a chance actually the Bank of England moves before the Fed? I mean, in terms of timeline, how quickly could that happen?
Who knows? I mean, we've had all these positive economic signals in the UK, manufacturing, housing roaring ahead, payrolls surging, consumers upbeat. But at the same time, in the UK, you have to acknowledge that unemployment, we don't know what's going to happen when the furlough scheme ends. We don't know if the government will be able to get the Delta variant under control in time to reopen the economy as planned. So that's going to stop the bank being as hawkish as it may want to be. In the future, it may want to wait until August for clearer data to be clearer about what it's going to do.
Lizzie, thank you so much. Our Bloomberg UK economy reporter there, Lizzie Burden. So let's get back to Klaus. And Klaus, I don't know whether it's a race, right, between who moves first, but it feels like, I don't know, the first that moves may have a first mover advantage.
I would think it's a first mover disadvantage, actually. I think that none of the central banks really want to break cover here. I think they'll want to move, more or less in tandem, because, the big risk is that, for instance, let's say Bank of England clearly steps ahead of the Fed, stops its asset purchases, as a reporter suggested, as early as this late summer or autumn. I mean, chances are that sterling would absolutely surge, and I don't think that that's what politicians want. I think. While what was said is absolutely true, I think what we also need to keep in mind is that the UK economy was probably the worst hit economy out of the advanced economies, and it's still the one that is furthest behind the starting position before the crisis. So the UK economy has a long, long ways to recover. It's basically as hard hit as Spain, and so I think in that sense, the case for a very early move by the Bank of England is not very strong. But, let's not forget, the Bank of England has already tapered, and they have managed to do so in a very undramatic way. And so I think, actually, they've been quite successful.
Klaus, what are we misunderstanding, actually, about how some of these central banks operate or how the markets misinterpret or interpret some of their communication strategies?
Well, I wouldn't necessarily say that the market is inept here. The fact is that, central banks have, and all of the main central banks, I wrote this up in quite some detail in our latest quarterly outlook. If you look at the evolution of central banks' macroeconomic forecasts, whether that's for GDP, whether it's for unemployment, whether it's for inflation, they have all improved quite dramatically since, let's say, call it the darkest hour roughly a year ago. And yet the monetary policy stance is completely unchanged. And that there's an increasing tension between this much better economic outlook and a completely unchanged monetary policy stance. And so those two, I think, have to be aligned again. And I think the Fed did a pretty good job aligning it with these changes in the dot plot that were published at the previous FOMC. So I don't really think, and I wouldn't blame the central banks that they're getting the communication all wrong. They're just dealing with a very fast-moving economic outlook. And because the deltas, the changes have been so enormous, the shifts are also enormous in the outlook, much bigger than they have been historically.
Yeah, Klaus, what are you expecting for treasuries?
Well, we expect a continued gradual increase in long-term interest rates, and that's very much a global view. We think it won't be by year-end. We're actually going to have positive bond yields. Would you believe it? Bund yields, I'm sorry. Positive Bund yields. That'll be something. We haven't had that for a while, but yeah, I think interest rate, the bond markets are going to normalize, and it's going to make a difference that central banks aren't major buyers of those assets any longer.
Yeah, Klaus, calls for celebration for the banks for positive yields. Klaus Badhurter of Société Générale joining us this morning. Now, coming up, an avalanche of opportunities. A Blackstone chief executive, Stephen Schwarzman, says the risk of U.S. capital gains tax increases could actually lead to an explosive growth in potential targets. More from our conversation with him at Bloomberg's Qatar Economic Forum. Up next, this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition of Francine Lacqua here in London. Now, more from the Qatar Economic Forum and a conversation with Blackstone's chief executive, Stephen Schwarzman. He says the risk of an increase in U.S. capital gains taxes may lead to an avalanche of opportunities as corporate owners look to cash in ahead of any legislative changes.
We've been through these periods of higher multiples, and it leads to a certain type of caution, but it also presents a lot more opportunities because prices are higher, more people will sell. What we've learned is because we're fundamentally in the private markets, is that the only reason to buy something is to make it much better. We're in the business of accelerating growth of companies and of real estate that we own. And so it's unlike stock investing where you buy it and you hope it works out. We're change agents. We believe for good. And if we can put more money to grow businesses, then we can deal with some of the issues of higher prices by accelerating growth, which gives us more protection on the downside. With the prospect of the United States potentially increasing capital gains taxes very significantly, it's really like an avalanche now of opportunities of people want to sell things before their taxes are much higher for selling the same thing potentially next year. And so it's giving us a lot of opportunities. And what we have to do is be careful, always have a very exciting plan for growth. By the way, that results in us hiring more people. So this is good for society. And hopefully it's good for our clients who typically are large institutions like QIA.
Your Excellency, how far along is the QIA in actually try to diversify its portfolio? So I know you've planned to boost investments, for example, in technology and healthcare. Is that done to a level that you're satisfied with now?
Not yet. I think we have been deploying and focusing in technology and healthcare. Within the last 2 years, we have deployed in technologies more than ever before. I think the sectors is promising, especially if you really targeted a certain segment within technologies. And I think it's the sectors is have grown to stay. I don't think so. There is a risk, perhaps in the short term, with the inflation in mind. Even though I'm not really concerned about it, I think it would be a temporary basis. But as you know, it's the era of technologies, and a portfolio without a huge component of technology is not really a balanced portfolio.
Well, that was the Qatar Investment Authority's Chief Executive Officer speaking at the Qatar Economic Forum with Stephen Schwarzman. Now, as you could hear, the Blackstone Chief Executive sees an avalanche of opportunities coming from an increase in U.S. capital gains tax. He says the investors want to sell things before their taxes are much higher for selling the same thing potentially next year. So let's discuss taxes and investments with our guest this morning. He's Klaus Bader of Societe Generale. Klaus, when you look at some of the growth models, some of the inflation models, given what we're seeing with COVID-19, how much does the tax regime actually change, I guess, the trajectory of growth or just some of the companies?
I don't think dramatically. I don't really think that is the key thing. There is, of course, a very legitimate question, which is, we're right now, we have absolutely massive public sector deficits. And how are we going to get away from those public sector deficits? How are we going to get back to a sustainable path of public finances? And is it going to require significant tax increases? I think it may well not. And the reason is that the deficits are as large as they are currently because governments have dramatically increased the sensitivity of the public sector deficit to GDP. And so as GDP recovers, and it is recovering much faster than anybody has expected, that the public sector finances are also going to improve more than the long-run relationships between GDP and the public sector deficit would suggest. And so I'm not massively worried about this. Now, don't get me wrong. In the US, there is very much a discussion about making the tax system more equitable. And that is something that I certainly wholeheartedly agree with. The fact that a lot of the biggest US companies don't pay any taxes, well, that's outrageous. And so the US tax system really needs an overhaul, a big one, and Joe Biden's on the job. And so I think that's good. But no, I don't think that that's really the key issue. For me, the key issue for the near-term economic outlook is all around households. Households and the behavior of consumers is front, back, and center of this recovery because they are chock-a-block with savings. Chock-a-block.
But Klaus, so how do you see it? You know, this would point to what, higher inflation globally?
Well, yes, then it did in the base case. You know, as everybody is revising up their growth forecast, including us, everybody is also revising up their inflation forecast. Now, you know, that doesn't mean that I'm looking for, you know, some explosion in inflation, but I also don't think that we're going to return to the super low inflation environment that we were in. I'm definitely in the camp that doesn't say, you know, it isn't, you know, we called our global economic outlook, the latest one, we called it inflation transitory until proven permanent. Now that's, you know, it's a good title. I didn't come up with it. It's a great title. I didn't come up with it. But the point is, it's not so much about is it going to be permanent, but rather is inflation going to be of the kind that is going to force central banks into action? That's really the question.
Klaus,
I don't think we're forever in a high inflation. Sorry, yes.
No, but I mean, it's very difficult for inflation. I mean, I know it depends on what you measure, but I was sent a photo, for example, of a croissant, a coffee yesterday for £6. I know I live in an expensive city, but actually, if people need to put up their prices to make up for, you know, COVID-19, for the pandemic or whatever, they then don't lower them after a while, right?
Correct. No, but you see, yes, but you have to differentiate between what you're now talking about is really characterizing effectively a one-off increase in the price level. And so you get for a period high inflation, but then you go back to the previous inflation trend. When people talk about permanent inflation, what they talk about is that you get higher inflation leading to higher wage demands, which leads to higher inflation. And so you get a wage price spiral, but you know, it might as well, in my view, be called a price wage spiral, because I think very often wages react to prices and not always the other way around. So you got to differentiate between these one-off price pushes. You know, our price is rising at the moment, you bet. If you look at the US core PCE or headline PCE, you just look at the level, it dipped a little bit at the beginning of the crisis, but now it is rising much more above the trend than it undershot the trend right at the beginning of this crisis. So, yeah, that everything is becoming more expensive. There's this in the US, they talk about a reopening premium, is not solid evidence that we're in a high inflation regime.
All right, Klaus, always great to catch up. Thank you so much, Klaus Badr, the Société Générale Global Chief Economist. Now, coming up, plenty more from the Qatar Economic Forum. We'll hear from our interview with the Barclays Chief Executive, Jess Daly, about the return to work, and also from BlackRock's Larry Fink about the prospect of a digital dollar. This is Bloomberg.
G7 today need to wake up and listen to the science. There isn't room for discussion on this. Scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated! The world is possible!
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Let's get straight to the Bloomberg. First with news. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. China is suing Australia, the World Trade Organization, over anti-dumping measures on some Chinese goods, further ratcheting up tensions between the two nations. The measures target Chinese products, including wind towers and stainless steel sinks. Earlier this week, Australia said it would appeal duties imposed by China on its wine exports. Now, women are more likely to develop persistent symptoms after a coronavirus infection, according to a study of 500,000 adults by Imperial College London. Overall, about 1 in 3 people reported at least one symptom lasting 12 weeks or more, with the likelihood increasing with age. Now, sources say the US is set to ban some solar products made in China's Xinjiang region over suspected human rights abuses. The move, which is expected later today, would mark the Biden administration's biggest action yet against Beijing's alleged crackdown on the Uyghur Muslim minority. Xinjiang produces roughly half of the world's polysilicon, a key material for solar panels and semiconductors. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Now, coming up, Londoners are snapping up luxury homes as lockdown measures keep wealthy foreign buyers away. We speak to Nicola Barattieri, the chief executive of Northacre, a property company that develops luxury apartments in London. That's coming up next, and this is Bloomberg.
Bloomberg Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Sooner rather than later, the Fed's Raphael Bostic and Robert Kaplan say the Fed could start tightening by the end of 22, and there's plenty more commentary from Fed speakers today. The hawk takes flight. The Bank of England's chief economist, Andy Haldane, is likely to use his last meeting as an MPC member to push for a reduction in asset purchases. And JP Morgan warns that it may require employees to get COVID-19 vaccines as big banks push to get staff back to work. We'll hear from our discussion with the Barclays' Jess Daly and much more from the Qatar Economic Forum. So good morning, everyone. I'm Francine Lacqua here in London, and welcome to Bloomberg Surveillance Early Edition on Thursday, the 24th of June. JP Morgan says it may require employees to get vaccinated as it ramps up its plan to get staff back into the office. This follows decisions by Morgan Stanley and BlackRock to bar workers from the office unless they've received a shot against COVID-19. Now, I spoke yesterday with the Barclays chief executive, Jess Daly, about his plans to getting employees back to work. He said that while the bank will facilitate flexible working, there's no replacement for face-to-face discussions.
Today, I'm sitting in the office, and we have an executive committee meeting right after my call with you. And pretty much everyone's going to be in and sitting around a table, which I think is a very important dynamic. So one of the things that's interesting, we went back and looked at what were our employees actually doing pre-pandemic. And I think businesses were already moving down the pathway to having flexible work hours. And it's very important that we let a single parent leave on a Tuesday afternoon at 2 o'clock to take a son or daughter to a doctor or to a sporting event. That flexible working, I think, was already building up prior to the pandemic, and obviously the pandemic has accelerated a lot. So I think people will be flexible. I would be surprised if most people are in more than 4 days a week. But one of the challenges of the technology era is you can look at your iPhone at 10:30 at night and start texting away. So I think technology has actually increased the working hours, although maybe less so in the office.
Would you ever just consider actually selling some of your real estate, like office buildings, because of the way we work post-pandemic?
I think there will be, a rationalization of our real estate footprint. But I would say it's more normal course. So no, we don't have plans to close full offices and tell people to work from home. No, we want people to come into the office.
What's your take on the City of London 6 months after Brexit?
I think the City of London has done a remarkable job. I think I think the banks have, again, been very constructive. I think it has increased the dialogue with government in a very positive way. And I, go back, you can walk on a trading floor of the investment bank, but what I find the most energizing is to go to the local branch where I live in London and to see the dedication of the people behind the counters and engaging with walk-in customers day in and day out. And they've been magnificent. And banks have not closed. They stayed open. And they've done their service to the communities where we live. And so I'm pretty encouraged by where London is, and London will be fine.
That was part of my conversation with the Barclays Chief Executive, Jess Staley, as part of the Qatar Economic Forum. Now, London's luxury housing market is largely relying on locals as lockdown measures keep wealthy foreign buyers away. Sellers of the priciest properties had been looking forward to the summer after Prime Minister Boris Johnson chose June 21st as a likely day that COVID restrictions would be lifted. But then the government delayed the easing by at least a month. According to data from Lunres, homes in the wealthiest areas of London are selling at the fastest rate in 7 years, but that's not translating into higher prices. Well, Northacre is a property company that develops luxury apartments in London. Nicolò Barattieri, Northacre Chief Executive, now joins us. Nicolò, as always, thank you so much for giving us a little bit of your time. And I like our regular catch-ups just to have an idea of what the luxury property market in London does. So we were thinking it was getting better with foreign buyers coming in. When are you expecting them to come back? And what's the situation like at the moment?
I think we'll have to ask Boris of when they're coming back, to tell you the truth. I really don't know in the short term, but we're expecting them hopefully in the fourth quarter of this year. I think what you're seeing in that, as you know, and as we've spoken in the past, the high-end space is characterized by having a strong interest from foreign buyers who at the moment are not able to come in. What we're seeing is that local buyers are stepping in, and as Lunres is saying, prices are not translating in an upward trend, even though there's activity, and that's because local buyers are more price sensitive than the international ones.
So what are the kind of expectations around the end of the stamp duty? Does that make a difference at all at those price levels?
Not really. I mean, in the high-end space, the end to the stamp duty holiday that's going to happen imminently is going to make no difference. It will help. It has helped quite dramatically in zones, 2, 3, and 4, and 5 in central London. In fact, you've seen pricing up between 5 and 7% in those areas in the last 12 months. But in central London, zone 1, pricing is actually down 2% during the last 12 months. So no, it doesn't make a difference to our buyers.
Nicolò, what about inquiries or also sales to people coming from Hong Kong?
We've spoken in the past that there has been strong interest from Hong Kong, from China, from Asia in general in the last 3 or 4 years. So even though the market was difficult, they were really the big buyers and the supporters in this market. They have gone quiet now purely for the inability to come and actually see the homes that they want to buy. So we are bullish in the medium to long term purely because, homes are at the forefront of people's expectations at the moment and their luxury purchases. But at the moment, until they can come, I think it's going to be quiet also on the inquiries front, especially from Asia.
And Nicolò, overall, for the luxury property market in London, do you see it, has it bottomed out? Can it only get better from what we saw last year?
Well, look, I think we've had 7 difficult years, right? The market peaked in June 2014, and since then you've had a price correction of around 20%, depending in what area. There are a couple of takeaways that I think that are important. The first is that, in these 7 years, you've had 3 prime ministers, you've had Brexit, you've had COVID, you've had the changes in stamp duty that have doubled the stamp duty level at this price point. So a lot has been thrown to the market, and actually this market has been very resilient if you take into consideration all these things. Having said that, you're in an environment where you have low rates, you've got fiscal stimulus, you've got lockdown savings, you've got limited housing stock, and you've got the fact that actually after this pandemic, people are looking at their houses as something that is much more important than it was before. So yes, we are bullish going forward. Lastly, what people also have to understand is that construction costs have gone up quite considerably. You have shortages of labor and materials, and you have borrowing costs that even though rates have come down in the last 7 years, for developers, borrowing cost has actually gone up. So new units that will be coming to the market will not be cheaper than they are now.
Nicolò, your longer-term forecast, so there's a couple of surveys out there saying that if we look at the prices that we had for London prices in 2014 from the prime market, that we could reach again those levels in 5 years. Because of Brexit, because of other influences, how likely is that?
Well, look, you're talking of having growth of about 4% a year. Going forward, I think it's very possible. The market at this level is very finite. If you think that over £5 million there were transaction. There were only 300 transactions last year in central London. So, it doesn't take much to move the needle quite considerably. In 2014, that number was around 650. So all it takes is a couple hundred more buyers to come into the market, and you'll see prices moving quite quickly. So yes, I think it's very possible.
And Nicolas, when things reopen, where do you have inquiries again from buyers from a certain part of the region? Where do you expect the bulk of sales to come from regionally?
I think that Asia will dominate the market. I think the Chinese have been very active even in the last 7 years, and actually they in a certain way have graduated from buying in zones 5 and 4 and so on, and they've moved into zone 1. And you've seen that they've made quite a bit of difference. They are the vast majority of the market, especially in the last couple of years.
Nicolas, as always, thank you so much for joining us. Nicolas Barattieri there, the Northacre Chief Executive Officer. Now, coming up, the U.S. is set to ban some solar products made in the Xinjiang region. It marks the nation's biggest step to counter alleged human rights abuses in China. We'll have the full story shortly. This is Bloomberg.
作为我的个人目标，可能接下来会继续锻炼身体，会尝试去做7+2，再次感谢曾经给我力量、给我能量的艾瑞克。
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Siemens has raised its financial targets and announced its first share buyback since 2015. The German industrial giant will buy back as much as 3 billion euros of stock over a 5-year period starting from next year. That is as the company's new chief executive pivots towards software to boost shareholder returns. Now, sources say Bullish, a cryptocurrency exchange backed by a group of billionaires, including Peter Thiel, is in SPAC merger talks with a Farpeak acquisition. The deal could value Bullish at nearly $12 billion, with an agreement possible in just the next few weeks. The final valuation could change depending on the price of Bitcoin. The world's biggest maker of Bitcoin's mining rigs is suspending sales of machines for spot delivery globally to prop up prices. Bitmain Technologies says it has stopped selling new equipment after top-tier rig prices plunged by about 75% since April. China's crackdown on crypto mining is causing more and more miners to abandon their operations and dump machines on the market. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, the U.S. is poised to bar some solar products made in China's Xinjiang region after allegations of forced labor. The move marks one of the Biden administration's biggest steps yet to counter alleged human rights abuses against the country's Uyghur minority. Now, joining us now is Bloomberg's chief Asia economics correspondent, Enda Curran. So, Enda, first of all, this feels very significant. Were we expecting it?
Well, look, it's another hawkish step by the US administration. Francine, Xinjiang is the source of around half of the world's polysilicon. It's an important input into semiconductors and solar panels. So the thinking is that this move is bound to have a spillover effect, not just in the terms of China-US political relations, but also in the industrial side of things. So there might be some reshuffling of supply chains as companies look to source their solar products from elsewhere. Now, we've already had a rebuttal from the Chinese Foreign Ministry this afternoon in Beijing. They pushed back against this measure. They condemned it. And of course, we know that China consistently considers Xinjiang to be its own internal red lines, and it criticizes other countries for interfering. But as you said at the start, it is a push by the US against China on the allegations of human rights abuses and forced labor in Xinjiang. And it does kind of continue the narrative that we left off with the Trump administration and the kind of hawkish moves that we were seeing during that presidency too.
So, Enda, what does it actually tell us about the wider US-China relations?
Well, I think we'll have to see the details of the policy when it's formally announced, of course. But it does speak to the idea that President Biden is continuing to pursue something of a hawkish approach. We don't have the full specifics or the contours of his China policy just yet. I mean, we've had some courtesy calls between the officials. We've had that meeting in Alaska, of course. We don't yet quite know, though, the full parameters of the Biden-China policy. We do know that he went to the G7 a few weeks ago, and he did try to push a hawkish line there against China with some success. We saw some pushback from Europe, but nonetheless, President Biden does seem to be shoring up some alliances when it comes to the US-China story. So I think at the very least today, while some people will say this move was more modest perhaps than some hawks are pushing for, you'd have to say President Biden continues to pursue a hawkish approach when it comes to China, even if the mood music has changed a little bit from what he inherited from the last administration.
Thank you so much, Bloomberg's chief Asia economics correspondent there, Enda Curran. Now, Larry Fink says cryptos are not important, but he acknowledges that the digital assets inspire young investors. Up next, we discuss the BlackRock chief executive interview with our very own Eddie van der Walt. This is Bloomberg.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's talk Bitcoin. And the cryptocurrency has been touted as a possible inflation hedge. Institutional investors are increasingly turning away from it. Among them, BlackRock Chairman and Chief Executive Larry Fink, who spoke with us at the Qatar Economic Forum, powered by Bloomberg.
Long-term investors are very unfocused on the tick-tock of the market, the tick-tock of the ups and downs of crypto. I think it's fascinating to watch crypto because it's inspiring a lot of young investors. I think that's fantastic. I think if that inspiration leads to long-term investing, that is a great outcome. But with our focus on long-term investing, and with 2/3 of the assets we manage are for pension funds, the conversation about crypto is a minor percent of any dialogue we have with any company worldwide. It's just not terribly important. Could crypto become a really important asset class one day? Sure. But right now, the bid-ask spread, the volatility, it has not led to widespread conversations worldwide. Where conversations I have with governments and leaders is about, should there be a digital currency, true digital governmental currency? That will change finance in a very substantial way. If there was a digital dollar, a true digital yuan, that will change however, that would be much more impactful than any other, like a crypto. But it's something that we look at, some of our investors use as one tool for investing. But it is really about the tick-tock of the market, and that's what public media does. You focus on the moment, the markets, and the ups and downs. BlackRock is focused on the long-term, building long-term portfolios as a fiduciary for our clients. And if we deem crypto or any asset in the world is a great long-term asset on behalf of pensioners worldwide or people building pension funds, then it'll be one of the tools for asset composition. But the tick-tock of the market, the ups and downs of what's going on in any one individual stock or a crypto, it's really unimportant.
Well, that was the BlackRock Chair and Chief Executive Larry Fink speaking at the Qatar Economic Forum. Now, joining us now to discuss crypto and the markets at large, as ever, is the Markets Live, Eddie van der Veld. Eddie, always great to catch up. So we've had a wild ride. I ask you and tell you this every week in crypto. What's the next level?
It's a fantastic asset class to watch, isn't it? I mean, because the upside is spectacular and the downside is equally as spectacular. So, look, I hear what Larry says there, and he makes a good point. When you talk to, I'm sure when you talk to big pension funds, as he does, the conversation, Bitcoin will not be the focus of the conversation. But those in the crypto community will tell you, look, that means there's opportunity for growth. That means there's a lot more people that haven't invested in it yet. And this asset class probably isn't right for, the majority of investors just yet at this point. But it's becoming more regulated. It's growing up little by little, and it's going through all of those. We've seen kids in their teenage years. They're turbulent, and I think this is where Bitcoin is now. Bitcoin's in the teenage years, but at some point it's gonna hit the big time, and we're still heading that way.
I love this analogy, Eddie. So, what is Bitcoin going to be when it grows up? Is it what crypto is going to be? Is it Ethereum or Bitcoin?
Yeah, that's a really good question. I think it's a little bit of both. I think for the moment, Bitcoin pulls in the money into the space, and then that money is used by, it also flows to Ethereum and some of the other smaller coins, which then uses it for the, DeFi purposes. In other words, ways of decentralizing finance, of creating new ways of settling contracts and so on. But I think Bitcoin is important for putting money in. And I think Bitcoin has a shot of, in the long term, becoming something like gold. That doesn't mean gold is Bitcoin is gold right now. It means that it is a speculative play on an asset that may someday become a store of wealth. But we're not there yet. Right now, it's very much a risk-on trade.
Eddie, what's your take on inflation? So we heard from the Fed. I mean, are we going to see a repricing of assets yet again, or was it already priced in?
Yeah, look, the pivot at the Fed is just, it's really going a little bit more hawkish, isn't it? We've got Bostic, Bullard, and there's a number of voices that are just starting to grow more hawkish, saying that, listen, we want to see a rate hike as soon as next year, never mind the slowing of asset purchases. So I think the Fed is catching up with the market a little bit, because the market's been talking, has been saying that inflation is not quite as transitory as the Fed has expected for a number of months now. So the Fed's catching up. But, I think here in the UK, the Bank of England's still very much behind the curve, and the ECB even further.
Yeah, what are you watching out for? I mean, the Bank of England, it'll be interesting to see, how the lone hawk votes for the last time, Eddie, but how much more difficult actually is it for the Bank of England, given it's a small, economy, closed economy compared to the US?
Yeah, and the UK is in a different place to the US. Reopening has been delayed again. Furlough scheme is still continuing. We don't really have the answers of where the economy is heading now. And we're losing, in the next few meetings, two of the hawks at the, or perceived hawks anyway, at the Bank of England. So I think the conversation is at a different place for the Bank of England. I don't know that the Bank of England is behind the curve in terms of, where the market wants it to be. But it will definitely be interesting to see, what we hear from the Bank of England, and particularly after Andy Haldane goes.
Thank you so much, Eddie van der Walt there from Markets Live. He'll be staying with Early Edition. Stay tuned. We'll continue in the next hour. Matt Miller joins me out of Berlin. Danny Berger here with me in London. This is Bloomberg.
Morning was a bit of a historic day. It was the first time Indigenous designers showcased at Australian Fashion Week, and it was a full house of all Indigenous talent.
It made me so proud. Absolutely beautifully done. I mean, the designers, the pieces on there, I think just about every model or every second model was like, oh, I want that, I want that. So each of my pieces, we have our signature prints, which are each tell a story and is definitely a contemporary way of experiencing Aboriginal culture. And then each of my pieces are named after, inspiring Aboriginal and Torres Strait Islander women. So when the customer buys something, they're learning about the story, they're learning about women. I would hope that it isn't tokenistic, and I would hope that it's not done to tick a box. And so, those things you have to be mindful about that. But I think it's incredible what's been achieved so far. But there's always room for growth. I think the elevation of Aboriginal and Torres Strait Islander people in these spaces, it's long overdue, and it's a really powerful and incredible time, I think, and to be a part of that is really special.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now,
You can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
The U.S. economy is really on fire. Almost everything is growing much faster than almost anyone anticipated.
The conversation about crypto is a minor percent of any dialogue we have with any company worldwide. It's just not terribly important.
We don't have plans to close full offices and tell people to work from home. No. We want people to come into the office.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lines.
It's 10 a.m. here in London, 11 a.m. Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, June 24th. Our top stories today. Sooner rather than later, the Fed's Raphael Bostic and Robert Kaplan say the Fed could start tightening by the end of 2022, and there's plenty more commentary from Fed speakers today. JP Morgan warns that it may require employees to get COVID-19 vaccines as big banks push to get staff back to work. We'll hear from Barclays' Jess Staley and much more from the Qatar Economic Forum. And the hawk takes flight. The Bank of England chief economist Andy Haldane is likely to use his last meeting as an MPC member to push for a reduction in asset purchases. Well, welcome to Bloomberg Surveillance, everyone. This is the early edition. I'm Francine Lacqua here in London, Matt Miller in Berlin, Danny Berger with me in London. Keely Lines off today. Matt, I know we're looking a lot at what we heard from Fed officials basically saying that we could have an interest rate rise as early as 2022, but actually we're not seeing a schism in the markets. I wonder whether or how much of it was already priced in.
No schism yet. But we will be watching for one, Francine. We're going to be watching interest rates very closely, going to be watching the inflation versus disinflationary regimes. Do we see a secular shift? We're also looking very closely at who's going back to work. I spoke with Siemens CEO Roland Busch early this morning. He said they're looking for a more flexible solution. So still allowing people to work from home or remotely, as he put it, but also wanting to get people back in the office a few days a week. Let's take a look at what's going on in Asia. Reliance Industries, by the way, is having its shareholder meeting in Asia. They'll talk a lot about work from home as well. They're doing their shareholder meeting, their annual general meeting, virtually for the second time. They used to do it in football stadiums, but obviously the COVID pandemic has been very difficult in India, especially recently. Take a look at what's going on in Asian markets. You see a lot of green on the screen, except for in Southeast Asia, and there you see a lot of red. And the MXAP, the MSCI Asia Pacific Index, isn't doing very well today. If you take a look at the broader market, you see it's up, but only about 0.05%. Look at the South Korean won. It's actually gaining against the dollar. This is a U.S. dollar Korean won, so as the dollar rises against the won, it's falling. As the dollar falls against the won, it's obviously rising. That's why red arrow, but still a green move. And the Turkish lira, I put in there. We think of it a lot of times as European, but I've walked from Europe to Asia and Turkey, so it obviously is spread across both continents. And then you see Reliance right now down 1.25%. Of course, Mukesh Ambani is the richest man in Asia, and he is speaking or has just spoken. You can follow that on our live go, Danny Berger, if you want to watch Mukesh talk. It's very rare that he makes an appearance.
Yeah, but I feel like that move on the lira isn't that exciting. I mean, we've seen crazy stuff happen to that currency, Matt.
Good point.
I mean, not that I want to see more craziness for it. Just saying it could be moving more. When it comes to Europe, though, it is a very positive day. Kind of surprisingly so, considering that we have the concerns around the Delta variant simmering in the background with the EU Commission leaders meeting today. But you have a lot of consumer goods doing really well, so that means you're going to see France, for example, outperform. It's all those luxury companies, the Hermes, the people still buying handbags, I suppose, but underperforming today is definitely the UK. It's only up 0.2%. 0.1%. And apologies to everybody, I have a very UK concentrated start to my board because we have the BOE today. It's really going to be really closely watched.
I can't believe it's Thursday already.
I know. How did we get here? How did we get here? But look, the market's been waiting for this, and it's still waiting for this, Matt. It's still waiting for this decision. So basically not much movement in the pound, not a lot of movement in gilts that have been pushed and pulled around by what's happening at the front end of the U.S. curve. And continuing to stick in London, you have LME copper down 1%. We saw stockpiles rise by 20% for copper. So that supply side of the crunch, perhaps it is over. And we can see copper come back down. Good news if you're watching for inflation. And finally, Credit Suisse got an analyst upgrade today as the new chair comes in saying, hey, they're concentrating on asset management. That's good news. Finally, want to quickly look at what's happening over in the U.S. We're looking at S&P futures higher by 0.5%. Really, we continue to see overnight, we get this bit. Sebastian Gailey from Nordea says it is a market in stasis. We continue to want to buy the dip. We continue to have that FOMO driving things. Bloomberg dollar spot weaker this morning. U.S. 10-year yields, there are still sellers out there. We're at one spot, 49.70 rather. And I just want to put the VIX on here because we are so close to a more than 1 year low. We're at a 15 handle on the VIX. Not a lot of volatility, but besides that, we are seeing a skew index that is near a record. So tail risks are in, tail hedges are in, Francine, despite the fact that what we're seeing in the VIX is just complete calm. Everybody is just so zen right now.
So zen, apart from the NFTs and the meme stocks,
right.
Danny. I mean, those are not zen, and they're not chilled at all. They're like on triple espressos.
Yeah, everyone wants to buy an NFT. There's one that I'm so excited for today. It's the World Wide Web. We'll talk about it later. I'm very excited for it.
I'm creating an NFT for Surveillance Early Edition. It will be ready soon. Danny, there's a lot to watch out for today. At 7 a.m. Eastern Time, we'll get a rate decision from the Bank of England. It's the last meeting for Andy Haldane, the biggest hawk on the MPC. Then lots of U.S. economic data, 8:30 a.m. New York time, including initial jobless claims, as well as personal consumption for May and first quarter GDP. Then more central bank action with a rate decision from Mexico at 2 p.m. Eastern Time. No move expected, but it comes as more Latin American central banks have been signaling the possibility of tighter policy. And after the close on Wall Street today, we'll also get the results of the Fed's stress tests. It could lead to the big banks releasing billions of dollars in buybacks and dividends to investors. Now, there's also a host more, or a lot more, Fed speakers today. That comes after we heard from the Atlanta Fed President, Raphael Bostic, and the Dallas Fed President, Robert Kaplan, yesterday, both with the view that the Fed may actually tighten next year. So let's get into the markets. All of this with our Bloomberg MLive editor, Eddie van der Veld. Eddie, what exactly is the market pricing in right now? I mean, 2022, an interest rate hike is pretty significant.
Yeah, I think so. And look, if we do get there, that would be a very positive sign for the global economy, just to see, that the economy is ready, has reopened. But I think there's a lot of COVID fatigue, and people just want to get on with their lives at this point. And if that means people go out and they spend money and they push up inflation a little bit, so much the better. And that would be, I think it would be a very positive thing if they manage to do that. But there's still a lot of water to get under the bridge before we get to next year and those rate hikes.
Eddie, just quickly on Bitcoin, I know you're watching closely the cryptos, and we saw that bounce back to 33,000. What are you expecting as we go forward here?
That was a bit of a surprise, wasn't it, Matt? I mean, Bitcoin had been testing that 30,000 level for a number of weeks, and it felt like if it breaks through there, that we could see a significant pullback to sort of the mid 20,000s. But it didn't happen, and the buyers stepped in. So I don't know. I don't know that the tests at the downside, are done. But even so, this won't signify the end of crypto. Crypto keeps bouncing back from the lows. I think you and I have talked about this rubber bubble before, and I think this is something that's true in crypto. When we see those big pullbacks, a lot of people see that as a consolidation phase for the next run up.
Eddie, I don't know how you can keep so calm watching Bitcoin all the time. I mean, I feel like it's always a roller coaster ride. Eddie, thank you so much. Bloomberg MLive's Eddie van der Walt. Let's go on to what's happening over at JP Morgan, because it says that it might require employees to be vaccinated. It's, of course, Wall Street preparing to return to the office. Joining us now is Tom Metcalf, Bloomberg UK's finance team leader. Tom, does this seem to be the way that banks are leaning towards in terms of requiring employees to have a vaccine?
Yes, I think that's fair. You've obviously had JP Morgan send out this memo on Wednesday, basically mandating employees to fill out a questionnaire on their vaccination status. And before that, you've had Morgan Stanley effectively doing something similar. Other companies, I think BlackRock, are also in this boat. So it does seem to be the direction of travel, and of course it sort of varies by company and also by region. But it does seem to be that as banks try and get folk back, they're going to sort of be chasing this information, and you probably maybe have a two-step process for unvaccinated employees. They may take longer to be brought back into the office.
Tom, Francine has been super psyched about bank stress tests all week long. All of a sudden today, I don't think she's that into it. But I'm looking at, $160 billion of dividend increases and stock buybacks that could be unleashed by these decisions. What are we expecting?
Yeah, this is the big news in finance today. To be honest, I think there won't be too many surprises. The banks seem to be doing well. There's no kind of huge shocks in the horizon. I suspect there'll be, probably cautious statements. But, I think, maybe the great unlocking is about to begin.
Tom, thank you so much, Tom Metcalf there. Could I just say, on the surveillance NFT, actually for early edition, I have the first bid, guys. I have someone coming in, remains anonymous, for $500, the first bid. So this is really, we're branching out, merchandising for surveillance.
Do we tie ownership of surveillance to that non-fungible token?
I'm sure, if the price is right? Work on that?
Am I allowed to bid on this? I know I, kind of come on now and then. Is it like a conflict of interest if I bid on?
We're selling it.
No, I want to own it though. What if I want to own it? All right, well, let's go ahead and check in some of the pre-market
Tom
movers.
Keene on this.
Yeah.
Definitely not.
Co-creator of surveillance. Yeah.
This is for the early edition. I'm sorry, the bid is for the early edition.
Yeah. I don't want to say that that's worth more. Just gonna, leave that one, let that sit. Anyway, looking at Tesla this morning, it is up 3% pre-market. Really interesting to look at the move of Tesla in context with the U.S. ban on some solar panels coming out of China. Tesla, of course, highly involved in this space. Is it the solar ban, or is it an Elon Musk tweet? Elon Musk tweeting about the Starlink IPO, that Tesla shareholders will probably get priority on that. So that could be moving it as well. Now, moving on, I also want to talk about some of the meme stocks this morning. We have Torchlight that is moving higher by 3%. They got hammered over the last two trading sessions, losing half of its value earlier this week. So it's coming back from that. It had offered up some new shares, so a slight bid there as well. Finally, Rite Aid, they have earnings later on today. Rite Aid has a very high short interest to it, about 15%. The implied volatility on Rite Aid as well is really high. That's about 15% of a move that we're expecting to see. So shares moving higher ahead of that, up more than 7%. Maybe some of these short sellers out there think that they could get washed out of the market, that, you really can't continue this gain, you really can't continue any losses considering how high the shorts are. So, Francine, that might be part of the reason why that this is moving higher this morning. But, of course, we'll just have to see what happens with those earnings later.
Danny, so much to look at today. Coming up next, Peter Oppenheimer. He is Goldman Sachs Chief Global Equity Strategist. We'll talk inflation, we'll talk stocks, we'll talk diversity as well. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua and Danny Berger in London. Kaylee Lines is off. And I'm looking at a chart that shows the differences in valuations between groups of bank stocks regionally. Peter Oppenheimer is our next guest. We're going to talk to him briefly, but he has a great note out saying that you may see a change in leadership in terms of value and growth, but also a split regionally as value and growth kind of meld together. We have seen a real outperformance of U.S. bank stocks. For our listeners on radio, I'll tell you, U.S. bank stocks is represented here by a white line, and it's just taken off as a percentage. U.S. bank stocks is represented here by a white line, and it's just taken off as a percentage of book value right now at 137%, whereas FTSE 350 Banks Index and the Eurostoxx Banks Index, they're both floating around 61, 62, 63% of their book value, so still way below book value. And my question to Peter, Chief Global Equity Strategist at Goldman Sachs, who joins us now, is do these European banks start to catch up now as we recover from the pandemic and people start looking at underperformers regionally?
Yes, hello, Matt. Good to be here. I think the European banks are quite a compelling value case. Now, of course, they've been cheap for a very long time, and many people saw them as being really uninvestable in much of the decade after the financial crisis. They had to raise more capital, moves to negative interest rates, crushed their margins, and then the pandemic hit and you saw provisions for loan losses. But now they're becoming much more cash generative. They have had a strong bounce from the lows, as many people have moved into more cyclical and value parts of the market. But from a valuation perspective, there's still a big catch up to make up for the shortfall with US banks. Now, the conditions are not exactly the same. The US economy is recovering more quickly, although Europe is catching up on that basis. But also the shift in interest rate expectations in the US, which you were talking about earlier, is helping the US banks in a way that we're not yet seeing really in Europe, given that rate rises are still not really a realistic prospect for some years to come. That being said, we do think that they're becoming cash generative. They're in a position to pay dividends again. They look very cheap. And I think that's one of the areas that we would be overweight in the European market.
Peter, I know in your note you also talk about the clear distinction between growth and value likely to fade. What does that give way to?
I think more of an eclectic mix, frankly. We need to look at this in context. If you look at the cycle that followed the financial crisis, for at least 10 years, we saw a very bifurcated market environment in which things became very factor-driven. Growth strongly outperformed value in every region. And of course, partly reflecting that, the US equity market massively outperformed other equity markets as well because it had much more exposure to growth. Now, why this happened had a lot to do with ever lower bond yields, and that pushed up the relative valuation of long duration assets. It was also a very growth weak cycle, particularly outside of the US, given the many problems that followed the financial crisis, the sovereign debt crisis, collapses in commodity markets and so on. So growth was quite scarce. But then we also had the tremendous outperformance of technology companies and their earnings. And I don't think we're going to see such a bifurcated market now. Sorry.
Right. So what does it mean where you see the best value from now on?
So here we see a mixture between deep value areas of the market. Banks we were just describing would be one. Commodities, energy, mining would be another similar area where we think there's strong cash flow being generated and some good valuations. Right. But also some of the more defensive growth parts of the market are starting to look quite attractive. They were hit as you got the longer duration stocks selling off a bit in recent months with rising inflation expectations. So we think it's going to be a bit more of a mix. And I think also from a geographical perspective, much more of a mix in performance rather than such a clear outperformance of the US.
So with that, if you don't have this clear growth versus value, you have some other things in there. Does that mean it's a stock picker's market now, Peter?
Yeah, very much so. We sort of think about a kind of framework, really, where most cycles are defined by different phases of development. Now, the initial recovery from a bear market, what we call the hope phase, is nearly always driven by very sharp rises in equity prices and valuations as investors start to price a recovery. That nearly always is led by cyclical and value stocks. But as you go into the next phase, the growth phase, where the actual growth comes through, you tend to get lower returns in general and a much more mixed return across sectors and factors. And it becomes really the area of alpha opportunity. And that would be really our call, that we're going into a period now where there's less beta opportunities, less steep rises in equities more broadly, less clear distinction between factors and sectors, but a much better opportunity set for alpha and stock picking.
Peter, thank you. Peter Oppenheimer there, as ever, with some wisdom on global equities, Chief Global Equity Strategist at Goldman Sachs. Now, coming up later, an exclusive conversation with the former New York Fed president and Bloomberg opinion columnist, Bill Dudley. That's at 7:30 a.m. in New York, and this is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Danny Berger in London, Matt Miller in Berlin. Kaylee Lyons is off. Now let's get straight to the Bloomberg First World News. And John McAfee has been found dead in a Spanish prison cell shortly after it was announced that he would be extradited to the U.S. to face charges of financial crimes. The creator of the McAfee antivirus software had been jailed in Spain since October on U.S. tax evasion charges. Now, Spanish newspaper La Vanguardia reported that he appeared to have taken his own life. News from Singapore in the last few minutes. The country is planning the first COVID vaccine shot for most people by the end of July. Singapore will also offer the vaccine to anyone older than 12 from July the 2nd. And President Biden has ousted the regulator of mortgage companies, Fannie Mae and Freddie Mac, replacing a Trump administration appointee. The move follows a ruling by the U.S. Supreme Court, which rejected a core part of a lawsuit brought by investors in the companies. Shares in Fannie and Freddie each plunged the most in intraday trading since 2013. So there is, of course, quite a lot going on in the financial space, and this was just one of the one things that actually we'll see a change under the Biden administration.
Yes.
Yeah,
many
definitely.
things will probably change.
Yeah, and of course, the lingering question, the Biden administration, is what happens with infrastructure. Is it smaller than we originally planned for as well?
Yeah, the big one to watch a little bit later as well. Coming up, the BOE decides. We'll speak to Simon Wells, HSBC Chief European Economist. This is Bloomberg.
excluded from the workplace, especially when you've got skills and motivation and things to give, can have a really detrimental effect on people's well-being. They can become isolated, of course have the financial stress of not being able to support themselves. That might be their first entry into the broader community where you're building relationships with workmates, and so that's your exposure to culture and you're starting to feel like you belong.
Some people might need to practice their English more, they might just need just some practical experience in an Australian kitchen.
I have not from Australian friend.
now back in the kitchen. I have many friends.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Danny Berger in London, Matt Miller in Berlin. Kailey Lyons is off. Matt, I don't know whether you want to talk about the stress test, the Bank of England inflation, or whether actually we just go rogue and talk about JP Morgan warning employees that they may need to be vaccinated to come back into the office.
You know, this was going to be my what to watch. So now I'm probably going to have to change it. But I think it's fascinating,
We can watch it twice.
Well, exactly. I think you might see more and more companies start to come out and require vaccinations. And then, of course, you're going to see pushback from people who feel that impedes on their freedom somehow, and then they're going to want to not get vaccinated. So this is why I'm sure someone like Jamie Dimon is going to try and be very delicate about it.
Yeah, I don't know how delicate he has been in the past, actually, through closed quarters. So we'll see exactly if this is a trend amongst major banks, whether some of the chief executives will feel emboldened to be tougher on their staff. Danny, what's playing out in the markets?
Well, I keep coming back to this idea from Sebastian Gailey of Nordea that it's a market in stasis. I really love that phrase because we continue to see resiliency after some of the turmoil of the past week of people wanting to go in and buy. Both Stock 600 and U.S. futures up higher today, 0.7% and 0.5% respectively. We keep seeing that FOMO, that buy the dip, that what happened yesterday we reverse today. But we are seeing copper head lower by more than 1% today. LME copper, we've seen stockpiles rise. Of course, China about to release its vast reserves of metal, selling into the market, pushing that price down, trying to control inflation. And in that context, what's happening in oil is fascinating. Prince Abdulaziz overnight saying that OPEC has a role to play in taming inflation. We're still seeing, though, the global benchmark Brent hold above $75 a barrel. It's been really steady despite some of the commodities falling. I also want to get into some of our pre-market movers as well. So Forest Road acquisition, it's a SPAC. Some Disney executives, Shaquille O'Neal is also involved in this one as well. And Matt, you're going to kill me for this because Shaq's back, but I feel like you're going to hate what I'm about to say. It's a three-way merger. They're buying, well, it's merging with Beachbody and but what else do I call it? There's three of them. It's a SPAC. Does merger not work in this circumstance?
I feel like, you know what, there may be in some sort of, in a Harry Potter book, merger would work. But in real life, there's a buyer and there's a seller of an asset.
But
now,
there's three of them.
I need to visualize the three-way to understand it, but usually it's an acquisition.
Okay. Well, I'll try to figure out who's acquiring who's not merging. Anyway, so that's one SPAC. Another SPAC that's gotten a lot of attention as of late is Clover, up more than 5% pre-market. This one's really fascinating because we had Barry Sterlich, the property billionaire, yesterday in the Qatar Economic Forum saying, Clover is an example of SPACs gone awry. It's crazy that this thing has gained so much. And anytime anyone talks down about it, it rallies. Well, that's literally exactly what happened. He spoke ill of it, and it's rallying so far pre-market. Finally, Sprinkler, an IPO, it's social media management software. It had a downsized IPO, but I think because of that, it got a lot of interest once it finally listed. So shares up 8%, Matt.
All right, you know what? My man Curtis has put together a pretty sweet chart for me. Dan Curtis, of course, my charts producer out of New York City. I love his cynicism. I share in it too. Radio listeners, I'll walk you through. Welcome, by the way, on London DAB digital. What this shows us is the 10-year yield and S&P 500 futures pre and post Fed meeting. Now, of course, it's been over a week, but the point of this is we had some real movement, the 10-year yield jumping and then diving, S&P futures falling and then recovering, and now a week and 1 day later, apparently, I just learned it's Thursday, are right back where we started from, although we do see S&P futures starting to move a little bit higher. I just think it's interesting that all of this, it's much ado about nothing, to quote, I'm going to guess, William Shakespeare. I actually don't know who that is. Not a really literary person. But Francine, maybe you can help me out. With Avon upon Stratford, where's William Shakespeare? Is that Much Ado About Nothing? Is that him?
It is him. Good job. Actually, when you come to London, I'm going to bring you to the Globe, and the Globe is like the house of Shakespeare. You can actually look at productions by candlelight. I know for a very romantic Matt Miller, that will be perfection. Now, the Bank of England is set to announce its policy. There you go. And the team. Its policy decision today against a backdrop of rising inflation, a growing global debate on the path for monetary policy, and a slowly reopening UK economy. Well, joining us now, Simon Wells, Chief European Economist at HSBC. Simon, I mean, what we're expecting is for the lone hawk, Andy Haldane, as his last MPC, to kind of go out and say, like, we should do it differently. How much attention will that grab?
Well, I think Andy's vote won't grab that much attention in the sense that we probably know what he's going to do. The bigger question, of course, is whether anyone else is going to follow him, given that it is his last meeting. And if you look at the news since the previous Bank of England meeting, it's all pretty positive, really. PMIs very strong. They fell back a touch yesterday, but still at high levels. You've got these pockets of tightness emerging in the labour market. Firms being forced to bid up for labour, permanent jobs.
Is it just me, or are we losing Simon there?
About 1.5.
No. Losing Simon.
Simon, we're kind of losing you. You're breaking up a little bit, and so I'll try and fill some time while our techs work on your connection. You know, we were in the danger zone, I felt like, for a moment. Andy Haldane first brought it up, and then we got that Deutsche Bank note from Peter Hooper and David Folkerts-Landau, and Mohammed El-Arian wrote a column for the FT about it, and then a piece for Bloomberg Opinion. And then the Fed, Jay Powell, kind of opened up a little bit of optionality at the last meeting. Maybe a hawkish turn, but basically spreading himself between the outcome-based framework and a little bit of a forecast in terms of what's going to happen in the labor market. And I wonder if that's made it less dangerous now.
Less dangerous. You know, Matt, something that really caught my attention is, okay, so it's very clear that the BOE will continue to be sanguine about inflation. So they have a very similar pattern to the Fed, but it's a very different economy. It's small, it's open, it's an island. And you wonder whether there's a first mover disadvantage or advantage, right? So if you're the first one to talk about tightening, does it mean that actually, it changes your reserves, Danny? And it kind of does go back to the matter of what kind of currency level you need, depending on how you export and import.
Right, but historically, it has been the Fed that moves before the BOE. I mean, that's kind of what the market is accustomed to. So it's no surprise that when the Fed makes more hawkish statements, that you see yields and likewise pound really move according to how those U.S. assets are behaving. But we've known that some of the emerging markets, for example, went ahead and moved before the Fed. So does the BOE follow that? Of course, as we've been saying, estimates and projections are for them not to, that they're going to stay put. And Matt, I mean, part of what goes into here has to be about what's happening in the Delta variant as well.
Yeah, the balancing act. I love the balancing. I mean, it's a nightmare for central banks at the moment. Maybe it is also for some money managers. Simon Wells, I think we have you back.
Adventure.
Re-established connection. I mean, is this an adventure for central banks, Simon, or is it just a very difficult balancing act?
Well, it's an old school connection. I kind of missed the middle discussion there. I mean, yes, central banks are facing a balancing act. But the fact is, for such as the Bank of England, that you're really not going to know how much some of the labour market tightness we're seeing now is going to last once support and job retention scheme is is rowed back. And that's not going to be until you get data for September, which isn't going to be a few months until after that. But you've got to act now. Different central banks are taking different paths here, of course, depending on their mandates and depending on their priorities. But for the Bank of England, it's not an average inflation targeter. It's using a forecast to target. It cannot afford to ignore some of the signals that it's seeing. So I think today it's probably going to have to come out and point to a few more upside risks from inflation, even if, as I was saying before, got cut off. Perhaps no one's going to join Andy in voting for a reduction of QE just yet.
Simon, I do want to go back to a point you started to make when we started to get a little bit of a dodgy connection, and that's the departure of Andy Haldane. You, of course, spent most of your career at the BOE. We've talked about what it means generally for policy with him exiting, but what does it mean for the bank as a whole? I mean, I'm sure you've run into him a time or two.
Yeah, I worked with him for a long time. Look, this is very much a change for the bank. It's an important point for the bank. It's an important point for Andrew Bailey because, of course, this is the appointment he makes. The other MPC appointments are made by the Treasury. So this is an opportunity for Andrew Bailey really to put his stamp on the bank, decide where he wants to take policy. And he's been around an awfully long time. And, of course, that chief economist really does act as a thought leader for all of the monetary economists in the bank. So it's a key moment. We don't know who it's going to be yet. We had the announcement the other day of the external member. But having been such a vocal hawk, it clearly does change the makeup of the committee slightly.
Simon, thanks so much. Simon Wells there, Chief European Economist at HSBC. Now, coming up, concern about bad loans is diminishing. That's the view from the Barclays Chief Executive, Jes Staley. More from our interview next. This is Bloomberg.
Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
We had a record first quarter. The strategy of balancing a wholesale bank or an investment bank with a consumer business anchored primarily in the UK and the US, I think paid off last year. I think it paid off quite strongly in the first quarter. There's been a softening of market volatility, but publicly available information in terms of our business, whether it's advisory or equity capital markets, has been quite robust recently. We continue to be encouraged about the balance, the balance of our business model. And as we come out of this recovery, and companies are doing better and small businesses are doing better, I think the concern around impairment will come down quite a bit. We have a very large impairment reserve. We were very conservative last year in terms of taking impairment charges. And given what we see right now with the economy, that gives us a lot of cushion.
Part of our conversation there with the Barclays Chief Executive, Jes Staley, as part of the Qatar Economic Forum. Now, the U.S. is set to ban some solar products made in China's Xinjiang region. This marks one of the Biden administration's biggest steps to counter China's alleged human rights abuses. Well, joining us now is Bloomberg's Enda Kern. Enda, how much was this flagged? Is this really the Biden administration cracking down on China, or was this always going to be the case?
Well, I think there are two angles to it, Francine. There is the political angle. It's a clear push by the US now against China in terms of criticizing China for human rights abuses and allegations of forced labor in Xinjiang. There's the economic side of course, which is that that part of China is actually home to around half of the world's source of polysilicon, and that's a key input for semiconductors and solar panels, and that might cause companies to shuffle their supply lines and look for a new source of those solar materials. So there's no doubt on the one side it will definitely stoke tensions between Washington and Beijing. Beijing has already pushed back against it this afternoon. And on the economic side, it might force companies to have a look for new sources for these solar products.
The U.S. is now saying that details of the genetic makeup of some of the earliest COVID victims were removed by the Chinese from an American database. How difficult is this saga of trying to find the sources of the virus in Wuhan?
Look, it's clearly one of the biggest political hotspots between not just China and the US, but indeed China and other governments right now, Matt. And look, it's still early days in the Biden administration, but all the mood music and sense is that he's going to pursue a fairly hawkish attack against China. He's not changing too much from what he inherited from the Trump administration. We saw he went to the G7 this month and he tried to get some kind of an alliance there with Europe, with some results in terms of pursuing that hawkish line against China. And that's why we're seeing now today with this expected news in terms of what they will do over Xinjiang and the allegations of forced labor there. And to your point, the ongoing pursuit over the source of the virus, all of these are hot button issues. None of them are going to go away, Matt. And that's why I don't think anyone is expecting, a circuit breaker in the whole China-US standoff anytime soon.
Enda, thank you so much. Enda Kern there, of course, from Hong Kong. Now, coming up, how the possibility of an increase in U.S. capital gains tax is also creating alternative investment targets for the Blackstone Chief Executive, Stephen Schwarzman. More from our interview next. This is Bloomberg.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Danny Berger in London, Matt Miller in Berlin. Kelly Lyons is off today. Now, Stephen Schwartzman says the risk of an increase in U.S. capital gains taxes may lead to an avalanche of opportunities. The Blackstone chief executive spoke to us from the Qatar Economic Forum.
We've been through these periods of higher multiples, and it leads to a certain type of caution, but it also presents a lot more opportunities because prices are higher, more people will sell. What we've learned is because we're fundamentally in the private markets, is that the only reason to buy something is to make it much better. We're in the business of accelerating growth of companies and of real estate that we own. And so it's unlike stock investing where you buy it and you hope it works out. We're change agents. We believe for good. And if we can put more money to grow businesses, then we can deal with some of the issues of higher prices by accelerating growth, which gives us more protection on the downside. With the prospect of the United States potentially increasing capital gains taxes very significantly, it's really like an avalanche now of opportunities of people want to sell things before their taxes are much higher for selling the same thing potentially next year. And so it's giving us a lot of opportunities. And what we have to do is be careful, always have a very exciting plan for growth. By the way, that results in us hiring more people. So this is good for society, and hopefully it's good for our clients who typically are large institutions like QIA.
Your Excellency, how far along is the QIA in actually try to diversify its portfolio? So I know you've planned to boost investments, for example, in technology and healthcare. Is that done to a level that you're satisfied with now?
Not yet. I think we have been deploying and focusing in technology and healthcare. Within the last 2 years, we have deployed in technologies more than ever before. I think the sectors is promising, especially if you really targeted a certain segment within technologies. And I think it's the sectors is have grown to stay. I don't think so. There is a risk, perhaps in the short term, with the inflation in mind. Even though I'm not really concerned about it, I think it would be a temporary basis. But as you know, it's the era of technologies, and a portfolio without a huge component of technology is not really a balanced portfolio.
Well, that was the Qatar Investment Authority's chief executive speaking at the Qatar Economic Forum with Stephen Schwartzman. Now, we should note that Qatar is an underwriter of the forum. Right. It's early in the morning, so here's a look at what else we're watching today. And I know, Danny, I've been waiting for the story all day. You're watching NFTs.
Yes, I am. Okay, and total transparency here, I'm not totally sure how I feel about NFTs. Of course, I'm really into the idea of a surveillance one, but this one I think is so fascinating. So it's from Sir Tim Berners-Lee, and he's going to be auctioning the original source code for the World Wide Web. I think that's really cool enough on its own. That auction starts later today, but also the winning bid gets a letter from Berners-Lee, which is, quote, reflecting on the code and the process of creating it, and a 30-minute long video created by a graphic designer that shows the code being written. Matt, I think this is so cool. If I had a ton of money, I would absolutely bid for this.
I still don't get the actual ownership link. Like, is it copyrighted? Do you then own the copyright? Or is it just like a digital certificate promising that it's yours with pictures? I mean,
it's kind of bragging rights, but it's also you get these extra benefits with it.
Well, I like extra benefits, so I'll watch that as well. Speaking of, President Biden has invited a group of senators back to the White House today to talk about a $560 billion infrastructure deal. It's considerably smaller than what he wanted, of course. We're talking about a spread out over 10 years here, but Senator Rob Portman, Republican of the great state of Ohio, says we are very, very close. So he is optimistic that they'll get a deal. And I guess, you know, the fact that Biden invited them back after talking to them all day yesterday must mean he thinks that there's a way forward as well. So I'll be watching that. NICNG, Fran, as I tell you, NICNG, to watch that on the Bloomberg.
Danny was making me actually think we should do a segment. If you had $100,000, what would you spend it on? I would not choose NFTs, but it'd be a great segment. We start it from tomorrow. I'm looking at the Bank of England balancing this recovery boost.
খুলনা বিভাগীয় স্বাস্থ্য অধিদপ্তরের তথ্য বলছে করোনায় কুষ্টিয়ায় সর্বোচ্চ 7 জন মারা গেছেন।
Is really this balancing act to keep the economy recovering whilst limiting inflation, but also limiting speculation about rising interest rates. So we'll see exactly what we hear, of course, from the central bank, but also what Treasury does to maintain stimulus until the recovery here in the UK is more entrenched. So that's coming up shortly. This is Bloomberg.
I'm not surprised also to hear the language of Fed Chair Jay Powell. They're committed to going at this gradually.
I think more surprising in the market was hearing taper talk start.
What they don't want to do is take a dramatic and drastic action to really result in a sharp shift.
Whether it's fiscally or consumption, there's really no cliff out there that we see right now.
Of course, the economy is experiencing some frictions. We rebooted the global economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance. Tom Keene has left the building alongside me, Lisa Abramowitz and Taylor Riggs. I'm Jonathan Ferro. Equity futures up 20 on the S&P 500, 42.51 on the S&P. Lisa, we start this morning with exactly the way we started yesterday. Just insert a different bank. First, it was Morgan Stanley, and it looks like JP Morgan might follow.
The idea here is requiring employees to get vaccinated before they come into the building, or frankly, just requiring them to get vaccinated altogether. This is what we were talking about yesterday. How much is Morgan Stanley the first mover, setting a precedent for the rest of the Wall Street banks? I love this memo, though, that was sent out to employees yesterday by JP Morgan. Report your status for vaccination by the end of the month. If you do not, you'll be contacted repeatedly by your manager.
Not messing around, are they? Get back to work seems to be the story. Get vaccinated too.
Yeah, and frankly, they're leading the charge when it comes to mandating vaccinations. You're not seeing that in the public sector. How much is the private sector really going to set the tone for what we can expect once the FDA gives the final approval to these vaccines?
Taylor Riggs, thank you very much for waking up early for us.
Thank you for allowing me to be an interloper on the
Let's
show.
talk about this. Let's talk about JP Morgan, Morgan Stanley putting the pressure on people to get back to work.
I don't know if I went out from New Jersey repeatedly contacting me, John, but it really does underlies we're coming off the election here, of course, in New York City for the mayoral election, sort of this push of what does an economic recovery of this city look like? What does this vaccine push look like? What does this mean really for some of the economic data as well as we push forward to what sort of this job recovery continues to look like and the interconnection so much with the vaccination rate?
As we go deeper into summer, and Lisa, I've got to say September seems to be the date in many people's diary.
Yeah, that people think that you're going to have to get back to work. Again, though, I do wonder whether we'll get FDA approval and really whether companies will go absolutely reverse their whole work from home idea and ethos and say, the office is where you've got to be.
Watch this, a market check without interruption. Deep breath, enjoy the moment. 42.51 on the S&P 500. Tom Keene away for the next couple of days. Futures up 20 on the S&P. We advanced by 0.5%. A nice lift to this market this Thursday morning, ahead of jobless claims a little bit later. Lisa will run you through the diary in just a moment. Yields are higher by almost a basis point at 149.36. Euro firmer off the back of some pretty good confidence numbers coming out of the continent. 119.43, Lisa, on euro dollar.
I got to say, when you said that, John, I almost wanted to interrupt you just because it felt familiar. That's all I can say. It felt like,
I won't interrupt you. Carry on, please.
Okay, all right. 8:30 a.m. We're going to get a slew of economic data. U.S. initial jobless claims expected to come in below 400,000 for the first time since the peak of the pandemic. Also getting the first quarter GDP figure. This is the third reading, expected to be largely the same at this incredibly high pace of more than 6%. However, there could be a downside surprise when it comes to the trade dynamic here, given some of the imports and, frankly, the lack of exports amid some of the supply shortages. 1 p.m., this is the exciting auction. The U.S. is planning to sell $62 billion of 7-year notes. This is the Treasury auction that has been the most volatile. However, yesterday's 5-year note sale actually came in relatively stable, a little bit weaker in certain of the internals, but still definitely solid demand despite some of the rhetoric around hiking rates and tapering some of the monthly bond purchases. And 4:30 p.m., the Fed will release the stress test results. The expectation is for all 6 banks to pass with flying colors and then for them to possibly even double their dividends and stock buybacks over the next year. My question is, how will the markets respond? This expectation is baked in. How much will this give a boost to bank valuations if this does come to pass and they do pass the stress test? Or, John, how much is this basically par for the course?
Well, let me ask you this. You're more interested in how the market responds or how Washington responds?
Well, at this point how the market responds, because honestly, there's so many priorities in Washington, D.C., whether it's infrastructure or frankly, big tech, that's more in their crosshairs right now than Wall Street. But yeah, you're going to hear, Senator Warren come out and say, how can they be making so much money and do all these stock buybacks? But it's going to be more sound than really, than actually coming through with anything.
The Twitter account of Senator Warren, one to watch maybe a little bit later this afternoon, if you like that kind of thing. Hugo Rogers joins us now, Dowtech Bank and Trust Chief Investment Officer. Hugo, great to catch up as always. Had a week of a little bit of volatility. I guess my first question for you is it a bump in the road, or are we just on course for more of the same? Is that what the story for this last week?
We think it's a bump in the road, to answer your question pretty directly. Good morning, everyone. Thanks for having me. The bump in the road is the road to recovery in inflation. If it's not a bump in the road, then effectively people's assessment is that this is already the end of the cycle. When we haven't even started, unemployment is still above 6%. We've still got 8 million jobs to get back in, 8 million workers to get back into the workforce, 8 million jobs to create before we start getting into the cycle. For us, it's difficult to imagine the cycle already ending when there are no rate hikes due, even on the more hawkish forecasts you saw last week, till 2022. So we think it's a bump in the road. We think people got overexcited about inflation. We've always been telegraphing our view that inflation is normalizing. It's not breaking out aggressively to the upside. There's no reason yet to doubt the transitory assessment of the Fed.
Well, Lisa's written about this recently. I'll ask you the question, and no doubt Lisa's going to want to follow up on it. What does it tell you that we had the kind of moves we had off the back of a very incremental move in the communications from the Federal Reserve?
Yeah, I mean, it tells you that there are lots of passengers on one side of a ship. You saw the open interest in the Treasury market. There was a squeeze available there. There's actually a shortage of inflationary assets. Your introductory piece spoke about banks. Obviously, everybody knows about the buybacks. But the main vehicle or the way people use investments in banks is as an inflation hedge, because banks are used as they're lending longs, they're borrowing short, lending long. They're basically a play on the yield curve. So that yield curve flattening was very bad for that. But it speaks to a dearth of true inflation hedges, and people got on one side and were surprised that inflation may be actually benign, which we think at the moment it's not exactly benign. There are risks to break out to the upside, but core inflation at 2.5%, if you adjust for the base effects, that is normalization rather than any kind of panic situation.
Hugo, there is a question about the accuracy, though, about some of these inflation gauges that you talk about. The idea here that the Fed has been involved in these markets and that, frankly, there is a lopsided amount of securities available for purchase as well as dollars to buy them. How much can we actually read from break-even rates in terms of expectations for future inflation versus what people are paying for their cars, their homes, frankly, even at the grocery store?
Yeah, the distortions in the bond market are well known. The Fed's still buying $120 billion of assets every month, and the money supply growth may have dropped from 25% down to about 15%. There's still oodles of money out there. All you have to do is look at that reverse repo now. Look at the $750 billion that's having to find a home, desperate to find some positive returns. So there's a lot of distortions in the bond market. We think you need to be very wary about signals from the bond market saying the cycle's over, that inflation is truly benign. We think that those things can reprice steadily as liquidity is withdrawn, because they're too distorted, even if inflation proves to be a little bit stickier. So that signal needs to be read very carefully. But the other signal that needs to be read very carefully is some of the inflation measures themselves. So everybody knows that the inflation number hitting 5%, largely down to used cars, hotel rooms, a quite narrow band of goods and services that are motoring away. To understand whether there's going to be a sustained breakout in long-term inflation, you have to look at the jobs market, you have to look at wages, and still there's excess capacity there. So at the moment, we are thinking that the transitory assessment is the right one.
With the asset purchases, does the type of tapering matter? Equal weight between MBS and treasuries, or perhaps maybe more a shift in a focus to MBS, given some of the housing data as of late?
Yeah, it's an excellent question. So the type of tightening does matter. We've seen in Europe, actually, there was a shortage of assets to buy in these bond buying programs. So I think what that is a nod to where the Fed thinks that they are distorting the market most severely back into the real economy, away from collateral requirements of banks and so on. So the tightening in MBS is I think, a function of the market structure, rather than we're looking to quell a housing bubble or something, despite rapid price increases. But it will affect the real economy in different ways. And yes, the data you've seen on house prices, they're not trying to cool a hot housing market. Actually, what's happened is prices, input prices, and house prices themselves have started crimping demand. But also, you've got other considerations now. Now, maybe you're going to be going back to the office, as your introductory piece suggested. So that big rush to move out of central business districts and small flats into somewhere bigger, that is now over. We're entering a wait and see phase there, including in the housing market. And, the main message from the Fed will be incrementalism.
Hugo Rogers, probably the luckiest man in finance. I get jealous every time he comes on. It's very summer, isn't he? Very summer cash with the white jacket.
Yeah,
just looks good.
Utterly charming, John. Thank you so much.
Good to see you, Hugo.
He's
as
in
always.
Bahamas,
Very good to see you.
right?
I know. Hugo Rogers at Dow Tech Bank of the Bahamas, Lisa.
Yeah, do you think he goes to the beach in his free time?
Maybe straight after this.
Yeah.
I have no idea.
Like
Maybe this is the morning's work done.
A Tang Mimosa along with Tom Keene. It looks like a good place to work. I think
Taylor, to be honest with you, asked the right question. Taylor, I asked that question to President Williams of the New York Fed, and he pushed back a little bit. I think they're worried about the broader signaling from any reduction, whether it's MBS or Treasuries, just the broader signaling for the broader market.
So interesting. I went back to read the December 2013 announcement on the taper and making it very clear, John, that it would be equally weighted between $5 billion in treasuries, $5 billion in MBS. And increasingly, though, in the last few weeks, I've heard more discussions of how do you do that. Mr. Bostic yesterday saying that we might look at taper in 3 to 4 months. That sets us up nicely for September. But we'll wait and see.
We'll catch up with Mr. Dudley a little bit later. Bill Dudley, Bloomberg opinion columnist and, of course, former Federal Reserve Bank of New York president. Looking forward to that. Equity futures with a lift this morning. Good morning. Up 20 on the S&P, 42.51 on the S&P 500. We advance 0.5%. This Thursday morning, this is Bloomberg.
With the First One News, I'm Ritika Gupta. U.S. officials are confirming that details of the genetic makeup of some of the earliest samples of coronavirus in China were removed from an American database where they were initially stored at the request of Chinese researchers. The U.S. National Institutes of Health says that the data, first submitted to the U.S.-based Sequence Read Archive in March 2020, were requested to be withdrawn by the same researcher 3 months later. In South Africa's daily COVID-19 infections rose to nearly 17,500, the highest number recorded in the country's third resurgence of the virus, according to the National Institute of Communicable Diseases. With 1.86 million people infected and more than 59,000 deaths, South Africa has the highest number of confirmed coronavirus infections and deaths on the continent. Bullish, a cryptocurrency exchange backed by a group of billionaires, including Peter Thiel, is in SPAC merger talks with Far Peak Acquisition. Bloomberg's learned the deal could value Bullish at nearly $12 billion, with an agreement possible in the next few weeks. The final valuation could change depending on the price of Bitcoin. And Bloomberg has learned that Hong Kong's Lalamove has filed confidentially for a U.S. IPO. We're told the logistics and delivery firm is looking to raise at least $1 billion in the share sale. Lalamove provides on-demand van hailing and courier services across Asia, Latin America, and the U.S. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
There's trillions of dollars of assets under management now calling for greater and consistent disclosure around climate risk. And when I've also asked staff to take up disclosures around human capital, the most important, really fundamental asset of a company, the people that work there.
There's a lot of work to do at the SEC, the 33rd SEC chair. That was Gary Gensler there speaking to Bloomberg TV and radio from New York City this morning. Good morning. Alongside Lisa Abramowitz and Taylor Riggs. Here's the price action, 42.52 on the S&P 500. We advanced 21 points, up 0.5%. A nice lift this morning, this Thursday. Going into some data in America about 2 hours and 12 minutes away. In the FX market, euro dollar approaching 120 again, 119.45, up a little more than 0.1%. Business confidence out of France, out of Germany, pretty tidy, and yields approaching 150 once more, 149.19. Yields up almost a basis point on the day. This bond market not disturbed by what's happening in DC, not on the monetary policy side, but on the debt limit. Lisa, Taylor, Secretary Yellen coming out swinging in the last 24 hours. Lisa, failing to increase the debt limit would have absolutely catastrophic economic consequences. Secretary Yellen went on to say it would precipitate a financial crisis, it would threaten the jobs and savings of Americans, and at a time when we're still recovering from the COVID pandemic.
It seems like pretty harsh words considering that this is usually a formality, right? I mean, isn't this every 6 months or so there's a debt limit crisis, or every year, and people wonder whether they're going to raise the limit. They raise the limit at the last minute. People yawn. Is this time different? And I wonder whether that's the case or whether she just wants to get ahead of it and sort of place the blame prematurely on the Republicans.
Let's bring in Bloomberg Government's Jack Fitzpatrick. Jack, as you know, the current suspension of the U.S. debt limit ends July 31st. How seriously should we be taking this?
We should definitely be taking this seriously. The question is how complicated the solution to this could be. The technical deadline is July 31st. Treasury can always bump that back by some amount of time using extraordinary measures. They delay as many payments as they can, that kind of thing. But we don't know when that actual effective deadline might be. Secretary Yellen warned that could be in August when lawmakers take a break. There's an estimate by the Bipartisan Policy Center, which tends to be pretty reliable, saying, no, it's probably going to be later in the fall. So there's not really much of a legislative strategy on this. And to be honest, I've asked all the lawmakers involved in these kinds of discussions for a couple months now what exactly the plan is on the debt limit. And even as of yesterday, there is no plan. Hakeem Jeffries, the House Democratic Caucus chair, said yesterday there really haven't been talks. The Democrats can do this in a partisan way if Republicans try to use the debt limit as leverage for spending cuts. But that's through a slower budget reconciliation process. that they haven't really started yet. So the deadline and the fact that they don't know exactly when it is it may be challenging for them, and some Republican pushback on just a clean debt limit extension, suspension, or raise might make things tough as we get closer to August.
Jack, this feels like the same story over and over again, and I got to be honest, the T-bill market seems to agree with that. It seems completely unrattled by the prospect of some sort of debt default. So can you give us some insight in the politics behind this, especially at a time when there are no hawks left, where everyone's willing to do deficit spending? Why isn't there some sort of agreement to sort of kick the can down the road and get some sort of extension here?
Yeah, I wouldn't say now is the time to panic. The issue, though, is one, Republicans in Congress don't have that much of an incentive other than just general good governance to go along with a clean debt limit increase. I would also point to the fact that earlier this year, Senate Republicans added a measure to their conference rules, which are non-binding but essentially a political statement, saying that any increase in the debt limit should be offset by corresponding spending cuts. So if you raise it by $100 billion, that bill also needs to include $100 billion in cuts, which is something that Democrats would not go along with. So it is at least worth noting that the path to a solution to a suspension or a raise of the debt limit is politically complicated right now, and that, yes, Republicans have supported deficit financing measures in the past, but doing that under a Democratic administration with Democrats in control of the House and Senate is much different, and there's some more reticence on the Republican side right now.
Jack, how much does this $559 billion bipartisan infrastructure plan fit into the picture here?
That's part of a two-track approach to the major legislation right now. The senators who negotiated that are going to meet with the president at some point today to talk about that. But keep in mind, Democrats want first a bipartisan infrastructure bill and then a more partisan catch-all measure that they can do through reconciliation to pass it with a simple majority in the Senate later. And it's a bit of a chicken and an egg situation in which Democrats don't really want to do the bipartisan infrastructure deal unless they know they can get their other priorities in a second deal. But they may not want to do the second deal unless they can also understand that they can get the bipartisan infrastructure deal. So they're trying to get two things moving at the same time. And at least as of now, they are moving forward, and the mood seems relatively positive, at least on that first step. And there are plans for a second, bigger bill on the American Families Plan, that kind of thing, the climate stuff, anything that gets pulled out of the infrastructure talks.
How are we going to pay for all of this?
The question is if we're going to fully pay for it or if we're not really going to entirely pay for it. And there may be some kind of gimmicky measures to pay for it involved. The latest talks on infrastructure are how much money can you actually raise by increasing IRS enforcement. There's a huge delta in terms of how you measure that. It may come out so that the official score that says how much money you raise and can use to pay for infrastructure spending is only something like $60 billion, and Democrats may insist, no, in reality, it's greater. There are conversations among Democrats right now about a big legislative plan, infrastructure, and their other priorities that is about halfway paid for. But when we see the details of this infrastructure package, and the tax talks have been tough. When we see the details, we'll see if they made it to 100% pay-fors or if it's a bit cut off, and there's some sort of political wrangling to claim that it's more paid for than the CBO really says.
Jack, thank you. Jack Fitzpatrick there of Bloomberg Government. I thought this was a whole new world, Lisa, where we don't pay for things anymore.
I know, that's what I kept saying. Why do people suddenly care about it?
And I'm not even being snarky. The reason I say this is because from the bond market's perspective, this was meant to be the story we confronted through 21 into 22, and that seems to have changed pretty quickly.
The whole idea of modern monetary theory, just print more money and you'll be fine, and it seems like it has worked in terms of bond prices not declining too much, yields staying pretty tame, and yet the hawks are coming back. People
Taylor, is this one of the key variables for you? Just the uncertainty for this market, for the outlook, the lack of clarity on the fiscal path?
I am dying a slow death, John.
Just watching these talks.
Somehow you have to pay for it. I mean, eventually, all
But
the analysts say there'll be enough dollar weakness that we finally realize that someone has to pay for it, but not now in wartime, John.
I thought you were dying a slow death because it was just boring watching these negotiations go on and on and on. I hope it's not this show. Taylor, thank you. Coming up, Danny Blanchflower, formerly of the Bank of England, ahead of a BOE decision. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts. Live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From New York City for our audience worldwide, here's the price action this Thursday morning. Equities up 21 on the S&P, a nice advance, 42.52 on the S&P 500, up about 0.5%. Your all-time high on an intraday basis, 42.57. Look out for that in today's session. Switch up the board and get to the bond market. 2s, 10s, 30s. At the front end, elevated. We have a heartbeat in the chart of a two-year yield. Lisa's been running you through that over the last week. Right now, about 26 basis points. We drift just a little bit higher again. The likes of Bostic talking about a hike in 22. The likes of Kaplan talking about a hike in 22. It's not my view. I don't have one. I'm sure you do. We'll talk about that in a moment. Your 10-year yield, 149. Yields unchanged on a 10-year, on a 30-year, basically unchanged as well. Lisa went through some of the supply. We'll get some 7-year debt. A little bit later from the Treasury. That's the bond market. Let's finish on this in the FX market. We've had some decent data out of Europe. The PMIs were strong. Business confidence out of France, out of Germany, also pretty strong, pretty decent. Widely expected, just in terms of the trajectory, you expect it to get better. And the moves in foreign exchange, I've got to say, Lisa, they've been pretty muted. Euro dollar 119.46, up almost 0.2%. Even with that decent data, it's just shrug of the shoulders as you were.
Pretty muted pretty much sums up it all.
It's a summer Thursday, isn't it?
It's so boring
That's what it feels
out there.
like. Euro dollar 119.46, Taylor Riggs falling asleep. What does she call it? Death.
Slow death.
Slow death.
She's
Thank you,
dying a
Taylor.
slow death.
A slow
We
death.
all are.
Lisa, we're done.
Yeah, we're done. I will just say, you mentioned the Fed speak and how nobody seems to care. Sven Henrik on Twitter put out this comment. I think we should just move to 24 Fed speakers a day, every hour of the day, to keep us updated on progress. The more they say, the less they actually say. Danny Blanchflower, Dartmouth professor of economics and former Bank of England Monetary Policy Committee member, joining us now. We were just talking about how there is not much being said that is new. However, we may hear something in a half-hour time from the Bank of England when they release their rate decision. You're looking for a potential policy error. Can you explain?
Well, both the Fed and the Bank of England are struggling in the dark. We've never seen anything like this. And the best thing is to simply wait and see. So any suggestion that they have a clue, I mean, people say things like, I think we're going to tighten in 2022 and 2023. Well, they're just kind of winging it. I think that the potential error here at the bank is to say that they're going to start to perhaps do less QE, sort of stop it by August rather than December. As the economy goes into lockdown, the data really are very confusing. So I think the sensible thing for them to do is to say, we're continuing, we're waiting, and we're watching. Two people are going to leave the committee. Haldane, this is his last meeting. Flige leaves in August and we get Catherine Mann. So I think the right thing to do is to just say waiting, watching, and signaling that they have a clue what they're going to do in the future, I think would be a major error.
Well, Danny, I got to think that all of the discussion that we hear out of Fed officials and of Bank of England officials basically gets shrugged off by markets, because until Fed Chair Jay Powell speaks, no one's going to listen. Basically, he's going to lead the charge globally when it comes to tightening. And until he does so, you know, these members on different central banks can say whatever they want. No one will believe them. Isn't that the case?
Well, I think that's right. And I think in many senses, Jay Powell and I both sound the same. He's been very sensible. What did I just say? Waiting and watching, understanding they made a mistake in 2015 and accepted that, and saying, you know, we'll see how the economy moves. I mean, we've still got to understand what happens with the vaccine and what happens in the southern states in the United States, of course. But then there's all these issues about which firms are going to survive, and are people going to change their long-run behavior? And that's a risk to the downside. Are people going to keep those savings that they have and not spend them? We don't know, but the risks, I think, are to the downside. So if you go back to making the potential error, people saying, oh, we need to worry about inflation. Well, what inflation? So the talk today is the Bank of England worries about inflation. Well, it's 2.1, and we've had two very weird months where the base effect has dominated and the slight changes in the last couple of months go away in 12 months' time. So everything looks to be transitory and temporary. And the answer is we just don't know. And Jay Powell has been, I think, fantastic. And he's just been saying essentially that. Wait, look, and we'll respond if we need to. But there ain't no inflation problem, despite the fact 2.1, and that's supposed to be an inflation problem with a weird couple of months. Come on, folks, get real.
Danny, do you think we're suffering from a bit of groupthink?
Yeah, absolutely. I mean, so the groupthink in a way, though, if you follow Powell, is to be right. But I hear these Fed governors, I hear Haldane at the Bank of England making ludicrous claims saying inflation's going to take off. Based upon what? Wild wishful thinking and guessing. That's not credible for a central banker.
Danny, that dissent's healthy, isn't it? Even if they disagree with
course
you.
it is.
It's healthy
Well,
to
of
have
course
that. And I
it's
think what I've missed over the last 10 years, is particularly with the Bank of England, since Governor Carney came out with some forward guidance that, let's face it, didn't work. But one thing he said off the back of that forward guidance is that it helped to tie the hands of the committee, because you got everyone to agree with one thing and no one could dissent anymore.
John, you and I were just chatting on this. If you look at the Fed, not a single governor since Greenspan has ever dissented. Governors at the Bank of England have actually not dissented, although Haldane, as chief economist, has. I think a real debate is credible and sensible. But I think if you realise that we just don't know, remember we saw the biggest drop in output ever seen, biggest and fastest drop in output ever seen. And the question is, what's the past data? Well, we have past data from the 1918 Great Influenza, and we've had, so there's really not much to go by. So yeah, you're right. Dissent's quite good, but in a sense, much of the dissent we've actually seen over the last decade has been dissent in error. The reality is that people have argued that you should have raised rates, and they've dissented on that side. And it's clear over the last decade, every one of those votes was in error. You shouldn't have done that.
Big picture, Danny, a lot of the notes that I've read, the push for wage pressures, a focus on human capital, a shift to ESG, those are structurally inflationary. Are we in a new inflationary regime?
Well, the answer is go and read the blog written by C.C. Rouse, the chair of the CEA, talks about actually the likelihood is that the wage data really are messed up. And reality is very soon we're going to see negative wage growth. I've got two nice indicators for the UK, how hard it is to understand wage growth. The official data came out this week on wage growth, 8.4%. But we've just had data this morning on the size of wage settlements, 2. And so what you have are these base effects and composition effects. It's very hard to understand what's going on, but in wage terms, we've seen the bottom of the wage distribution drop out. And so we're comparing to a weird thing from a year ago. And so I think the evidence is actually that, there are going to be some bottlenecks, but that's not something you want to respond to instantly. I think that the wage pressure we will see, but I think a lot of it is, the world is changing a bit.
How many more data points would it take for you to see? 3, 4?
I don't know. I want to see evidence that significant bottlenecks are occurring, and I don't see that in the data. I'm not going to say 3 or 4. I would want to see sustained evidence, but I think the wage settlement evidence is pretty good. 2%, same as it's been for the last decade. It's been 2, 2, 2, 2. Yes, there are temporary bottlenecks. But what should the central bank do to respond to a temporary bottleneck? Think of price changes. We saw a big rise in timber prices. Okay, people don't have to buy timber. And so the price of timber now is halved. So I think we just have to watch an economy recovering from a shock we've never seen before.
Danny, just to conclude things, someone wrote into me just moments ago, and I think you'd agree with them. The only mistake has been to be too hawkish, never too dovish. That's been true over the last 10 years. Is that what you worry about now?
I think that's right. I mean, I don't understand how is it an error to sit and wait and watch? Just wait. Don't do anything more than you're doing now, and watch as the economy resolves itself. Look at the hawkish folk who I've been on your programs with many times over the last decade, telling us inflation was going to take off. That's what it was going to do. You had to raise rent. All of that was nonsense. So I think the error has always been in a recovery. You tighten too quickly. There's really no error to be had in waiting and looking and seeing. And I think that's what's going to happen. And we're going to see in the UK, the potential is the government is going to withdraw the stimulus, perhaps in September. In the US, these unemployment benefits are going to go away. And then we'll see. We'll see how the economy bounces back. But, wait, look, watch, and don't make another big mistakes like George Osborne did in the UK in 2010.
Danny, we need a round table, don't we, with you and Andrew Sentence? Yeah. We need to do that again.
Oh, no.
So we get Sentence back. Like the good old days. I think we're friends now.
We are good friends. We both think Brexit is a disaster.
There we go. You agree on something.
He still wants to raise rates, of course.
Does he? Well, that's what I thought. Maybe that would be the optimal roundtable for a program
No,
like this.
what's the discussion?
The discussion is that you want low rates forever, and
wrong.
he wants higher rates. Danny, it's good to see you. It's good to hear from you. Danny Blanchflower, Dartmouth Professor of Economics.
Things up again.
I'm trying. And former Bank of England Monetary Policy Committee member. Lisa, do you know that the two of them, when they were on the MPC, they fell out afterwards, and we did this nice kumbaya get-together. They made friends on my show many years ago after the UK voted to leave the European Union. That's the one thing they could agree on.
Yeah, and you want to bring them on.
15 years.
You want to bring them on to disagree.
On rates specifically.
Yeah, you want them to disagree because you want some good dissent. You also want some drama because this is a boring market and there are no hawks left, and there is a question of whether this is the right approach or whether there should be perhaps a little bit more pushback. Did you see this paper that the ECB analysts put out about how low inflation expectations breeds
the
low
one in
inflation?
Kit Duke's note this morning.
Yeah.
Kit's note over at SocGen. I saw that, yeah.
Yeah, I thought it was interesting, sort of the whole idea of Japanification. And it sort of brings this cycle in the forefront of central bankers' minds. If they say that inflation's going to stay low, does that keep inflation low? How much can they kind of
so they should
push it up?
commit to making a policy mistake. They should say.
I'm trying to stir something up for you.
It's going to be too high.
No,
What's wrong with the both of you? Taylor Riggs, Lisa Browitt's board this morning. Equities might print an all-time high later in the session. Taylor, what does that tell you that we could have record highs and you're both bored of it?
M2 money supply, right? All the money, John, sloshing around. We were having great conversations this morning of not only the monetary effects, but the fiscal effects as well. And it is unbelievable. The NASDAQ 100 at a record high, and sort of a hint of that defensiveness underneath the surface and the resiliency of these markets to shrug off any of those inflationary concerns.
How many record highs can you have before you shrug it off? This is going to be, what, the 13th?
This is another one. We'll talk about the pandemic a little bit later as well. Dr. Gigi Granville, Johns Hopkins Center for Health Security Senior Scholar. We'll do that later from New York City. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden is traveling to North Carolina today to encourage more Americans to get the COVID-19 vaccine. His trip to Raleigh comes 10 days before July 4th, the president's stated target date to see at least 70% of adult Americans at least partially vaccinated. The CDC says that so far, slightly more than 65% of U.S. adults have had at least one dose. China has filed a lawsuit against Australia at the World Trade Organization over anti-dumping measures on some Chinese goods. The measures in question target Chinese products, including wind towers and stainless steel sinks. Earlier this week, Australia said it would appeal duties imposed by China on its wine exports. And the world's biggest maker of Bitcoin mining rigs is suspending sales of machines for spot delivery, hoping to prop up prices. Bitmain Technologies says it has stopped selling new equipment after prices for top-tier rigs plunged by about 75% since April. China's crackdown on crypto mining is causing miners to abandon their operations and dump machines on the market. And Siemens has raised its financial targets and announced its first share buyback since 2015. The German industrial giant will buy back as much as nearly $3.6 billion of shares over a 5-year period, starting next year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
We don't have plans to close full offices and tell people to work from home. No. We want people to come into the office. With the vaccination rate as high as it is now and the measures that people have taken, while clearly COVID-19, it looks like there's going to be another wave. But hopefully that doesn't translate into hospitalizations or more serious illness.
That was Jes Staley, the Barclays CEO from New York City this morning. Good morning. Tom Keene taking a long weekend alongside me, Lisa Abramowitz as always, and Taylor Riggs as well. It's the price action this Thursday morning, shaping up as follows on the S&P 500, 42.52. We advanced 21 points. We're higher, firmer, stronger by 0.5%. Yields are higher too by a single basis point on a 10-year to 149.36 in the FX market. Euro stronger off the back of some pretty decent confidence data out of the two largest economies in the Eurozone, France and Germany. Euro dollar 119.46, advancing there 0.2%. The bank CEOs, Lisa, they are not holding back. Jes Staley, we don't have plans to close the offices. We want people to come into the office. He's pretty clear about that.
Come into the office, but you need to get vaccinated if you do. That is Morgan Stanley, JP Morgan not far behind. And it really is showing how the private sector is leading the way when it comes to vaccination policy at this point.
Get it done and get back to work. Taylor Riggs, the thing's pretty clear going deeper into summer, isn't it?
100% clear, John. And I think that this has been sort of the big debate on Wall Street, of course, not only within New York City, but global Wall Street, as we think about how the private sector takes back perhaps maybe some of those big decisions, John. So we think about how to get an economy reopened.
Yeah, Taylor, you say global Wall Street, though, Lisa, it's been pretty clear, with maybe the exception of Barclays and Jes Staley, that the European banks are taking a slightly, subtly different way of thinking about this.
Yeah, it's that they see that working from home really works, and also that it might maybe save money.
Just a little bit on floor space,
might be part of
on
it.
office space, maybe. Dr. Gigi Gronville joins us now, Johns Hopkins Centre for House Security Senior Scholar. Doctor, great to catch up. Chancellor Merkel speaking in the last couple of moments. Here's the headline. We're worried about the COVID-19 Delta variant. Doctor, why should we be worried about the COVID-19 Delta variant?
Yes, the Delta variant looks like it's a little more transmissible than some of the variants we've dealt with before. But thank goodness it's still, the vaccines are protective. So if you haven't gotten vaccinated, this is the chance. This is your opportunity to get immunity before you get exposed, because it's looking like you will be exposed to this virus. So don't delay.
So, Dr. Gronville, what's the logic of places like Israel closing or perhaps delaying the reopening to foreign visitors because of the Delta variant, because 100 people got diagnosed with COVID, given the fact that people are not getting hospitalized? And frankly, these vaccinations are protective against the variant.
Yeah, well, not everybody is able to respond to the vaccine in the same way. And perhaps, you don't want to take that risk. There are still maybe children who haven't been vaccinated. So it's taking an opportunity that maybe could have been taken early in the pandemic to try and limit the import of infections if you had the ability to test and to do contact tracing.
And this is coming at a time when Germany's Angela Merkel is saying that there needs to be more coordination between the European region in terms of the travel guidelines. What's the threshold in your mind in terms of vaccination rates, in terms of hospitalizations, where we can get a sort of more consistent protocol globally in terms of travel, in terms of testing, in terms of quarantining?
Yeah, I think you're not going to get a good answer about that, except that that's not enough what we have right now. There's still a lot of problems with access to vaccine, and so we need to make sure that the people who are most vulnerable and the people who are interacting with others and transmitting it to each other, that they are also prioritized for vaccination, because it's a lot of the younger people that are transmitting these variants.
Doctor, I'm curious how you respond to people who say you look at countries like the UK and Israel with the best vaccination rates, and yet they can't reopen their economy because, to Lisa's point, you see a rise in infections, sometimes asymptomatic cases. Some people say that sort of undermines the confidence in the vaccines. How do you respond?
Well, 2 doses are better than 1, and so that's part of the problem with the UK, that there are still a lot of people who haven't had their second dose. So I think, I don't know what to say to that, except that for you personally and your family, you will be better protected if you have both doses of the vaccine. And there is even some discussion now about whether or not people who are particularly vulnerable, who have had the one-shot J&J vaccine, whether they might consider topping it off with a second shot, because the second shot seems to be more protective.
Do you see a time in the near future, similarly to the flu 100 years ago, where we just learn to live with the virus?
Well, we're not going to eradicate this virus. Any thought that that we're going to be able to take this away from the planet is that's just not going to happen. It took a lot of effort, and it was very particular conditions to eradicate smallpox from the planet. And we're not going to be able to replicate that here, especially because this virus can also infect a lot of different animals. So we are going to live with it, but let's learn to live with it with a high vaccination rate and high testing. We can do that, and we can certainly limit severe disease.
Doctor, we've got to leave it there. Thank you. Dr. Gigi Gronville there, the Johns Hopkins Centre for Health Security Senior Scholar. Got a case study playing out in real time in the UK right now with this Delta variant, Lisa, and we have a country that has got, I believe, 60% of the adult population with 2 doses of a vaccine now. So how this plays out is going to be pretty key.
And the fact that younger people are the ones that are getting sick, but they're not dying. They are getting hospitalized, but you're not seeing the hospitals overrun. So at what point does this become, as you've mentioned many times, the onus on the individual to protect themselves and, frankly, to have protection for the rest of society, and frankly, just get back to life? For those who are vaccinated, they're going to be fine.
When a personal decision no longer threatens the healthcare system more broadly. Are we at that point right now, Lisa? I guess that's the open question.
That's the open question, especially because, to Gigi's point, to Dr. Gronville's point, there are places that still don't have that many vaccines, so they might be less available in terms of access, and also younger individuals, right? I mean, younger kids who might not be as vulnerable. However, if they're not vaccinated or even eligible, do we really want to enter into that shift?
I've got to say, for New York City, Taylor, with the exception of going on public transport, getting in an Uber or a cab and wearing a mask, things are pretty much getting back there, aren't they?
John, you know what I thought about the other day? It was like a year ago. I was on the Open, and I made a joke about how traffic seemed to be back. I take that back. 2 days ago, traffic was more back than it was a year ago.
I've got to say, going into the weekend, it is very, very busy in New York City. It's the New York tourism, the domestic tourism. Lisa, do you think that's what Mr. Gorman and Morgan Stanley's made his point about? That if you can return to New York to go to a restaurant, we want you back in the office?
Yeah, basically they're saying if you can have a normal life elsewhere, why not have a normal life coming back to the office? I think the distinction here is whether people will want to work from home, whether there is a generational shift where younger people say, look, why should we come into the office if we can do our jobs just as well? And so I think that the proof now goes beyond the pandemic and goes to a quality of life, a style of life in terms of efficacy. And that's going to be the divide.
And maybe an older gentleman who wants a longer weekend, just to have a stroll around Manhattan, have a cigar without a mask on. Who am I talking about?
Who
am I talking about? He'll be back with us on Monday. Equity futures 42.52. We advance 0.5%. From New York City for our audience worldwide, this is Bloomberg.
Freedom delayed 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly, and later this week we'll get unemployment, inflation and retail sales data that should all further illuminate the economic recovery.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Bloomberg Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
I'm not surprised also to hear the language of Fed Chair Jay Powell. They're committed to going at this gradually.
I think more surprising in the market was hearing taper talks start.
What they don't want to do is take a dramatic and drastic action to really result in a sharp shift.
Whether it's fiscally or consumption, there's really no cliff out there that we see right now.
Of course, the economy is experiencing some frictions. We rebooted the global economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Tom Keene is out of the building alongside me, Lisa Abramowitz and Taylor Riggs. Looking at the equity market right now, 42.52 on the S&P. We advanced 21 points on the S&P 500. Sterling comes in just a little bit, now negative on the day at 139.55 with a Bank of England rate decision. Lisa Abramowitz, what's the detail that you see right now?
Just that it's no drama, right? That basically there was no rate decision. They voted unanimously, to speak to your point, to maintain benchmark interest rates and that they hold government asset purchase plan. It had $875 billion pounds. So basically no change, no indication of tightening. We'll have to wait to see and parse through the details to see whether there was any more hawkish decision. But you could see yields falling here as people weigh this as them remaining as dovish as they can be.
And a parting dissent from the chief economist Andy Haldane, largely anticipated. That's the result of all of this, voting to reduce the asset purchase target. The asset purchase target, the gilt purchase target right now, 875 billion in its entirety. Sterling down to 139.42. Taylor, we've got to try and get you excited about the day ahead of all-time highs on the cards, maybe on the S&P 500.
You're not going to let me live that down, John. Certainly interesting day. The resiliency of these markets to shrug off some of the inflationary, perhaps some of the more hawkish tones that we get. Raphael Bostic, Mr. Bostic, of course, from the Atlanta Fed, really striking that tone, John, yesterday, hinting that he's looking at a taper maybe in 3 to 4 months. That sets us up nicely for Jackson Hole September and perhaps maybe some of the divergence or not between the individual central banks as equity markets say, all right, we're in it and we're going going higher.
And everyone else just shrugs their shoulders as we looked down the path towards another all-time highs. The Bank of England right now, we will not tighten until there is clear evidence of progress towards our goal. Lisa, 139.28 now on sterling against the US dollar. We're down about 0.25% there.
Yeah, although they did say that downside economic risks have been reduced. However, everyone seems to be saying this as we end up heading toward some sort of recovery. That said, the balance of the decision-making at this point is to the more dovish side. And I think that is clear from each central bank meeting that we hear. Frankly, it's going to have to be Fed Chair Jay Powell that changes the tone.
Let's turn to the price action, 42.51 on the S&P 500. Equity futures drifting higher this Thursday morning. We advance 0.5%. Cable, negative on the day. That's a weaker pound, down by 0.25% against the US dollar. Sterling, 139.26. Euro dollar, 119.41, advancing a little more than 0.1%. And yields basically unchanged on a 10-year at 148.68. Lisa, unchanged on a 10-year after all of the surprise and action after the past week.
Yeah, a thrilling day. Honestly, though, this is telling because the fact that you have all of these Fed officials coming out and saying, actually, these inflationary pressures could be significant. The fact that you're not getting any move today is significant, that people are shrugging that off. I will just say, if you're playing the drinking game, the Bank of England coming out and saying the T word, transitory, when it comes to inflationary pressures. My question is, if we have such a robust recovery, if we have such a tight labor market, why is it that we're still getting nearly 400,000 Americans filing for unemployment benefits each week? Today, we're expecting less than 400,000 for the first time since the peak of the pandemic. However, still a high 380,000. The question that I have is how much progress is being made? How can we dismiss these data points as just noisy versus actually telling in terms of the composition of which jobs are coming back? Are we at a services recovery yet? Also getting the first quarter GDP, the third read of that. 1 p.m., the U.S. is selling $62 billion of 7-year notes. Perhaps there will be drama here. It does not seem like, though, that is the case based on the recent auctions that we got. Yesterday's 5-year sale went pretty well. And then 4:30 p.m., the Fed will release the results of the stress test. All 6 biggest U.S. banks are expected to pass with flying colors, expected to double their dividend payments and their stock buybacks. The question that I have really is the market question of how people will trade this. Basically, is it baked in, or do people see this as a point of profitability going forward? Have banks become the new utilities, John, in terms of just generating cash and being a reliable bet rather than a more fickle one that fluctuates on trading volumes?
That has been a theme for many years now, hasn't it? Lisa, thank you. Let's turn to Luke Cower, UBS Asset Management Asset Allocation Strategist. Mr. Cower, good to see you, a good old friend. Luke, as you know, central banks, when they change, they take baby steps. And the baby step that I think we're witnessing over the past week, both with the Federal Reserve and now with the Bank of England, seems to be just reassessing the balance of risks around the outlook and also around the outlook for inflation. What's your take on that, Luke?
John, imagine if your baby's first step wasn't a first step, if it was, a pole vault or a high jump. That's the shock kind of the market had to deal with, even though we're talking about things that were only out, in 2023 and do require a lot of progress to be sustained and to be actually realized. So in kind of looking at the Fed and digesting how that might hit cross-asset action, what we're thinking about is kind of the 2 reasons why Chairman Powell said that the dots did move up. One reason is that economic activity is coming in, so there's more confidence within the Fed that the baseline outlook that they achieved that they outlined in March is going to be achieved. So on the one hand, this suggests that continued inline data is going to be a force of pressure that continues to pull forward dots. And if you're trading short-term interest rates, all you have to do is be more confident than the Fed that economic outlook is going to be achieved. You can kind of continue to push the timeline on that front. On the other hand, it's clear that the inflation risk, the balance of inflation risk, that jumping to a net 13 Fed officials thinking that the risk to core PCE are tilted to the upside, that also influences the forecast, the balance of risks, and when they think tightening might be warranted. So on the other hand, you have what we would expect to see over time is that the ebbing of these inflationary pressures and upside risks, just as these do turn to be less persistent, to avoid using the T word, inflationary forces. So kind of putting this together, I think what you would expect coming out of the FOMC, and this is something we've adjusted to take account of, is that real yields break-evens trade-off has moved more into the real yield yield side of it driving moves in the 10-year. That, of course, is going to also have an effect on the dollar. So it's about seeing less widespread dollar weakness and the scope for that deteriorating on the margin. What I will say is encouraging to say from a risk perspective is that even as we've had, a broad dollar rebound in the wake of the FOMC, it's rallying more against the DXY components than it is against the EMFX component. So this suggests this isn't about a kind of a dumping of risk currencies, so to speak, or a less positive view on risk. It's just a reevaluation of the Fed, real yields, and what that means at the front end.
So, Luke, the more we hear the T word, transitory, the more people buy risk assets. Exactly as you said, they're going further into a risk in order to get returns. There is a question at what point the Federal Reserve, the Bank of England, other central banks start to take action just to curtail some of the moves that we've seen. And I'm thinking of the mortgage market in particular. To Taylor's point earlier, this question of the composition of which assets the Fed may pare back on its purchases. How much are you looking to the mortgage market to feel some pain from that as people start to question the elevated housing prices?
Well, I think the main reason why the Fed at this point is still purchasing in both asset classes is because it knows, as we know, that by purchasing MBS, it's sucking Treasury vol out of the market. And one of the Fed's goals is to use asset purchases to a certain extent to calm markets, calm market volatility. So I think the signal from the Fed that it's going in either direction in terms of both purchasing less and moving to raise rates at some inconclusive point in the future is really just a signal. They will both be that the Fed is moving more from a vol suppressant mode, a purely vol suppressant mode, in order to get us through the crisis and get the rebound completely on track, to one where the Fed is going to be more a source of two-way volatility. I think that's the real read-in from that, not necessarily the nature of the components of the underlying asset purchases.
Luke, are you surprised by the cross-asset resiliency with equities at record highs, a VIX with a 15 handle, and a very calm and well-behaved bond market?
To a certain extent, yes. I think the markets have been able to digest this quite well, a more hawkish than expected Fed. And I think kind of when we're looking through what and why, what we talked about earlier in terms of the dollar being stronger, real yields being stronger, how far can that filter out? What's very important lately is that it hasn't filtered out really all the way to commodities. Copper had a pretty bad move down, but that's kind of alleviated lately. Oil still pushing forward to new highs. So the market is still trading this idea of we're still getting very, very good activity going forward. The Fed has cut off right tail inflation outcomes. Therefore, it's safe to buy equities. In our view, there are limits to this, particularly the way that it's been kind of playing out under the surface with the rotation to growth. That's not necessarily something we want to chase right now. Right now, the equities at the headline level, we do think are due for a breather. And if you look at over the past few months, equities have really moved sideways on a global basis and on the S&P 500. So we're not necessarily looking for a lot of downside, but think there will be an attractive dip potentially to buy going forward in the coming weeks. And this is just to do with the market needing to digest that the second derivative is turning, the Fed is becoming less supportive.
Luke, always great to catch up. I promised you we wouldn't talk baseball. We won't. Has UBS got a call on Euro 2020? Have you got a country, a nation?
I mean, I have to say the Swiss, right?
The Swiss.
Do you?
I guess, maybe.
Why do you have to say the Swiss?
UBS, I guess. It's
really?
The house view, right? You got to go with house view? You got to go with Switzerland. UBS asset management, asset allocation strategist Luke Cower. Luke's become so corporate.
I was about to say the exact same thing. Really?
He's become so corporate.
He would never say
I know.
the New York team.
So just pick a side.
Is that
Seriously.
long hair corporate?
Not sure, to be honest with you. Used to be very strict over at UBS, Taylor. What you could wear, what you couldn't wear, the kind of styling you might need. I'm not going to go there. I'm going to go to a headline for the Bank of England. This is how you say goodbye to your dissenting chief economist. It's wrong to undermine the recovery with premature tightening. Lisa, that's the headline coming out of the Bank of England this morning.
Saying goodbye to the last dissenter. I think a lot of people thought that he was, don't let the door hit you on the way out. People thought that he was a little bit on the fringe. That said, how much is it actually healthy to have that fringe view? I don't know. You think you
think dissent is good.
Yeah.
Andy Haldane goes over to a think tank now and writes some provocative pieces, maybe.
For Project Syndicate?
Gets you thinking, for whoever. Coming up at 8 a.m, Peter Cheer, Academy Securities Head of Macro Strategy. Looking forward to that conversation with Pete in about 50 minutes from now. Equities up 21 on the S&P, 42.53 almost, up 0.5%. From New York City, heard on Bloomberg Radio, seen on Bloomberg TV, this is Bloomberg Surveillance.
With the First Word News, I'm Rishika Gupta. US officials are confirming that details of the genetic makeup of some of the earliest samples of coronavirus in China were removed from an American database where they were initially stored at the request of Chinese researchers. The US National Institutes of Health says that the data, first submitted to the US-based Sequence Read Archive in March 2020, were requested to be withdrawn by the same researcher 3 months later. The Vietnamese government plans to administer 300,000 to 500,000 COVID-19 vaccinations a day in the next 6 months, according to a post on the government's website. The Ministries of Health and Defense are said to be close to completing warehouses capable of storing vaccines at extremely cold temperatures in 7 locations across the country. And bullish, a cryptocurrency exchange backed by a group of billionaires, including Peter Thiel, is in SPAC merger talks with Farpeak Acquisition, Bloomberg's learned. The deal could value bullish at nearly $12 billion, with an agreement possible in the next few weeks. The final valuation could change depending on the price of Bitcoin. And John McAfee has been found dead in a Spanish prison cell shortly after it was announced he would be extradited to the US to face charges of financial crimes. The creator of the McAfee antivirus software has been jailed in Spain on US tax evasion charges. A Spanish newspaper has reported that he appeared to have taken his own life. He was 75 years old. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
作为我的个人目标，可能会接下来会继续锻炼身体，会尝试去做7+2，再次感谢，曾经给我力量、给我能量的艾瑞克。
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public public-private partnership.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I'm not surprised also to hear the language of Fed Chair Jay Powell. They're committed to going at this gradually. The real unemployment rate is still elevated. The bond market is not signaling substantial inflation. And so this is going to be a gradual process.
As you were in the bond market, that was Brian Levitt, the Invesco Global Market Strategist. Tom Keene out of the building with me, Lisa Abramowitz, Taylor Riggs. I'm Jonathan Ferro. Is the price action this Thursday? Equity futures 42.51 up 20. We advance 0.5%. In the FX market, euro dollar 119.44. Yields unchanged at 148.51 on a US 10-year. If you switch up the board and get to the FX market, sterling is what I want to look at. Cable with a leg lower. That's a weaker pound against the US dollar, 139.23. That's a weaker pound, Lisa, as the Bank of England pushes back against any chance of a hawkish pivot a la the Federal Reserve anytime soon.
I think the Fed's going to have to move first, and that's the message that we're getting from central bank after central bank. I mean, honestly, at what point is this just going to be a race to the bottom continually, even as we see inflation pick up?
Do you remember that race back in 2014 between the Bank of England and the Federal Reserve? Who would hike first?
Yeah.
Going to be waiting a number of years maybe for even the Fed to make that move.
Honestly, at this point, it's the move of indicating that they're going to slow the purchases. That's first, and frankly, that'll be a hawkish shock. What did Luke Kawa say? What if the first step was a first leap? That's considered a leap.
I called it a baby step,
Yeah.
and he said, imagine if your baby's first move was a somersault or something like that. Thank you, Luke Kawa. Josh Wingrove joining us now, Bloomberg White House reporter down in D.C. Josh, always good to catch up, sir. Let's just start with following the infrastructure talks. I've been told it's days and not weeks. We've got to get it done. Otherwise, we're going alone. And then I was told the same thing 3 weeks after I left the building. What's going on, Josh?
Yeah, they seem to have reached near the sort of cusp of a deal or an actual deal last night. A couple of senators coming out calling it a quote-unquote framework, others saying, well, we're not quite there yet, but they did get this sort of golden ticket, which is a meeting with Biden himself today at the White House. The White House said they wouldn't do that unless there was progress. The top-line numbers kind of depend on who you ask right now, but it looks like something on the order of $559 billion in new spending. There's ways that they can sort of muck that up by stretching the timeline and including stuff that would have been spent anyway to push it over $1 trillion and call it a win. Democrats in the House, though, are signaling that for them, the reconciliation process is part of this deal. In other words, stuff they did not get in this can maybe get rolled into reconciliation. So with regards to a bipartisan infrastructure deal, this is sort of like, letting the least popular person at the table order the appetizers because you know that you still get to order the main course.
Well, Josh, that's exactly what I was going to go to. The idea here of, isn't this a loss for the Democrats, giving the Republicans the upper hand, that 1.9 to 1.2 trillion to now $559 billion infrastructure plan, continuing to ratchet down while the prospects of further plans getting passed kind of start to wane?
They wanted more for sure. Republicans will definitely hold this up as a win. Democrats are frustrated, of course, particularly the progressive wing are frustrated, but there is that still shoe to drop. Now, reconciliation, for those of the sane viewers who are not following the vagaries of Senate parliamentary procedure, there's a lot of big question marks on it. A, we don't know what all 50 Democrats in the Senate will support, Joe Manchin, Kristen Sinema, et cetera. B, we don't know what can go in reconciliation. It's always sort of up in the air. You'll recall that the $15 minimum wage went over the side of the ship when they realized that would be sort of out of bounds. So Democrats have this sort of second bullet to fire, if you will, but they don't know yet what they can put in it. Remember, he's got that whole third plan as well, the families plan. They kind of want to do all of that through reconciliation. That might go to the fall. It's a lot of moving parts here right now. But Biden is trying to have this sort of smaller deal that Republicans can support. Incidentally, we don't, just because 10 Republicans support it doesn't mean 60 senators do. And then try to get something enough on reconciliation that progressives don't sort of lose their mind and, accuse them of selling out to the Republicans.
Josh, one reason why it's always great to speak with you is because you walk through the halls of Capitol Hill and you find out where the balance of energy is. Is it all in infrastructure? Is basically the pandemic over and no one's talking about it, even though in the rest of the world there still is a lot of cases and a lot of concern about getting vaccinations?
I mean, yeah, infrastructure and other things. The pandemic has definitely gone down the list. One thing that we're going to see Joe Biden do today is go to North Carolina to try to essentially beg people to get shots. We really have two Americas right now where higher vaccination rates in some states are, in stark contrast to lower vaccination rates in other states, in particular through the U.S. South. That Delta variant is starting to spread, and Biden is kind of torn on his messaging, right? He wants to do this July 4th celebration at the White House. They're going to have 1,000 people, Independence Day from the virus. Depending on where you live in the U.S., this thing is very much over or it's very much not. And the problem is that a lot of folks where it's not over tend to be the ones that most likely to believe it is over, and they're not getting the vaccine. So in Congress and the White House, this is a balancing act. Biden wants to talk about reopening. He wants to talk about all the shots they've given. 150 million people in the U.S. have had both shots. That's a staggering number as compared to, a few months ago. But my gosh, this thing is still roiling out there, in particular that Delta variant.
To some of the infrastructure conversations as we try to round this conversation out. And how are we thinking at this moment of defining what infrastructure is and what it isn't?
I mean, it's definitely getting more to bricks and mortar. This was sort of the early animating discussion. Joe Biden takes a broader view of it. They think that anything that facilitates people entering the workforce can be, considered infrastructure, including things like the caregiving economy and whatnot. Some of that did get pushed into the third bill, which means it wasn't necessarily on the table for these conversations. What we're talking about now is a little more sort of, core, what you might call core infrastructure. And again, $550 billion over, a shorter time frame. They'll probably call it over $1 trillion over 10 years when you roll in stuff that was sort of on auto spend anyway. There's consensus that this is needed, but we'll see. One of the changes that they've done is sort of raid money from COVID aid for around telecoms. So, that doesn't sound like people that are that five-alarm desperate to add more infrastructure funding to the pot.
Hey, Josh, it's good to see you. Josh Wingrove, thank you, and good luck. My good friend Anne-Marie Horder and joining the team down in D.C. That is a big dose of New York down in Washington. You'll be okay, Josh. Josh Wingrove down in D.C. looking a little bit worried about how much New York has just gone down to D.C.
Come on.
as Anne-Marie Horder joins the team. Just Anne-Marie's style of New York down in Washington, do you think they can take that?
Of course they can.
See.
I mean, come
We'll
on.
see.
You think
We'll
that they're
see.
such lightweights down in Washington, D.C.?
I think they're lightweights compared to what takes place up here, don't you?
Well, I mean, the gloves come off here.
Sit
I mean,
on
if
the
you ride the
fence.
subway, honestly,
Sit
I
on
think
the fence.
it's a different kind of gloves coming off in
Gloves
Washington,
coming
D.C.
off,
than here.
waking up at 8:30 compared to getting up at 6. It's a different world. Come on.
I'm still trying to recall the governor and replace it with a movie star, you guys.
There you go. Thank you, Taylor.
Honestly, I don't know. I think New York tough is, there's a soft underneath that.
All right. I'll take your word for it. We'll catch up with Peter Cheer on what's happening down in Washington, D.C. and get his view on what it means for New York in the markets on Wall Street. We'll do that in about 30 minutes. Before we get there, we need to catch up with Bill Dunkley, too, the former New York Fed president. Looking forward to that. Equity futures up 21 on the S&P, 42.52, up 0.5%. Yields unchanged, 148.68. Wasn't an insult of New York, Lisa. I'm with New York.
Yeah.
Been here, I'm very much New York.
Yeah, you love how clean the streets are?
I love New York.
I know
Don't even try and frame things that way. 42.52. This is my home. This is Bloomberg.
Welcome home.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
From New York City, live on TV and radio for our audience worldwide, here's the price action this Thursday morning. About an hour away from jobless claims in America. Equity futures drifting higher, 42.51, up 20. We advance 0.5%. A nice move on the S&P. The Nasdaq too, we advance there almost 0.6%. Keep in mind, just away from an all-time high, a couple of inches away, 42.57 is the intraday all-time high, the S&P 500. One to watch once we get the cash open a little bit later. In the bond market, 2s, 10s and 30s. In your bond market, we look a little something like this. A summer Thursday feel to a bond market with yields pretty much unchanged through the curve. Your 10-year 148.85, unchanged there on 30s too at 2.1090%. Let's get to something that has changed in the last 30 minutes. It's the shape of sterling, cable, the pound against the US dollar, a gap lower. The pound right now 139.18. If you were positioning for a hawkish surprise, maybe you got a surprise. For everyone else, it's more of the same. That transitory theme coming from the Bank of England, and it's bye-bye to the Bank of England chief economist. Overall size of the asset purchase programme. The rest of the Bank of England say farewell, good riddance, maybe, not my view, just perhaps, some people thinking it at least. The pound right now 139.14. Taylor Riggs with some stocks this morning. Hey, Taylor.
You know, John, we got some interesting comments yesterday from Barry Sternlicht talking about the peak hype cycle. And of course, some of that comes, as he mentions, Clover Health and some of the other SPACs, and just terms of the money sloshing around in the system. So I'm taking a look at Clover Health. I'm also taking a look at some other of the meme stocks, Sundial and Torchlight Energy, which we cannot stop talking about given the wild swings that we continue to see. And of course, stories out this morning that fundamental managers who sold GameStop, well, maybe some of them are regretting it, given the massive run-up that we continue to see. And so those are shares that we continue to follow. Let's take a look, though, at some of the other fundamental stories. We have to talk about the reopening and MGM, where we are on that upgrade to a buy at Deutsche Bank with a $54 price target. Tesla's also a fundamental story here. You're getting a lot of competition from Porsche, Audi, Mercedes coming and making an aggressive push in that EV space. Regions Financials, of course, with the Fed stress test for the big banks. What does it mean for some of the regional players, given the massive underperformance that we've seen in June? That reverses this morning as we're up 0.6%. And can we talk about Beyond Meat? John, I have very interesting comments on this. Duncan said that they still are selling some of the breakfast sausages.
Okay.
JP Morgan saying that their checks showed that there weren't the Beyond Meat breakfast sausages. I'm a Beyond Meat fan, I think, but I'm not sure how I feel about the breakfast sausage.
So just walk me through this. Are we struggling to track whether they're still selling the Beyond Meat breakfast sausage?
Yes, and there's also like a Taco Bell plant-based thing going on. It's a very, very delicate debate.
Lovely. Do you eat Taco Bell?
I do.
You do? Okay.
Yes.
Good to know.
So does John.
Meat, down by 1.3%. Do I?
Yeah, I often see you there.
Yes, of course.
Yeah, of course.
Yes, I do. Are we paid by? No, we're not. No, I don't. Joining us now, Bill Dudley. I'm pleased to say the Bloomberg opinion columnist, Princeton University senior research scholar, and former New York Fed president joins us too. Bill, it's good to catch up with you. And I enjoy your pieces, and your piece out this morning. It's a little bit technical, but I want you to run through things. When the Bank of England comes out with a rate decision, bank rate means a lot for a lot of people in the UK, for business loans, for mortgages. The Fed funds rate is a different beast, and you're pushing back against the continued use of targeting the Fed funds rate and using it almost, Bill. Can you just walk me through the thinking here?
Well, the federal funds rate used to be important because reserves in the banking system were quite scarce, and so banks had to trade the federal funds rate, federal funds between themselves to satisfy the reserve requirements. That's not the situation today. The banking system's awash in reserves as the Federal Reserve continues to buy $120 billion of treasuries and agency mortgage-backed securities. So the federal funds market's become very different, very much smaller and much more idiosyncratic than it has been in the past. The motivation for this piece was the fact that the Fed last week had to make a technical adjustment to two short-term interest rates, the rate they pay on overnight reverse repurchase agreements and the interest rate they pay on reserves, 5 basis points each. Why? To supposedly keep the federal funds rate closer to the middle of its target range. Why are we targeting the federal funds rate in the first place at this point? It's no longer an important market. The Fed has the ability just to pay the interest on reserves. Why not ditch the federal funds rate target and just set the interest rate on reserves at the level that's appropriate with the monetary conditions that the Fed seeks to accomplish?
Well, that's your simple solution. In your words, 3 words, drop the target. Bill, could you anticipate a communication issue around doing that if they were to do that this year?
I think they could explain it very easily. They would no longer have to make these technical adjustments that I think are more confusing than illuminating. Also, another thing that they need to do is exempt reserves from the leverage ratio. As they add more reserves to the banking system, that's putting downward pressure on rates. The whole reason why they had to make this technical adjustment to the federal fund, to these two interest rates, push the federal funds rate up, was the fact that they're flooding the banking system with reserves. And banks don't want the reserves because of the leverage ratio, which is starting to bind as a capital requirement for banks.
And
so if you exempt reserves from the leverage ratio, then that problem goes away as well.
And Bill, you're talking about the glut of deposits that you're seeing on some of the bank books, with some banks even saying to their corporate clients, we don't even want your money because it is getting to be excessive. Just taking a step back, how much is the change that you're proposing evidence that we're going to remain in this environment with a system awash in cash and the Federal Reserve pumping money continually into it, even though there is so much cash? How much is it just sort of an acknowledgement of that reality over the near and frankly, not even that near term?
Well, I think that we're going to be in a system where there's lots of reserves in the banking system for some time to come. First of all, the Fed's not going to stop their asset purchases quickly. It's probably going to continue well into the fall. So the balance sheet's going to continue to grow. The amount of reserves in the banking system are going to continue to grow. And then when it finally decides to start to normalize its balance sheet, the balance sheet is so big now, it's going to take a long time to get it back to, the $1.5 trillion of excess reserves that we had prior to the pandemic. So I think we have a system where the interest rate the Fed pays on reserves is the primary tool of monetary policy. Let's acknowledge that.
I understand, Bill, the argument that the Fed wants to continue with their very easy money policies, just simply to allow inflation to pick up and allow employment to get to a better place. However, people have pointed to certain frothier areas, in the mortgage market in particular. Do you think it's advisable? Do you think that it would harm the progress that the Fed is allowing to happen in the economy for them to pare back on some of the mortgage debt purchases that they make every month?
I think it would have an effect more on expectations about future monetary policy. We tell the market the Fed has now acknowledged that they've made substantial further progress towards their goals. And so people would change their expectations of the timing of tightening. So I don't think it would be that important in the narrowness of the housing market. I think it would be quite important as a signal of monetary policy and the timing of tightening of monetary policy.
Is that the preferred method versus...
So I don't think they're going to do it. I don't think they're going to do it. I think they're going to be pretty patient here.
What about perhaps maybe more of an equal weighting taper? I think a la December 2013 and a discussion of $5 billion in treasuries, $5 billion in MBS. Is that just more of an easy path to go?
Well, I think that you have a template from the last cycle. And so to deviate from that template, you have to have a really good reason. I don't think they have a really good reason. I think if they deviate from what they did last time, just raises a bunch of questions. What are you concerned about? Why aren't you following the game plan that you followed last time?
What did we learn from last time around, Bill? the lessons of the last time we reduced asset purchases and eventually actually had some balance sheet reduction several years later?
Well, I think it went, in all fairness, quite smoothly once the Fed communicated clearly about what the sequence was going to be. First, we stopped the asset purchases. We tapered the asset purchases down. Then we raised short-term rates, and then we finally start to normalize the size of the balance sheet. So this time, the market has a template to look at. Last time they didn't, and so there was a lot more uncertainty about what the Fed was going to do in the last cycle compared to this cycle. I think it's one reason why the markets are pretty comfortable with what the Fed's up to.
Do you think that there's too much Fed speak at this point? We've been talking about how there's very little dissent, and there basically is a Fed official every hour speaking.
Well, there's always probably too much Fed speak. I mean, the thing to pay attention to is really the chairman, the vice chairman of the Board of Governors, and the vice chairman of the Federal Open Market Committee. So Powell, Clarida, and Williams.
Bill,
what they say really.
In. Are you saying ignore the Fed presidents when they go around doing speeches?
Yes.
I wouldn't say ignore the Fed presidents, but put a lot less weight on them because they're just one member of the committee. I mean, the big three set the agenda for the Federal Market Committee. The committee's not going to do something if those three people aren't on board. So it's about weight. Don't ignore the presidents, but don't put too much weight on what one individual president might say.
Bill, just how much they influence the conversation inside the Federal Reserve when you have those FOMC meetings, when you had the likes of Plosser, Fisher really pushing back at the turn of the last crisis, going through the recovery. Just how much do they influence the conversation?
I think they influence the conversation because they offer a different perspective, and I think diversity of views is actually important. Diversity of backgrounds is actually important in terms of getting good monetary policy making. But at the end of the day, the committee is going to go where the consensus is. So if someone's always dissenting, they sort of marginalize themselves because they're not relevant in terms of figuring out where's the committee going to go in the future. Right now, there's a lot of disagreement about when should we start to taper asset purchases because people are uncertain about the state of the recovery and how fast will it cut into unused labor resources. There's quite a bit of disagreement right now about timing. But the people that matter are Williams, Clarida, and of course Powell, because they're the ones who are going to determine the ultimate timing.
Hey, Bill, it's good to catch up, as always. Good to see you. Great piece, too. Available on Bloomberg.com and on the Bloomberg terminal. Bill Dudley there, Bloomberg opinion columnist and former New York Fed president. Just a little bit of insight there, Lisa, into the inner workings of the Federal Reserve.
And this is the reason why markets are shrugging off some of the more hawkish dots from last week's Fed meeting. Basically, people are saying that wasn't Fed Chair Jay Powell. It was not John Williams from the New York Fed. It wasn't Rich Clarida. So we don't have to pay attention to those dots. My question is, what is the purpose of all these Fed presidents, the regional Fed presidents, coming out and having a more hawkish tilt, warning about froth, warning about potential upside surprises to inflation, if everyone just ignores them anyway, if basically it is going to be a Fed Chair Powell and nobody else?
I think some healthy dissent is important. Are we getting that now from this Federal Reserve? I remember one interview with Jim Bullard, I think it was out on CNBC in the last couple of months, where he almost said that he was waiting for Chairman Powell to start the conversation about tapering. They are waiting for the chairman to almost cue what they can and can't talk about.
Do you think that that's what it is, internal pressure, or do you think that they don't want to rattle markets too much and then push the goals further out? I mean, the idea here that markets get very concerned by any hawkish tilt, even if it's a dot, the fact that there was that sort of flattening in the yield curve does get people's attention. But still, is this what counts as dissent?
I don't know. Look, I will say in a world where you've just spent the last couple of years talking about this brand new framework, your hands are tied to some degree. So maybe that's why this defense of this more hawkish stance is just a little bit more muted than it otherwise be. Though I have to say, Lisa, it's got louder in the last couple of weeks. It's Bostic, Bullard, Kaplan, just again and again and again. 42.51 on the S&P, advancing 0.5%. Lisa Brambridge, Taylor Riggs, Jonathan Ferro, Tom Keene back on Monday. Equities pushing all-time highs, up 0.5% on the S&P. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden is traveling to North Carolina today to encourage more Americans to get the COVID-19 vaccine. His trip to Raleigh comes 10 days before July 4th. The president's stated target date to see at least 70% of adult Americans at least partially vaccinated. The CDC says that so far, slightly more than 65% of U.S. adults have had at least one dose. The Chinese Defense Ministry says that exercises by the People's Liberation Army aircraft in the Taiwan Strait are a necessary response to a regional security situation. There was no elaboration. During a briefing in Beijing, a Defense Ministry spokesman urged the US and other countries to abandon what he called a Cold War mentality and to stop talking about a Chinese military threat. Authorities in Sydney are rejecting calls from some health experts for Australia's most populous city to enter lockdown to control an outbreak of the Delta strain, the strain first identified in India. That's despite case numbers almost doubling to 31 over the past 2 days alone. The world's biggest maker of Bitcoin mining rigs is suspending sales of machines for spot delivery, hoping to prop up the prices. Bitmain Technologies says it stopped selling new equipment after prices for top-tier rigs plunged by about 75% since April. China's crackdown on crypto mining is causing miners to abandon their operations and dump machines on the market. Global News 24 hours a day, on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The conversation about crypto is a minor percent of any dialogue we have with any company worldwide. It's just not terribly important. Could crypto become a really important asset class one day? Sure. If there was a digital dollar or a true digital yuan, that will change however, that would be much more impactful than any other, like a crypto.
Fink there. Larry Fink, the BlackRock chairman and CEO from New York City this morning. Good morning. Alongside Lisa Abramowitz and Taylor Riggs, I'm Jonathan Ferro. Tom Keene out of the building. Here's the price action. Equity futures. 42.51, up 20 on the S&P. We advance 0.5%. Euro dollar 119.40. We advance about 0.1% there. Slightly stronger euro. Business confidence out of Europe this morning. French business confidence, German business confidence. It gets better. Outside of that, in the bond market, yields unchanged, 148.85 on a 10-year, unchanged. If I was to tell you 12 months ago, this is where we'd be with international travel, I think you might have questioned that. Lisa, if I was to tell you 12 months ago, this would where we'd be with UK travel, even with these kind of numbers out of the UK. The Prime Minister speaking this morning, more than 60% of adults receiving 2 COVID-19 vaccinations, 83% receiving at least one. And he talks about the opportunity. That's the operative word here, opportunity, the opportunity we all have now to open up travel through the double jab. I just can't believe we're not there yet.
I would agree, and I think that it's interesting to see places like Israel, which has one of the most vaccinated populations out there, just closing their borders to foreign travelers for even longer because of an increase in the Delta variant, even though the hospitalizations haven't picked up all that much. It just talks to this threshold, this fear that people have of COVID that perhaps goes beyond what we're seeing in the hospital system.
The airline business right now is just really tough for international travel. We've talked about that a million times over the last couple of months. For domestic travel, that was meant to be the support, Taylor, the support for the likes of American Airlines. American Airlines have been aggressive about putting capacity back on, and we've seen it continuously over the last couple of weeks. American Airlines have had to cancel flights
Yes.
because they can't get the staff, Taylor.
You know, John, we spoke with the Southwest CEO on the close yesterday, and I brought up American Delta trying to scramble to hire 1,000 pilots. He literally says that they can't bring workers back fast enough. Some of this, of course, is not just the airline industry. This is a broad U.S. global issue of a labor shortage, trying to bring labor workers back into the workforce. But it really speaks to the travel industry specifically, John, about how quickly demand came back. Perhaps maybe we were caught off guard just a little bit, though everything I'd read said this was going to be the roaring 20s. Brace yourself.
Yeah, Taylor, you make the good point, though. This is just one case study, one example of a much bigger, broader story, particularly for the U.S. economy. And Lisa, we've asked continuously, when do we start to address these issues? Well, the answer to that is right now. My question is, when do we resolve them? When do we start to see real signs that they're being resolved? Is that the end of August, deeper through summer, beginning of September, maybe later?
You've talked about humility, and we heard the same kind of tone out of Fed Chair Jay Powell. The uncertainty, as Tom says, make it up. They are making it up because we don't even understand why there is this friction in the labor market. I mean, do you buy this idea that it is childcare? Do you buy the idea that it is a skills mismatch? Or do you buy the idea that it's because people are getting enhanced unemployment benefits and want to just stay home? I think that the evidence is really unclear exactly what the main driver is, probably a little bit of all.
Oh, September's the date in the diary then, right? When the kids go back to school?
It's my date in the diary.
The additional UI expires. That's when we're going to find out.
You know, John? Yeah. All I know is my cauliflower rice at Chipotle is up 5% because they have to pass on the costs from higher wages.
But is that a one-off shift in the price level or the beginning of something more persistent?
If it's transitory, they wouldn't be passing on permanent price increases.
No, that's not the definition of
consumer.
transitory. That's a one-off change in the price level. Persistent would be if that was to happen again and again and again.
It's a
Is
rate
this
of
just
change.
a one-off change in a price level or the beginning of something more persistent?
It's a rate of change question. And actually, speaking exactly to that rate of change question, there was a story on the Bloomberg today about used car prices and how actually they are poised to decelerate. Yes, they're going to still be increasing, but not at the same pace as some of the supply chain kinks get worked out. I mean, to that point, John, that would seem to confirm the transitory idea.
42.52 on the S&P 500 this morning, getting close to all-time highs. It's the same debate. It's value versus growth, growth versus value, banks versus tech. Take your pick, any flavour. Let's bring in Dave Wilson, a Bloomberg stocks editor, for more with his chart of the day. Morning, Dave. Run us through it.
Well, what we're talking about here, John, is correlation between the S&P 500 pure growth and pure value indexes. So you're talking about a subset of the broader S&P 500, specifically companies that best fit into these growth and value categories. Now, we've certainly seen some back and forth over the past year or so. Value stocks kind of taking the lead for a while as, we got back from the lows of March of last year. And more recently, in the past month or so, it's been a bit of a shift toward growth. And what you get out of that is that, the correlation just isn't there the way it has been historically. In fact, you're looking at the lowest level since October 2000 in terms of the relationship between these pure growth and pure value indexes. So it really does matter more than it has for more than 20 years which way you go when it comes to the growth versus value argument. And that really plays out, when you look at, say, the past 3 years, you've got to try to basically pure growth and pure value track each other until the lows of last year, and then things kind of start going their own way.
All right, so what is the why behind this? Is this an idea that a lot of fund managers come on and say, which is it's time to be a stock picker? Is this the idea that the rotation under the hood of the equity indexes has been abnormally significant?
Well, perhaps more of the rotation, because you have to go back more than a decade to really see the last time the value stocks kind of led the way. And, arguably more recently, that's been flipped on its head a bit. We've seen a return to growth. I mean, still value one of the best performers on the year if you look at, various factors that people pay attention to when it comes to investing. That said, I mean, with the turnaround we've seen more lately, again, you kind of get value and growth each going their own way as opposed to moving together, which has been the tendency over time.
Dave, good to catch up. Really interesting stuff, and that debate continues. I'll catch up with Jonathan Golub of Credit Suisse and Savita Subramaniam of Bank of America a little bit later about clinking onto that idea that the cyclicals can outperform from here. And also, we need to talk about the fiscal plan down in D.C., or the lack thereof, Lisa. Peter Cheer running much of what is driving the market could be linked to doubt about the size and effectiveness of fiscal stimulus. Pete's going to join us in about 5 minutes, Lisa.
Yeah, but what's weird? Whenever I ask people about this, they all say it's not priced in, any kind of fiscal stimulus. So if this is the disappointment, then it has been priced in. And if it's not priced in, then are we taking also tax hikes off the table, which also could be a potential downside risk to stocks?
Oh, so it's bullish or bearish? Which one is it?
I'm going to stay with bearish on both sides.
Okay, fantastic. Thank you.
I'm going to be consistent, true to form.
I am not shocked. Nobody is.
Well, I mean, honestly, you've got the fiscal stimulus on one side. People say that people haven't priced in the boost. And on the flip side, people say that they've priced in the potential negative drag from higher taxes. So actually,
yeah.
Could it be a bullish surprise?
Okay.
Look at that.
Thank you, I think. The wonderful Lisa Bravitz, Taylor Riggs, and Jonathan Ferro. TK's back with us on Monday, taking a well-earned long weekend. 42.51 on the S&P 500, advancing about 20. We're up 0.5% this Thursday morning. 35 minutes away from jobless claims in America. We'll run through the economic data for you a little bit later in the next hour. For our audience worldwide on radio and TV, this is Bloomberg.
Morning was a bit of a historic day. It was the first time Indigenous designers showcased at Australian Fashion Week, and it was a full house of all Indigenous talent.
It made me so proud. Absolutely beautifully done. I mean, the designers, the pieces on there. I think just about every model or every second model was like, oh, I want that, I want that. So each of my pieces, we have our signature prints, which are each tell a story and is definitely a contemporary way of experiencing Aboriginal culture. And then each of my pieces are named after, inspiring Aboriginal and Torres Strait Islander women. So when the customer buys something, they're learning about the story, they're learning about women. I would hope that it isn't tokenistic, and I would hope that it's not done to tick a box. And so, those things you have to be mindful about that. But I think it's incredible what's been achieved so far, but, there's always room for growth. I think the elevation of Aboriginal and Torres Strait Islander people in these spaces, it's long overdue, and it's a really powerful and incredible time, I think, and to be a part of that is really special.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
The bump in the road is the road to recovery and inflation.
Powell is very optimistic that we are going to get a robust labor market recovery, that inflation will be contained.
I'm not surprised also to hear the language of Fed Chair Jay Powell. They're committed to going at this gradually.
What they don't want to do is take a dramatic and drastic action to really result in a sharp shift.
He's just been saying essentially, wait, look, and we'll respond if we need to, but there ain't no inflation problem.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Lisa Abramowitz and Taylor Riggs. I'm Jonathan Ferro. TK taking a long weekend. He'll be back with us on a Monday. Looking at the price action right now, 42.52, advancing 21 points on the S&P 500. Lisa, your takeout last week, it's as you were.
I mean, honestly, it's amazing to me that we're finding that the melt up into new highs is just basically treated with a shrug. But it's just same old at this point, given the fact that people have faith that the Fed is going to keep on hold for the foreseeable future.
And we are desensitized from all-time highs, seemingly, Taylor, once again this morning.
Unbelievable, the resiliency of these markets, the inflush of cash every time there's a pullback, the calm with the 15 print on the VIX, and John, the calm within the bond markets, despite all the ups and downs that we've had in the last week, a very, very well-behaved bond market below a 150 on the 10-year.
We've settled down in and around 150, just south of that on the 10-year, Taylor. Let's get to the price action right now. 42.53 in sight on the S&P 500, 42.57, your intraday all-time high on the S&P. We advance 0.5% this Thursday morning, about 29 minutes away from jobless claims in America. Yields unchanged, as Taylor points out, 148.51 on a 10-year yield. In the FX market, sterling with a gap lower off the back of a Bank of England decision, unchanged. No hawkish surprise there. Sterling weaker, euro firmer. Euro dollar 119.33, stronger by almost 0.1%. The price action elsewhere, though, Lisa, it's been pretty muted, to be fair, the last couple of days.
It's been pretty muted. I will say the most interesting moves have been in lumber, where you've seen the price come down significantly. significantly in copper, where you also have seen the price come down, some of the deceleration in the price increases that have led to a lot of the inflation. And I wonder how much that's coloring the view that's being expressed by the bond market.
And deceleration in growth on the horizon too. Lisa, we've been talking about that for a while on this show. At some point in 21, you start to think about 22 and 23. Pretty quickly, I think we're already doing that.
And I think that the idea that the people are not worried about the Fed taking a hawkish tilt really puts in the forefront a deceleration in growth, peak growth kinds of fears as being the main potential risk to markets right now, to equities at all-time highs.
And the uncertainty around the fiscal outlook, not just the monetary policy outlook as well. Peter Cheer of Academy Securities writing about that recently. I want to bring in Pete now for more. Peter Cheer of Academy, the head of macro strategy. Pete, let's just start there. The uncertainty around the fiscal program, the fiscal effort down in Washington, how important is that for what we're seeing play out in this market?
I think it's actually incredibly important. When you look at bond yields, right, people have been talking about the impact the Fed has had, but when you started seeing doubt about how big the fiscal stimulus is going to be, that's when you started seeing bond yields come down. So that to me is a concern. I guess there's some hopeful news overnight, but the packages seem smaller and taking longer to implement than I would have liked to see, though I'm still quite positive on growth, but really the fiscal story is probably as important as what's going on with the Fed and just not getting enough attention.
Pete, do you think that's what's holding back this bond market, keeping a lid on things at 148.51 on 10s?
Yeah, if you go back 3-4 months ago, I think people were expecting $2 trillion, $3 trillion potentially of long-dated bonds being issued to support a big fiscal stimulus. That's kind of off the table right now, right? We're already down to talking about $1 trillion. The bond market can digest that. So I think it's less supply is helping the bond market, and a little bit of concern that the growth isn't going to be quite as good as they wanted. I think it's going to turn out to be good, but that's being priced in as that doubt right now.
So, Peter, when I speak to fund managers and they say that a fiscal stimulus hasn't been priced in yet and that anything would be an upside surprise, is that hogwash?
I think it's not being priced into the economy. I think it's being priced into the markets, if that makes any sense. So I think we haven't seen the job creation yet. One concern and one thing we're looking at, right, is we have this jobs, quote unquote, problem right now where we already have a lot of unfilled jobs. So some of this infrastructure spending, which would have been very good at creating jobs, how good is that if we can't fill those jobs? So I'm hoping as we end the summer, as some of these, stimulus checks and also more importantly, as schools fully reopen so people can get back to the workforce, we'll see that, gap between the number of jobs available and the number of people wanting to work close, because that's going to be critical for growth next year.
Amen to the schools point. There is a question about whether what you're saying is an argument for big tech, because not only do you not necessarily get the increase in interest rates, so this actually does bleed into the argument to buy them as a steady cash flow, but it also takes off the table perhaps some of the tax rate hikes that people were talking about that would disproportionately affect big tech.
I think the concern I still have is that on big tech, this minimum tax, I think, is the way this administration is trying to go. They're really not going to focus as much on the statutory rate and the effective rate. So I think that could impact big tech. And I think we are going to ultimately start seeing higher yields because I don't think the inflation's gone away story is at all correct. And I know today people are talking about lumber and all these other things. I think the biggest inflation news is us, as a country going after the China solar providers, right? I think we are going to see more and more scrutiny into supply chains, what our suppliers look like, and we're going to find that either they're not up to our standards in terms of how they treat the employees, how they treat, sustainability, and that is going to be inflationary, whether they increase their costs or we have to find new suppliers. So I think that's the story that's going to drive inflation. And looking at, commodity prices is one thing, but that's going to be the long-term inflationary, driver is this push towards ESG and real scrutiny of supply chains.
So settle the debate for us. John and I were chatting earlier. My cauliflower rice at Chipotle has gone up 5%. They're raising prices, passing those on to the consumers. Are these one-off events, or is this going to be a series of further price increases, that rate of change that we continue to talk about?
I think it's going to be, ongoing. I think when people talk about peak growth, okay, sure, we might hit peak growth, but we might get 6% next year, 5% the year after. That's going to be plenty inflationary. And if this is really tied to job creation and bringing back jobs, this pressure to make everything sustainable, I think you're going to see price pressures along the board. And right now, again, when I look at sustainability, that is one of the reasons I think we're going to see price pressures is the belief that customers can pay those prices and will pay those prices, right? You like the cauliflower rice, it's very popular. People are going to pay those. So I think that's not a one-time trend. I think this is ongoing.
Are we then peak margins?
That might be closer to, but again, and so I think we're peak margins in some ways, but what I'm seeing when we talk to large corporations is you might be able to give up some profitability, and if you're deemed as more sustainable, right? If you fit that ESG mandate, your PE ratio can still go higher because there is such demand for that. So I think the focus is on your final stock price. Maybe you can actually have a higher stock price with smaller margins, especially if you're pushing into that whole sustainability ESG area that's attracting both consumers and investors.
I don't have a view on this. I want to be very clear about what I'm trying to explain. And Pete, please weigh in. There is a difference between a one-off change being permanent. You can still say that things are transient because what you're talking about is the rate of change being transitory, that these levels will not persist over time. And I think those two concepts, Pete, get confused.
Yes, and if we go back to the cauliflower rice, we might not see another hike in that for 2 years, but it doesn't mean that something else isn't going to get hiked next month or the month after. So I think there's just the sustained pressure, and you are starting to see wage inflation, right? You're seeing people demand higher wages, and that's going to continue. And even when you look at lumber, it's probably still up 20%. So that's a massive, massive gain, right? If you think about 3% inflation as the target, you've just covered still probably 5 years worth of inflation. So let's not get overly, worked up about the current moves. I just think this is going to be very, very persistent. You're going to see prices continue to move up, and it's going to be on the things that we consume. I think that's one of the other big issues that we all face is how do we actually measure inflation and, what values are worthwhile and what's affecting our day-to-day life. And I would say right now, inflation is off the charts in what most of us actually buy.
Let's talk about what it means for credit, Pete, your world. This was from Manny Roman at PIMCO, speaking to us in the last 24 hours. In March 2020, you had real opportunity in high yield and private credit. It's been very good. There were special situations. A lot of it has played out. This early in the recovery, a lot of the spread tightening has played out. Just how different is this moment, Pete, compared to recoveries that gone by?
Listen, I think credit is actually fine right here. So, we have CDXIG investment grade CDS index trading at 50 basis points. That traded as low as 29 pre-financial crisis. I see no reason that doesn't get back to the mid-30s. It's kind of boring because you'd like to see the volatility. You'd like to see high yield get volatile. But even last week, I thought it was really important that credit spreads as a whole did fine. You had equity volatility all over the place. You had crypto moving all over the place. You even had these massive bond moves. But credit as a whole did very fine. And I think it's a little bit depressing when you talk to the active managers. Everyone likes things to go wide. You'd like to get the big shorts on. But the reality is I think it's a very boring market. Companies are very, very comfortably priced on credit. There's so much of an equity buffer for these companies. There's so much money coming into the markets. You're seeing corporations defeasing their pension plans by selling equities to buy bonds. So I think almost as dumb as it sounds to say, at 50 basis points, you're supposed to be long credit. Take the summer off and watch it tighten. It doesn't sound sexy. It doesn't sound fun. But I think, sadly, that's the right trade right now. Credit is very, very stable and should continue to grind tighter.
Hey, boring is good compared to what people expected to happen. Pete, it's good to catch up. It's good to see you in the studio too. Peter Cheer there, Academy Securities Head of Macro Strategy. Boring is not what people were looking for 9 months ago, Lisa.
No, and that is what they have gotten. I will just say, to edify Pete's point, there was a deal that caught my attention overnight. It was a gun accessories maker called Magpul Industries, and they were trying to sell $250 million of debt in order to pay a dividend to their private equity sponsors. They pulled the deal. And yes, this might be because of ESG considerations, but it also is because people are pushing back. This is discretion in markets, even at these really tight spreads.
Where are spreads right now?
They're at 280, yes.
It's tightest since 07.
Correct.
Isn't it crazy?
It is insane.
That at this start of the recovery, this close to the beginning of the recovery, and we're already there.
So Howard Marks of Oaktree has sounded the alarm before on high yield valuations. And recently he came on Bloomberg Television and he said, unfortunately, this makes sense. And unfortunately not for the economy, because for the economy, if you can borrow money for cheaply, that's good. But unfortunately for investors who are not going to be getting that much and who probably can't afford to sell.
The man himself, Howard Marks. When did you catch up with him? Last week?
Yeah, last week.
I should go back and watch that interview.
Well, it was interesting to hear how he, who wants to stress opportunities, who wants to talk down valuation, says, look, we can't find a reason for this to sell off, especially with the Fed continuing the easy money policies. And frankly, with the cash flow just rushing in.
Yeah. Unreal. Lisa Bravitz, Taylor Riggs, Jonathan Ferro. Tom King back with us on Monday. Equities closing in on record highs, up 21 on the S&P, up 0.5%, and just a shrug from so many people as this takes place. 42.52 on the S&P 500 from New York City this morning. Good morning. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Prime Minister Boris Johnson's government is to convene a London summit to help tackle the lagging COVID-19 vaccination rate in the UK's capital. The latest numbers show that 60% of Londoners have had at least one dose of the vaccine, compared with 73 to 79% across England's other regions. There's been a surge in Delta variant cases in the UK, though daily fatalities remain low. Queen Elizabeth II's income was hit hard by the pandemic as lockdowns and travel restrictions led to a 53% drop in income from tourists visiting royal palaces. Annual accounts show that without places like Buckingham Palace and Windsor Castle open to visitors, the sovereign's income was cut to $13.1 million in the time period measured. That's down from a little more than $28 million a year earlier. And China has filed a lawsuit against Australia at the World Trade Organization over anti-dumping measures on some Chinese goods. The measure in question targets Chinese products, including wind towers and stainless steel sinks. Earlier this week, Australia said it would appeal duties imposed by China on its wine exports. And Bloomberg has learned that Hong Kong's Lala Move has filed confidentially for a US IPO, with Topper Logistics and delivery firm is looking to raise at least $1 billion in the share sale. Lala Move provides on-demand van hailing and courier services across Asia, Latin America, and the US. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
I think what we've seen during this period of time is that
Communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The U.S. economy is really on fire. Almost everything is growing much faster. We've had almost a perfect storm here of massive government spending, central bank accommodation, record low interest rates, and that's a recipe to really power an economy.
That was Stephen Schwarzman there, the Blackstone CEO from New York City this morning. Good morning. Alongside me, Lisa Abramowitz, Taylor Riggs, Tom Keene will be back with us on Monday. I'm Jonathan Ferro. Here's the price action for you. Kicking things off this Thursday morning, approaching jobless claims in America, 12 minutes away. Equity futures up 21 to 42.52, advancing about 0.5%. Euro dollar firmer by a little more than a tenth. Euro 119.39 against the US dollar. And yields unchanged, 148.35. Can we call it a snooze, Lisa Abramowitz? Maybe we can in the bond market.
We can in the bond market. In stocks, it's snoozing up to record highs. But in bonds, it is stasis. That's all I can say.
Getting a headline from Senator Portman. He says Manchin is supportive of the infrastructure package on offer. We're making a step forward here, Lisa, around infrastructure talks.
That's been the idea here, the golden ticket we were hearing about earlier today, meeting with President Biden, the group of bipartisan senators. The question is, $559 billion, is that the end or is that the beginning of the fiscal spending we can expect over the next 2 years?
Let's bring in Terry Haynes, shall we? Pangea Policy Foundry joins us right now. Terry, let's start there. What we can expect, as far as you're concerned, down in D.C. on the fiscal front?
What we can expect, firstly, is a touted roughly $1 trillion infrastructure package, like the one I've been talking about for the last month or so, of which, as Lisa says, about $559 billion is new spending. Brings up a dichotomy for markets, by the way. You'll hear Washington pump high numbers, but then a lot of it isn't new spending, and that's important to understand. The last COVID relief bill, for example, touted as $2 trillion, but only $1 trillion is going to get spent this year. The rest run out over the next 8 years. So you're going to get that. Are you going to get much of anything else at this point? I really doubt it. The so-called families plan, another couple of $1 trillion, I think is going to be very difficult to pass, even with all Democratic votes. And then what you're into is, you're into spending, which is going to be largely flat into next year, and you've got the debt ceiling as a potential surprise. But Washington's attention is going to be taken up between now and the end of September, a time in which the House and the Senate are roughly in only one out of those next 3 months, with getting the infrastructure bill done and otherwise partisan warfare about all the other stuff I just mentioned.
As we talk about $559 billion of new spending, Terry, how much political momentum is there behind balancing the budget, behind raising taxes or cutting spending ahead of that August debt deficit ceiling?
Oh, none. Both parties talk about debt and deficit when it suits them. Democrats did over the 4 years of the previous administration, but in reality, where the parties tend to come together, and as we've seen, is on spending things. COVID is a money spender. The China bill was a money spender. Those things are money spenders, and the parties come together around those things. But most of the rest of it, I think federal spending is going to be largely flat, as I say. But the rest of it, they will fight over. But I don't think you're going to see anything beyond the infrastructure package today, anyway.
Terry, where then is the momentum on how we're going to pay for all of this?
We're going to pay for it, Taylor? The devil's in the details on the infrastructure bill. I edged up my odds to 75% on infrastructure last night, but on the news, but I'll still give you 25% things fall apart. And one of the details here is that we don't exactly know how they're going to try to pay for it, and they say they are going to pay for it. And they say they're going to pay for it without tax increases. So there are not insubstantial difficulties here yet. And then I think what markets see is a deal solidifying. I mean, the likeliest scenario here. The markets will see a deal solidifying over the next week, but they'll see wrangling around this deal and passing it out of both houses through the month of July. So there's going to be a lot of volatility here, and one of the details that will cause that volatility is exactly how the thing is paid for.
And you don't worry about debt and deficits during wartime. When then should we begin to discuss it?
My view of this very simply is that unless Washington gets a market signal that there's too much debt or too much deficit, Washington is not going to heed a call. But my favorite example of this is the 2017 tax bill. And no disrespect to anybody who put that together, but understand that the red line for Republicans was they weren't going to go into deficit any more than $1.5 trillion over 10 years. Yeah. Now, when you're talking about how to manage a deficit increase, that's a sign that you're really not serious about bringing the deficit down, and that's the way Washington is these days, regardless of party.
Yeah, and Terry, if it weren't that way, people probably would be accusing it of not recognizing the reality we're in of pretty low bond yields. Since Tom Keene is not here, I'm going to channel him and talk about how close we are to the 2022 midterm elections. Is this fiscal package that we're seeing coalesce in Washington, D.C. going to be viewed as a win for the Republicans or a win for the Democrats?
Yes. The answer to that is yes. Infrastructure spending is bipartisan. Members of both parties want to see better roads, bridges, fundamental infrastructure. They all want to be able to go home and say that they did that. And the key for me at the same time will be seeing if they can goose them along more quickly. There's in my home state of Pennsylvania, there's been now a 10-year-long project just to redo 40 miles of old interstate. And if things are going to take that long, there's going to be a lot of frustration out there in the world. So one thing that they're going to need to do is goose their states along and make things go a lot more quickly in order to gain the maximum amount of political benefit out of it.
That's the best way of answering a Tom Keene question.
Yes. I'll take a note.
Terry, thank you. Terry Haynes, Fangea Policy Founder down in Washington, D.C. Just still, Lisa, an immense amount of uncertainty about the outlook here. I think there was a lot more conviction at the beginning of the year about what we would get from D.C., and now a lot of that's faded.
Although, if Terry Haynes is correct, and the headline number is $1 trillion. It's only $559 billion of new spending, but still you could say that the headline number is $1 trillion, and it does not come with tax hikes. Then is it a wash? If no one's going to pay for it.
I'm hearing you. Do you want me to answer?
Yeah, I mean, this is the issue, right? I mean, for market participants, how much does it matter if you don't have it offset? That's, to me, the issue. Yes, please answer.
Well, right now, I think the market's speaking for itself, isn't it? Just nothing. Tumbleweed in treasuries after a repricing over the last week, back to 148. Taylor, as you pointed out, comfortably below 150, just in and around that level now. We've settled down.
Unbelievable. A 15 handle on the VIX and is settling down within the bond markets, John, as you alluded to, despite some of the whipsaws we've seen on the long end of the curve. It was an average 5-year auction. I believe it was yesterday or 2 days ago. Very, very calm, even as we're thinking about how you get through a 5-year rate cycle hike with higher inflationary pressures. And there is still demand for some of that debt out there.
Jobless claims moments away in the United States of America. From New York City this morning, good morning. This is Bloomberg.
excluded from the workplace, especially when you've got skills and motivation and things to give, can have a really detrimental effect on people's well-being. They can become isolated, of course have the financial stress of not being able to support themselves. That might be their first entry into the broader community where you're building relationships with workmates, and so that's your exposure to culture and you're starting to feel like you belong.
Some people might need to practice their English more. They might just need just some practical experience in an Australian kitchen.
I have not from Australian friend now, but in the kitchen I have many friends.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
From New York City for our audience worldwide, live on TV and radio, this is Bloomberg Surveillance alongside Taylor Riggs and Lisa Abramowitz. I'm Jonathan Ferro. Tom Keene will be back with us on Monday, waiting for some economic data in America. As that starts to come out, let's just run through the price action briefly. 42.53 on the S&P 500, positive about 0.5%. Jobless claims coming in a bit firmer than expected. It's the wrong kind of upside surprise. 411,000 against an estimate of 380, just down from the previous month of 412. Waiting to see if we get a revision there, Lisa, but coming in just a little bit hotter than expected.
Yeah, and this to me is the conundrum. How much can we read into this data that has been incredibly messy? How much does this give us a true read on how many people are filing for jobless claims? Because if people really are looking at a tight labor market, why are we seeing 411,000 individuals filing anew?
Durable goods coming in a little bit lighter too, at positive 2.3%. We were looking for something closer to 2.8%, coming off the back of a previous read of negative 1.3%. Are we done with the big surprises in either direction, do you think now, Lisa, as we work our way through the initial reopening?
When you look at the surprise index from Citigroup, it does seem like that is the case. We're getting to a more normal state. The question is whether we've gotten to peak surprise upside, right? The idea being 10-year yields ticking lower on the heels of this. No drama, though. But still, this idea here of peak growth kind of getting eked into this data.
Did we get a move in a bond market of like half a basis point?
Half a basis point. It was pretty dramatic.
148 on 10s. Taylor, you're pouring through the data too. Your take?
You know, you have a Federal Reserve that continues to focus on these labor markets. We heard from Jay Powell on Tuesdays. He continued to say, this was interesting, he expected the jobs market to be better in the last few payrolls report. And unfortunately, when you sort of get like a jobless claims of 411 versus 412 last week, it sort of reiterates that unchanged nature with the Federal Reserve really focused on the labor data.
Let's bring in Ira Jersey, shall we? Bloomberg Intelligence Chief US Rate Strategist. Ira, to begin with the economic data, your reaction, please.
Yeah, it's uneven, and I think that that's been a trend that we've seen over the last couple of months, and the bond market obviously doesn't like it when you have a slowing in the second derivative. So basically, you know, things are still in an upward trajectory, but they're not as quick maybe as they were in March and April of this year. And I'm looking at some of the durable goods numbers, and when you look at the revisions along with what we have, it's basically as expected. So, you know, even though the headline may have missed expectations, the fact is that we've had these upward revisions now that for the April data. So it's making it seem like it's more unchanged. As we get more and more of this, I think that the bond market is going to continue to be range bound, because people are going to wonder, hey, are we really in this upward trajectory for the long term or not? And that's going to be a big driving factor for Treasury yields.
We just got some more of the initial jobless claims data showing that the revised outlook from last week, the prior initial jobless claim was actually revised upwards. Again, the wrong kind of surprise, to 418,000 initial jobless claims. Ira, is there something deeper that we need to be taking from these numbers, especially as a number of states start to roll back some of the enhanced unemployment benefits, that the labor market really is not coming back as quickly as people said, and it has to do with something more pervasive, more persistent possibly, than simply just either matching people with jobs or reducing some of the employment benefits?
Well, I think it's a little bit of everything. So, more people are obviously being laid off, and part of that may just be that there's not work to be done. Where again, this is a very uneven recovery, right? Where we saw this big reopening and a lot of benefits from that reopening, but now that's fading. And keep in mind, the initial jobless claims are only half of the equation, right? So that's only how many people are being let go, not necessarily how many people are going to be rehired, because there are certainly a significant number of industries where you will continue to see big rehiring, particularly the hardest hit sectors. So as hotels and different entertainment and recreation functions, as those reopen, you'll continue to see probably growth there. But again, it's that second derivative. So while we already had some really large increases in employment in some of those sectors, the pace of growth in that those sectors in terms of jobs is going to start to slow just a little bit. And that's one of the reasons why I think a lot of markets are going to kind of be range bound for a little while until we get some clarity on exactly how far this recovery can go. And quite frankly, for the market anyway, for the bond market, the Federal Reserve turning more hawkish doesn't help the case for higher yields, because not so much because they're going to necessarily raise interest rates soon, but because as they talk more hawkishly, people are going to worry that they're going to make a policy mistake because of all the fragility that still exists in the general economy. And there's still a lot of demand for risk-free assets, even though the Federal Reserve might be pulling back on its asset purchases later this year or early next year.
Ira, always good to hear from you, sir. Ira Jersey there, Bloomberg Intelligence Chief U.S. Rate Strategist. Joining us now is Stephen Stanley, Amherst Pierpont Securities Chief Economist. Stephen, are you getting a clearer picture of the economic data at the moment with the incoming data over the last couple of weeks?
Well, I think the bottom line is, look, the economy, at least in the short term, is overheating. It started in housing, manufacturing now, certainly the labor market. I think basically demand has recovered faster than supply. Hopefully supply will catch up soon enough. But for the moment, that seems to be the overarching story.
You've demand catching up with supply. Quit rates are at an all-time high, and there's a record number of job openings. Is there a labor shortage, or is there a skills shortage?
Right now, there's a labor shortage. I mean, you look at who it is that's complaining, in terms of companies the most vehemently about not being able to hire people. And it's for the most part, it's firms on the lower end of the skill set. So I think it's really more a shortage of warm bodies at this point. And, for all the reasons that Chairman Powell and others have laid out, chances are that things are going to kind of ease up over the next few months as we move into the summer and then into the fall. I think things will start to normalize.
Stephen, we've seen a number of states throughout the United States reduce some of the enhanced unemployment benefits over the past few weeks. I'm wondering whether we have any preliminary data as to whether more people actually went out and got jobs, whether this actually eased some of the frictions we've been talking about.
Yeah, I think it's a little early yet. I did see anecdotally that there was a little bit of an uptick in inquiries on some of the job search sites in the states that announced that they were cutting the benefits early. But look, the federal benefits numbers lag by a few weeks, so we don't have any hard data yet for the states that have ended the benefits. We're probably not going to see it in the payroll data to any meaningful extent until the July numbers, which come out in early August, because the June survey period was the week before the first tranche of states cut the benefits. So I think it's a little early just yet. We may start to hear some anecdotes, but we're not going to get hard data on this for at least a few more weeks.
Stephen, your view right now on how this is playing out at the FOMC, do you think a lot of this makes sense?
Well, I think what we learned last week is that they've been surprised to the upside for both the economy and inflation, and they're kind of backpedaling a little bit from, their game plan coming into the year, which was to be on hold for a very long time. My guess is they're going to kind of be kept on that defensive stance. I think the inflation numbers are going to be high, at least for another month or two. I do expect that the labor market data are probably going to start to get incrementally better over the next few months. So I think they're going to continue to be surprised to the upside, and I think they're probably going to end up moving a little more quickly than they had originally envisioned.
What does that look like, Stephen, then, relative to what they envisioned?
Yeah, so my assumption at this point is that the taper announcement comes at the September FOMC meeting. They start to actually taper in October, which probably puts me about 3 months ahead of the consensus. And then I think, we get a rate hike around the middle of next year, which again, maybe puts me, 3 to 6 months ahead of certainly where the Fed is, and maybe a little ahead of the market consensus as well.
So, Stephen, how are they going to communicate that, given the fact that Jay Powell has reiterated his dovish stance, and it seems like just some of the regional Fed presidents, like Jim Bullard, agree with you that a 2022 rate hike is in the cards?
Yeah, well, right now, as Powell and others have indicated, they're really not focused on rates just yet. The first order of business is asset purchases. They have to begin to taper those, and I think most people on the committee would like to end asset purchases before they start to raise rates. So, to the extent that they're feeling like maybe they need to raise rates a little earlier, that argues for an earlier beginning to tapering and then a quicker process. And I think that's going to be a key difference between this time around and 2014. I don't think they're going to have the luxury of moving very slowly on the taper process. I think they're going to have to get that done more quickly this time than they did last time around.
And that's the worry a lot of people have. Actually, Stephen, it's good to catch up and get your view on things. Stephen Stanley there, Amherst Pierpont, Securities Chief Economist. Just off the back of this data, dollar a little bit weaker, dollar index a little bit lighter. We shave about 0.1% off the dollar index. Just to turn to the broader market, your bond market, basically unchanged, almost down about 0.5 basis point on a 10-year yield right now. Lisa, still south of 150.
I'm struggling to understand, though, with some of these downside disappointments, the idea of downside economic surprises that we've been seeing, how we could get to a place where we accelerate the tapering and we accelerate the rate hike. What would be the trigger for that? And that's what I'm thinking about right now. Would it be labor market progress? Would it be inflation that seems to be more persistent? Based on what we're seeing right now with auto prices and the potential deceleration there in lumber prices, not seeing where that comes into play either. So yes, this is a worry, to echo what you were saying, but I'm just not seeing it necessarily played out in the data just yet.
It's that commitment to being late from the Federal Reserve that they've basically wrote into their framework, that we're now going to be data dependent, not forecast dependent, outcome dependent, which will leave them to be late by definition, Lisa. And if they're late, there's this concern that once they do start to move, they have to move more quickly.
Well, but that is predicated, and I agree with you. That's predicated, though, on the idea that we will get inflation, that will pick up more materially. And I think that really is the question. I mean, none of us know the answer to this, but if people are worried about that, why are we not seeing inflation expectations pick up materially?
Yeah, coming up on the program in the next hour at the Open, I'll be catching up with Savita Subramaniam of Bank of America. We'll be catching up with Jonathan Golub of Credit Suisse as well. Going into that, equities approaching all-time highs, 42.52 on the S&P 500. Taylor Riggs, a final word before I run on this equity market, climbing back towards record highs.
Record highs and across the board, 25 basis points on the 2-year. We go nowhere, John.
Pretty dull elsewhere, isn't it, Taylor? Taylor Riggs, Lisa Bravis, Jonathan Ferro. More of us tomorrow. Tom Keene will be back with us on Monday after his long weekend. Do we get to call it a sabbatical when Tom takes time off?
I'm sure you will, so it's not about whether you get to or not.
I will call it that on Monday when he returns. Your equity market, 42.52. Heard worldwide on Bloomberg Radio, seen worldwide on Bloomberg TV. For our audience worldwide, this is Bloomberg Surveillance.
With
With the First One News, I'm Rishka Gupta. The sea view side of a beachfront condo tower collapsed in the Miami area town of Surfside early today. The collapse trapped residents in rubble and twisted metal and sent a cloud of debris throughout the neighborhood. Firefighters were seen pulling survivors from the concrete debris. In a tweet, Miami-Dade police said one person has died in the collapse. U.S. officials are confirming that details of the genetic makeup of some of the earliest samples of the coronavirus in China were removed from an American database where they were initially stored at a request of Chinese researchers. The U.S. National Institutes of Health says that the data first submitted to the U.S.-based Sequence Read Archive in March 2020 were requested to be withdrawn by the same researcher 3 months later. And President Biden is traveling to North Carolina today to encourage more Americans to get the COVID-19 vaccine. His trip to Raleigh comes 10 days before July 4th, the president's stated target date to see at least 70% of adult Americans at least partially vaccinated. The CDC says that so far, slightly more than 65% of U.S. adults have had at least one dose. California Governor Gavin Newsom is set to face a recall vote after petitioners collected enough signatures to trigger an election. Newsom has faced scrutiny for his efforts to control the pandemic with strict lockdowns, which fueled the movement to remove him from office. He was criticized for dining without a mask at a restaurant last November while telling Californians to avoid social interactions. Global News, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
I am concerned about inflation overshooting by more and for longer. And I'm also worried that we'll see a second half of the year where the economy is running really hot, first and foremost the US economy, and that will have spillover and spillback effects into the global economy.
That was Alex Weber, UBS chair, talking about the hopes, the fears of faster inflation for banks. Certainly, faster inflation would be a good thing if it steepened the yield curve and led them to more profitability. Since the end of May, the S&P financial sector actually is down 4.7% on that flattening yield curve. Now, we have the CCAR reviews, the stress tests by the Federal Reserve. We expect results today, 4:30 p.m. Jeff Hart, will be watching that. Piper Sandler, senior analyst for research. Jeff, thank you so much for being with us. What are you expecting out of the stress tests today?
Yeah, good morning. I'm actually expecting it to be much less eventful than in the past. This is kind of the first non-pandemic CCAR under the stress capital buffer methodology. So, I mean, we're unlikely to get specific dollar amounts kind of from the companies that we've gotten in the past. And so there'll be probably less information out there, which is going to make it harder to be able to actually call winners and losers, tonight, as opposed to over the course of the next year.
Jeff, what's your expectation in terms of how the market will respond, given the fact that the expectation is for all of the banks to pass with flying colors and to be able to buy back more shares and pay out bigger dividends?
Yeah, I mean, it sure doesn't seem like anyone should fail, and that, all these banks passed last year and they've built a lot of capital kind of since then, so that shouldn't be too much of an issue. I mean, the thing that could get interesting is to the extent that someone's stress capital buffer, as the Fed calculates it, changes meaningfully from what it was last year. I mean, that could inject some excitement into it, but it seems like it's going to be, I think, a fairly straightforward exercise. We'll kind of see what kind of results we end up getting out. But I mean, the bottom line good news is the banks are going to be able to start returning capital again. And that's been some pretty big buybacks. And I actually think all of them will raise their dividend, which is kind of unique to this year as well. But it's just kind of, in the past, you've been able to call winners and losers. It's been kind of a night where who came out the best. I don't think we're actually going to get, specific dollar amount capital plans from many of the banks. To the extent we get some, that'll make it more interesting. But I think it'll be more we're going to raise our dividend X amount, and here's our excess capital under the stress capital buffer. We'd like to return it to shareholders in a prudent manner or something like that, as opposed to, go back 2 years ago, a company would come out and say, we're planning to buy back $5 billion, worth of stock, and you could kind of judge that better.
Jeff, from the market perspective, there's been some big underperformance for the financials as of late. Does anything today change the game in terms of how you're thinking about some of these dividends, some of these buybacks, a boost perhaps to the share price?
I don't think it's going to change it a whole lot. I mean, kind of as banks have had a pretty nice run, and I think when we started seeing kind of interest rates maybe going another way, it became kind of an excuse for some selling. But when I kind of look at kind of the outlook for banks over the next, let's call it a year or two, I think it's still constructive and still positive. And capital returns are a big part of that. I just think that's kind of expected that they're going to be pretty good. So I don't think we're necessarily going to get anything surprising tonight that's going to make people that much more excited or that much more scared of the bank specifically.
Within your research, are you seeing a bifurcation between some of the big banks and maybe some of the more regional players, or is this broad-based a positive environment?
I think it's pretty broad-based positive environment. I think the bigger players, when you start looking at the universal banks like a JP Morgan or a Bank of America, are probably in a bit of a better position in that capital markets have been really strong and they have big capital markets businesses. And until we actually get kind of loan growth and higher interest rates, not just at the 10-year, Scale is increasingly important to banking, and these guys have it. So I think the environment we're in here now kind of plays into the big guys' hands. And as we kind of migrate to some loan growth, which I do think we'll see, it's a matter of when, not if, and hopefully some higher interest rates, then it kind of becomes more broadly good for banks in general.
Jeff, I'm wondering, just zooming out, there is a question of how much financials really hinge on the yield curve. A flatter yield curve tends to be bad for banks, thus the underperformance that Taylor is talking about. Was the reaction from last week's Fed meeting concerning to you? The idea that if the Fed takes any steps whatsoever about backing away from some of their easy money policies, that the yield curve actually flattens, not steepens, that this will actually bode poorly for the financial sector?
Not so much. I mean, it's interesting. Bank stocks tend to move with the 10-year, even though, something like the maybe 5-year, 6-month spread means a lot more for their fundamentals. So the stocks tend to move. So as we kind of look at it here, the 10-year coming down typically will bring the bank stocks down. But I don't really think the interest rate environment for them has changed a whole lot over the last couple of weeks. We're still kind of waiting for the short end to go up, and that's what we really ultimately need to see. Ideally, the Fed starts raising short-term interest rates and the curve steepens because they're responding to a strong economy, and that'd be really good for banks. I suppose that the scarier situation would be if they're responding to inflation without that strong economic growth. But as long as the economic growth is driving it, that should be good news for banks.
Jeff Hart, thank you so much for being with us. Jeff Hart, Piper Sandler Senior Analyst for Research. We're getting those stress test results again at 4:30 p.m., the first post-pandemic stress test results. Taylor, you talked about the underperformance of the financial sector, and I do find it fascinating that it really has come on the heels of sort of a rejiggering in financial expectations, that perhaps there is this transitory growth in inflation and that the Fed is correct. I'm wondering, going forward, what is being priced in? To your question, is your sense that people are still going long financials or that they're backing away at this point because it's all the good news that's already been priced in?
I've heard increasingly notes like UBS yesterday saying that they reiterate this pro-cyclical stance, Lisa, that indeed the market took a little bit of a pullback, but it is this inflationary trade, despite perhaps what the bond markets are telling us within the column on a 210 on a 30-year. But it really has been a little bit of both, maybe a little bit of tech, maybe a little bit of cyclical, but it certainly has not been get out of the cyclical trade, it's done.
Yeah, no, I would agree with you. No, that's actually what I'm hearing also from people who come on this show and other shows. That's exactly what they say as well. They're still doubling down on the banks. I gotta say, it's fascinating to hear about these record highs every single day, really, really not moving the needle in terms of our shrugging it off. And it doesn't seem like a very active market. But Taylor, is there anything that people say that you are hearing about what could potentially disrupt this?
I think all the conversations we've had this morning, Lisa, maybe taxes being a headwind, but the conversations we hear on the close are, how do you fight M2 money supply? How do you fight a Federal Reserve that says, nope, we're only focused on the labor market despite inflation? And all of those signs, despite some of the hawkish tones we've gotten from some of those Federal Reserve heads, has been, we're in it, and we're in it for good.
Yeah. Mike Wilson pushing back a little bit, saying M2 growth has actually decelerated, so perhaps that could be a headwind. We will continue to discuss. Coming up on Balance of Power, Jared Bernstein of the Council of Economic Advisors. From New York, this is Bloomberg.
G7 today need to wake up and listen to the science. There isn't room for discussion on this. Scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated! The world is possible!
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City for our audience worldwide, good morning, good morning. 30 minutes until the opening bow this morning. Equity futures approaching all-time highs on the S&P 500, positive by about 0.5%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
From New York, we begin with a big issue. Market heavyweights pushing back.
The U.S. economy is really on fire.
We're going to see inflationary consequences.
I do think that prices are going up. Wages are the most concerning.
You're going to see the continued inflation.
The economy is running really hot.
Too much money, too massive amounts of stimulus.
This overheating,
overshooting by more and for longer.
There is a danger
that this is ongoing inflation and that the Fed will need to adjust.
I am concerned about inflation.
I don't see the basis for policymakers' serenity.
No question that the Fed needs to go into a period of normalizing rates.
This overheating is likely to necessitate a monetary policy response.
Let's bring in the panel. Joining us now is Stephen Parker of JP Morgan Private Bank and Jean Bavin of BlackRock Investment Institute. Jean, I want to begin with you. This debate continues. It hasn't changed. Many people are sick of hearing it every single morning on programs like this, which is why I've started my program this morning with it again. So, Jean, my question to you is, when we resolve this debate finally, at what point in time do we get that done? Where on the calendar?
Great to see you, John. Thanks for having me. Yeah, I think we've been debating that quite a bit. I think what's interesting is, that was in the cards for many months. I mean, this restart is a powerful force that would be creating significant inflationary pressures. We've been seeing, in our view, what's coming from since last year. Now it's becoming consensus. We are hearing more noise around it from the heavyweights you just mentioned. I think that it's real. We think we're breaking to a slightly higher inflation regime than what we've seen over the last decade and more. At the same time, I think it's kind of a welcome development. That's what the objective is about. That's what the central banks are trying to do. And I don't think they'll walk away from delivering this inflation soon. So I don't think we are seeing going back to a historical policy response at this stage. And I think that means the Fed remains easy despite inflation coming up.
Stephen Parker, your take, please.
We agree. We think a lot of these inflation pressures are more transitory in nature. We do think that we're heading into a slightly higher regime, but that's for good reasons. It's because growth is stronger. But when you look at some of the parts of the market that have been particularly in focus as it relates to inflation, oftentimes the best cure for higher prices is higher prices. And that happens because it curtails demand a little bit, cools things off, but also because it forces the economy to invest in supply chains to bring that supply back onto market. You look at things like lumber, which have been, which we've all focused a lot more on than I can ever remember in my entire career. And we've seen a massive correction there in prices just over the last month or two. And we actually think that's a good thing. Ultimately, we think that a gradual move to tighter monetary policy is probably in the cards because we think the global recovery will continue, will be prolonged, and will be strong. But we don't think that's a bad thing, particularly if policymakers can message that and ensure that markets aren't caught by surprise.
Well, policymakers are starting to push back. This is what the Dallas Fed President Robert Kaplan had to say, forecasting a rate hike in 22. He said, assuming we meet our conditions, I'd rather start tapering sooner rather than later so that we have more flexibility in deciding what we want to do on rates further down the road. I want to bring in Carl Riccadonna of Bloomberg Intelligence on this. Carl, I feel like we're arguing past each other almost every single day. There is a difference between an adjustment in the price level, which is likely permanent, and the factors behind that adjustment, which may well be transitory, and therefore it's the rate of change that you need to be focused on through this year and into next year.
Absolutely. It's the rate of change that matters, John. So those folks who got a $15 minimum wage working in a warehouse or a big box retailer, that may be a great addition this year, but inflation will erode those gains away. And there's no certainty whatsoever that as the economy normalizes, that 15 per hour will be indexed to inflation or some other sort of growth rate that enables them to keep up. So again, the joy fades as we move further and further into the future and start to lose that positive gain. And here's three numbers to keep in mind: 4, 3, and 2. And these are the forecasts for the end of next year for unemployment, 4%, GDP growth, 3%, and inflation at 2%. So if we're getting to the end of next year and that's the type of economic conditions that are prevailing, that's not all so different from where we were prior to the COVID crisis back in 2018 and 2019 when we were in an economy that did not signal a big inflation problem. So I think we're really being reactionary to a peak growth, peak inflation environment, as we all knew it was going to happen in the second and third quarters of this year. But all of that's going to fade as we get around to the time where policymakers will actually be ready to start normalizing policy.
What do you think that should mean then for the optimal calibration of policy over at the Fed?
Well, I don't agree with the Kaplan assessment of act now so you have more leeway to act later. Chair Yellen, when she was Chair Yellen, made a good point of, the best insurance against having to cut rates in the future is to leave them lower for a longer time now. So let the economy develop, let the recovery mature, let the labor market continue to mend, because we still have 7.5 million workers who have not been reabsorbed into the labor market. So there's a significant potential for scarring there. And so I think that it's not act now so you have room to cut or hike at some point in the future. Rather, maintain those accommodative conditions once we get past this peak so we can really assess what's happening. What Vice Chair Clarida said on Bloomberg Surveillance about a month ago, he said, wait until we get deeper into the year, really to the tail end of the year, to have a sense of what the normalization is starting to look like. And you're already seeing it in the latest durable goods orders, growing, but growing more slowly. You see it in the various purchasing manager surveys, growing, but the pace of growth is starting to moderate. So as the moderation sets in the back half of the year, I think there will be a recalibration of the urgency for policymakers to start doing something.
Carl, it's good to see you. Carl Riccadonna of Bloomberg Intelligence. As always, sir, thank you. Jean Bavin back with us. Jean, I want your view on this. You mentioned something important a little bit earlier. You said we'd move into a higher inflation regime. What's behind that, Jean?
So just to pick on what Carl was saying and then segueing into your question, I think like what we're going through now, we're turning the light back on, right? And once the light are back on, we cannot turn them back on again. So I think that captures a lot of, we're restarting, but it's not like we can extrapolate the kind of numbers we're seeing now for the years to come. So that I think should give us a bit of tempering a bit expectations around growth from here. And in that context, inflation is a real phenomenon. We are seeing demand, a lot of pent-up demand that is turning back on when supply is lagging. So that's the restart dynamic on inflation. But beyond that is the deliberate attempt of the Fed generate this inflation. That's the objective. They are operating under a new framework now where they deliberately want to have inflation above target for a sustained amount of time. And ultimately, I think that's why it's going to be hard for them to be more hawkish than they have been last week. I think that's peak hawkishness for the near term. And exactly because it's going to be difficult to generate this inflation by pulling forward the liftoff much more than 2023.
Stephen, what was remarkable to me and many others as well is that they took just a tiny, tiny step. It was just a re-evaluation of the balance of risks around their outlook, and that was enough to trigger a really big repricing in a Treasury market, which was temporary, down to 135 at the low end on yields earlier this week. Stephen, what was your takeaway from that? Just the signal you got from the price action over the last week?
Well, I think one of the biggest things that we've learned, frankly, over the last decade or so is that markets don't like being surprised by policymakers. And we've gotten used to a Fed and central bankers around the world who have done a really good job of outlining and forecasting and letting markets know the long-term path that we're going to take. I think a lot of markets ourselves, or a lot of investors, ourselves included, were surprised by the shift, particularly around some of the views around letting inflation run a little bit hotter for a little bit longer. And I think that's what the knee-jerk reaction was. It was the market questioning whether this is a change in the direction of policy. And I think as we've gotten more information, as we've heard from more Fed speakers, there was a realization that this was really something that was incremental in nature, not a drastic shift in terms of the policy direction, which is why we've seen markets settle back down. And ultimately, we think as long as policymakers can continue to provide that guidance, that markets will be able to digest this, even if it means a gradual shift in policy over time.
So I wanted to finish here with you both then. Is there anything about the past week that has changed your outlook in any way, shape or form? John?
Not really. I think, we're going to see the most muted response of the Fed to inflation that we've seen in decades. That's what the new nominal is about. That's what the new framework is about. That hasn't changed. I think what we've seen last week is, we have a range of views of market participants now that is unusually wide, and that's prime environment for information coming and being leading to overreaction. And I think as a result, this is what we've seen over the last few days. It's settling down now. I think no big news from our side over the last week.
Stephen Parker?
No change. Continued strong growth, continued supportive policy. Inflation remains contained, which we think translates into sticking with stocks over bonds, staying diversified, and focusing on parts of the market that can deliver that long-term growth, along with barbelling with some of the cyclical sectors that we think continue to have legs as the economy continues to reopen in the coming months.
Gents, stay close. We'll continue the conversation. No change to this market too. We're on course for another all-time high in the S&P 500, 42.51 on S&P 500 futures right now, up another 20. We advance 0.5%. With some of the movers out there at the market desk, here's Abby.
Indeed, John. It's certainly a strong risk-on tone this morning. And similar to yesterday, tech is a big driver. The NASDAQ 100 futures leading the S&P 500 futures, also heading to another all-time high. So not surprisingly, many of the big tech names, Apple, Microsoft, again, both of those names above $2 trillion in market cap. Facebook, NVIDIA, all strong. Now, that is the growth trade that has been outperforming over the last month. But today, once again, we have the reflation trade doing so pretty well as well. JP Morgan, Citigroup, Bank of America higher. This ahead of the Fed stress tests coming out later today. Even with yields in a little bit, the yield curve actually the yield curve is a little bit steeper. So perhaps that is what is exactly helping the banks. We have some nice gains here. And then finally bringing it to the Alzheimer's drugs. Eli Lilly popping up 7.8%. They have gained the FDA breakthrough status. This speeds up consideration for approval. Biogen, of course, received this a few weeks ago. Very controversial. You can see the threat of competition taking Biogen down. But overall, risk on tone, John.
Abby, thank you. That's the morning in the equity market. Risk on, 42.52 on S&P futures. Up next, the Bank of England warning against premature tightening, keeping its support in place. That conversation next. We'll catch up with Guy Johnson out of London from New York City this morning. Good morning. 18 minutes away from the opening bell. Equity futures elevated, advancing 20 points, up 0.5%. 42.51. Let's call it 42.52. This is Bloomberg. Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Both the Fed and the Bank of England are struggling in the dark. We've never seen anything like this. And the best thing is to simply wait and see. So any suggestion that they have a clue, I mean, people say things like, I think we're going to tighten in 2022 and 2023. Well, they're just kind of winging it.
What else would you expect from Danny Blanchflower? Good to catch up with Danny a little bit earlier this morning. The Bank of England taking a page from the Fed's transitory playbook, pushing back against calls for a hawkish shift and writing in its statement the following. Financial market measures of inflation expectations suggest that the near-term strength in inflation is expected to be, drum roll, guess what, transitory. Joining us out of London now is Bloomberg's very own and my good friend, Guy Johnson. Guy, take it away. A page out of the Fed's book, maybe.
Yeah, it does sound familiar, doesn't it? Tell me if you've heard this one before, John. We think the recovery looks strong, but we don't want to put it at risk. We think inflation will spike, in the Bank of England's case, to north of 3%, but we think price rises will be transitory. The labour market looks good, but we need to wait until later on this year. In the UK's case, for when the furlough scheme rolls off, John, to get a clearer idea of when the labour market really is going to strengthen back to pre-pandemic levels. There are some hawks, in this case Andy Haldane, the outgoing chief economist, but he can't persuade anybody else on the MPC that it's time to taper. Yes, this sounds very familiar, John.
Not going to resolve these issues until maybe the autumn, the fall, as they would say, on this side of the Atlantic, guys. It's going to take a while.
Absolutely. The furlough scheme needs to roll off. We need to get an idea of what is going on. We need to know what's happening with the Delta variant, now the Delta Plus variant. We need to know what the reopening is ultimately going to look like. You have seen the reopening being pushed back. You saw that showing up in the latest PMI data, John, which took a little bit of a pause in comparison to what we've seen out of the Eurozone, which is reopening and re-accelerating. You can see that in the confidence data that we've seen out of both France and Germany at the moment. But I think it's just a wait-and-see mode. I think it's going to be a quiet summer. The August meeting, I think, is going to be more interesting. We are going to get more data at this point. We are going to get better forecasts. We are going to get a clearer insight. But nevertheless, as you say, John, I think it's later this year before the central bank can really get a gauge of what is happening truly with the UK economy.
No doubt, Guy, you'll go through some of these parallels with Alex Steele in about 43 minutes or so. I do wonder if the differences matter here for the Bank of England. There's no average inflation targeted regime in the same way there is now here in the United States. The additional factor, too, no long persistent period of undershooting the inflation target over at the Bank of England. At times over the last 10 years, quite the opposite. Do you think that makes a difference?
No, it has a history of looking through inflationary spikes, and I think the markets will take that broadly on board, John. Certainly we've seen inflation spike above where the Bank of England is predicting it now, and it looked through it last time. The expectation is that it's going to look through it again this time. The market did take today's statement, I would argue, on the dovish side. You can certainly see that in the reaction when it comes to the pound. But there is a long history, John, of looking through inflation spikes. We've certainly seen it in the past. The market is expecting that we will see it again.
Cable with a gap lower off the back of the decision. Sterling right now 139.26. Guy, looking forward to the show in about 42 minutes. Let's bring back in JP Morgan, Stephen Parker. Stephen, here we are. What's remarkable for so many people is we're this early in this recovery. We've got central banks sitting out of the game, talking about how they won't get involved anytime soon. And yet equities are going to be close to or maybe through all-time highs stateside in about 12 minutes. On the equity side, credit spreads are as tight as they have been since 2007. How different is this recovery compared to the market action, the price action that we're seeing right now, relative to where we were maybe 10 years coming out of the last crisis?
Well, I think we're in a much better place in terms of the stability of the market, the economy, and the financial system today. Coming out of the last crisis, there were a lot of questions around the financial sector. And clearly what we've seen is that banks have built up a lot of capital. They've helped to stabilize. So I don't expect that we will see the same types of disruptions that we saw in the last drawdown. I think this is more akin to a natural disaster, which means that this recovery has been sharper. And we think that for all of those reasons that you mentioned, strong growth, a accommodative policy, easy monetary conditions, that means that the pace of the recovery can not only remain strong, but also last longer than expected. And that's the big key. We think that earnings growth is actually going to be stronger than what markets are pricing. And so a lot of the concerns that our clients are expressing about markets at all-time highs, valuations, we think markets are going to continue to grow into those valuations because earnings are going to continue to be strong.
Let's build on that. I want to bring back in BlackRock's Jean Barvan into the conversation. John, when people look at where equities are, close to record highs, where they look at credit spreads, tight, the tightest since 2007, it's hard to believe that this is early cycle in financial markets. How are you and the team at BlackRock thinking about that dynamic?
So I think contrary to 2008 and when the recovery started, I don't think we're seeing now the prelude of a decade-long bull market shaping up. So I think, as I mentioned before, we're turning light back on. I agree this is akin to a natural disaster, and so we're getting it back on the back of it. That is providing a powerful near-term kind of risk support, which is we're comfortable with what we're seeing in terms of valuation at this stage. But at the same time, I think this environment we're going to see kind of a modest return over the next 5 years. So our capital market assumptions are reasonable but muted expected return. So I think it's a balance between it's real, the restart is real, it's happening, it's supporting markets, but at the same time not extrapolating a decade-long bull market like we had post 2008 on the back of this.
Jean, for those out there that might want to be a little bit more defensive going through the summer, given what we may or may not hear from the Federal Reserve, what are you suggesting they do at the moment?
Well, actually, the first thing I would say is we very much believe that we still should be pro-risk in this environment. There may be a risk down the road on a few years out, but at this moment, we think that the new nominal, the Fed support is still very much in place. That provides a favorable backdrop for risk taking. And maybe one way to modulate a bit the risk taking at this juncture is maybe look more now in regions like Europe and Japan, where they haven't benefited as much from the restart. The restart is now broadening, and taking maybe some chips out of the U.S. in favor of these regions at this juncture might be a way to modulate some of the risk taking.
Stephen, do you like the idea of that additional international exposure?
Yeah, we've been talking to our clients about making sure that they're at a minimum rebalancing into a global portfolio mindset. After a decade of outperformance of the U.S., it's not surprising that a lot of investors have a much bigger portion of their portfolio allocated to the U.S. And we think there's opportunities both near term and longer term outside of domestic markets. In the near term, we agree with Jean. I think that places like Europe and Japan have some of those cyclical tailwinds, some of the recovery and catch-up that they've lagged relative to the U.S. Longer term, we still think that emerging markets offer really compelling opportunity. They bring a nice blend of cyclical value and secular growth, and a lot of those economies are ahead of the curve in terms of the recovery, and we think that's an opportunity.
Hey, gents, good to catch up. Gentlemen, Jean Bavin of BlackRock, Stephen Parker of JP Morgan. Coming up in the morning calls and later, Wall Street's biggest banks bracing for stress test results. That conversation still ahead with Bank of America's Savita Subramaniam and Jonathan Golub of Credit Suisse. Equities opening up in about 7 minutes' time. Equities up by about 0.5% on futures. Equity futures 42.52 on the S&P 500. We advanced by 0.5%. From New York City this Thursday morning. Good morning. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
About 5 minutes away from the opening bell stateside. Equity futures unchanged through yesterday. This morning, a bit of a bounce, up about 0.5% on the S&P, advancing on the Russell by 0.5, on a Nasdaq by 6. That's the price action. Let's get you some morning calls this morning. We begin first up with Morgan Stanley raising its Apple price target to 162. The analyst forecasting a stronger than expected June quarter, with demand concerns overblown. Your second call from Deutsche Bank upgrading MGM Resorts to a buy with a $54 price target. The analyst expecting the economic reopening to fuel upside growth to its casinos and margins. That stock up by a little more than 2%. And your third and final call from Piper Sandler, downgrading Dollar Tree to neutral, a 102 price target. The analyst seeing inflationary headwinds continuing well into next year. That stock is down to 100 on the button. We're negative about 1.47%. Coming up, the value versus growth debate heating up with Wall Street taking their positions. That conversation up next with Bank of America's Savita Subramaniam and Jonathan Golub of Credit Suisse. The cash open next with equities approaching record highs stateside. This is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We're looking down the barrel of all-time highs ahead of the opening bell on the S&P 500 this morning. Good morning. About 15 seconds away from that cash open. 42.55 on S&P 500 futures. Up another 23, advancing about 0.6%. A drift higher on the Russell. On the Nasdaq, 2 up 0.6. That's the cash open. That's your opening bell. Switch up the board and get to the bond market. Yields unchanged, 148.85. What a round trip we've been on over the last week. Basically now where we were on Wednesday morning before that Fed decision, just south of 150. Euro dollar 119.41, a little higher than 0.1%. A stronger euro off the back of better investor confidence, business confidence out of Europe. In Germany, the EFO improves. Outside of that, WTI with a 72 handle, a break of 73, $72 and about 74 cents. We're negative there, 0.5%. That's the cross-asset story at the market desk with your movers. Here's Abby.
John, with that outperformance for the NASDAQ 100, not surprisingly, at another all-time high. Let's start out with big tech and Microsoft opening above that $2 trillion market cap. Not a huge gain, but we do have gains for lots of the tech movers, including Microsoft, Qualcomm, Intel, PayPal even joining in, up 0.8%. D.A. Davidson initiating with a buy rating and a $325 price target, suggesting some upside ahead. We also have strength for the auto space. This is a continuation. Tesla now up for a third day. One of the top stocks for the S&P 500 yesterday up more than 5.5%. Today up 2.5% after the bit of correction, even bear market this year. It seems that investors want back in on Tesla. That is true, too, for Ford and General Motors. Small gains there, but riding the electric vehicle tailwind. And then finally, John, we have tech working, we have autos working. We also have the other part of the reflation trade mainly working. Conoco's down just a little bit, but JP Morgan, Citigroup, the big banks higher as yields are basically flat, up just a little bit at this point. And of course, ahead of those Fed stress test results released later today at 4:30 p.m. And then Chevron up ever so slightly, Conoco down. But overall, again, a risk-on tone. Most sectors are working. Consumer discretionary, it looks like up top.
Abby, thank you. About 1 minute and 42 seconds into the session. Abby's going to run you through the price action. Through the first 30 minutes of the session here, stateside, we advanced to all-time highs. 42.65 is your new record high on the S&P 500. That print came just seconds ago. Right now, 42.63. Within the equity market, away from the headline number, the value versus growth debate still front and center. Wall Street taking sides with strategists at Morgan Stanley, Cornerstone Macro, Charles Schwab, all warning investors not to sell their cheap cyclical stocks in favor of resilient growers. For more, here's Bloomberg's Katie Greifeld. Hey, Katie.
Hey, John. Well, that's one of the biggest debate in equities right now. What a Fed taper will mean for that growth versus value debate. And the knee-jerk reaction coming out of the Fed meeting last week has been to offload the S&P 500's cheapest shares, those pure value plays. They've been lagging pure growth, the fastest growing companies, for a few years now, but they were starting to make up a little bit of ground. But the idea that the Fed could start to turn off the taps has growth pulling ahead once again. And you can see those diverging fortunes clearly in the correlations. Pure growth and pure value, they're the least correlated right now since 2000. That's after they've been moving virtually in lockstep for years now. That correlation was approaching 1 in April 2020, but it's breaking down now as talking about tapering gets underway. And John, it's worth pointing out that even with this drop, value is still on top for the year. Energy, financials, they're some of your best performing sectors. And you have the likes of Charles Schwab and Morgan Stanley saying, don't call time on cyclicals just yet, that there's still room to run. So we'll see if that outperformance holds.
Information technology top of the pile this morning, at least, up 0.8%. Katie, always super smart. Let's catch up soon. Katie Greifeld there on the price action we're seeing. Goldman's Peter Oppenheimer expecting the distinction between growth and value leadership to start fading. Take a listen.
We see a mixture between deep value areas of the market. Banks we were just describing would be one. Commodities, energy, mining would be another similar area where we think there's strong cash flow being generated and some good valuations. But also some of the more defensive growth parts of the market are starting to look quite attractive. Also, from a geographical perspective, much more of a mix in performance rather than such a clear outperformance of the US.
Let's get into this right now and bring in two of the best on Wall Street, Bank of America's Savita Subramaniam and Jonathan Golub of Credit Suisse. Savita, I want to start with just cyclicals, and then I want to get to your industrial call in just a moment. For the cyclicals, why do you want to stick with it still?
Well, I mean, it's the economy. It's basically the broadening out of the economy. We haven't reopened the world yet. We've just started in the U.S. We're starting to see that kind of drift across the Atlantic. I mean, I think that the easiest call to make right now is to stick with cheap stocks. But I think what's interesting is that some cheap stocks a year ago are no longer cheap, whereas other stocks have remained cheap because earnings have basically kept a pace. So I would stick with the value call. I would stick with a select group of industrials. But to your point, not everything looks great right now. And industrials is one area where we do think that things have gotten pretty pricey off of the low levels that we saw last year. Oh. But I think that the call on cyclicals remains intact, unless we're heading into a slowing down of the economy, which it really doesn't look like. None of our economists are calling for this. I would stick with the cyclical bias.
I'll turn to industrials in just a second. Just hold that thought, Savita. I know you want to get there. I need to get Jonathan Golub into the chat too. John, you agree on a cyclical side. Just reading your research. They'll carry on leading on both profits and returns. That's your call.
It is, and I think that if you said to me, would you rather be in growth stocks over the next 5 to 10 years? I think the answer is yes, and we will get back to that point in time where growth is going to lead. But the economy, and I'm right on the page with Savita on this, where the economy is just too strong. And I don't think it's a growth versus value thing. I think it's a cyclical thing. You want companies that are really exposed to economic improvement, and a mining company, an energy company, a mall retailer, all of those do much better in a reaccelerating economy where the FANG stocks and the tech stocks, they do well. They're kind of all-weather companies. They do well under all conditions, but that means this is not their moment in the sun right now.
Let me give you the stage now, Savita. Forgive me for cutting you off. The industrials, why aren't they the optimal way of playing this?
Look, I think that industrials have been kind of a chicken way to play the reflation trade. So we've seen that industrials have grown very crowded by institutional investors. They've grown incredibly expensive over the last 12 months off of the nadir. So I think that, the better way to play reflation, economic reopening, higher oil prices is energy. I also like financials. I think financials is still cheap, but industrials has been kind of the chicken energy sector. It's been the way that investors have been able to have access and exposure to oil without actually holding oil stocks. So I think that there is this really interesting disconnect right now where industrials actually looks pretty expensive, pretty crowded. And then you've got these deep value sectors like energy and even select materials that haven't really participated in that institutional investor buying. What I worry about is industrials doesn't actually look all that green. I think folks are buying it because it's more kind of green than energy, but it really isn't. Industrials actually contributes the highest percentage of carbon emissions to the S&P 500. It contributes 30% of total emissions of the S&P 500. So I think that it's a sector that offers up what investors think is a greener way to exploit the oil price move, but it's not. It really isn't. And I think the better way to do it is buy energy.
Three sectors there that you mentioned, the financials, the industrials, and energy. Let's save the banks just briefly, John, and go to that call on the industrials. Less bullish, less constructive over at Bank of America, much more so on energy. Where's Credit Suisse on that, John?
Yeah, I think that the two groups that participate the most here are going to be energy and financials. But to a certain extent, I think it's not worth the effort to try to make a call on materials versus industrials versus retailers. The big call is this. This is going to be an incredibly powerful reopening process, and you want to buy the top half or top third of the market that is going to win during that play. And you could be really nuanced and say, I want to buy transports, or I want to buy machinery names, or I want to buy, E&P oil exploration companies. But I think in reality, it's just avoiding companies that are, number one, more defensive in their nature, areas like consumer staples and utilities. I think those are going to be clear laggards, and I think tech is going to be a market returner. The differences between the cyclical groups, I think, are going to be much more subtle, and I don't think you need to make a really nuanced call there if the economy remains as strong as I think it's going to be.
Well, it depends if the price pressure comes along for the ride in a much more pronounced way. Savita, I wanted to go there. You and the team have done some tremendous research on this. Companies with high employee-to-sales ratios. Can you walk me through what you see in the data and how it shapes your views on the sectors you want to be in and the sectors you want to avoid?
Yeah, thanks for the question. So I do think that we're moving into more of a stock pickers market. So I would say you can't just buy all cyclicals and you get to the same place. To your point on inflation, industrials is, I think, the third most labor-intensive sector in the S&P 500. Consumer sectors are 1 and 2, and then industrials. There's a huge tightness in the labor market, and our analysts have been writing about this. I think that's going to translate into margin pressure, especially in a sector that's pricing in really strong earnings growth over a period of time where, I think banking on this infrastructure deal coming through and benefiting CapEx beneficiaries isn't necessarily a slam dunk. So I would focus on pure inflation beneficiaries, which aren't industrials. Industrials has too much margin and pressure from the cost pressure that you're seeing from labor and other raw materials. So I think that's what you want to really pay more attention to. And I guess I would say that we are moving into more of a nuanced market environment. We've seen this cyclical rally where, to Jonathan's point, all cyclicals did really, really well for the first half of this year. I think we're moving into an environment where you really want to pick your spots and look at labor inflation and labor intensity as a way to kind of differentiate between the good and the bad cyclicals.
There's some subtle nuances between the both of you. You're both pretty optimistic about the future. You're both looking to play it through cyclicals. But John, I have to say, Savita is far more nuanced than you. Why are you a little bit different on this?
Well, first of all, let me just one point that I kind of agree, but have a slightly different view on is this idea of costs. We found that right now pricing power is unbelievable. Companies' ability to pass on costs, despite higher labor, despite higher input, is really high. So we see very, very little margin pressure. We think that companies are focusing, and they always will, on the downside risks of having higher oil prices and copper prices and labor. But what they don't say is, you have no idea how much we're increasing our prices. Take a look, because it seems unbecoming. But that's the reality here. So I do agree with Savita that you want to focus on those companies that can pass on the pricing, that have less downside risk for margin squeeze. But we're seeing that much, much more broadly. And the economy is so disrupted, Jonathan, in terms of who can open up and who can move their products about and who can get parts and who can get labor, that it is really, really difficult to be nuanced. I mean, last quarter, on March 31st, at the end of the first quarter, the consensus on Wall Street was for 20% profit growth. We ended up with 48%. When you end up with numbers that are this big because the dislocation is this large, trying to use a scalpel when the right tool is a chainsaw is a mistake. So I do think that Savita's right. We prefer energy over industrials. Absolutely. I prefer materials over industrials. Absolutely. I do think there's a margin squeeze incrementally in retailers from from the inability to get labor back into your retailer.
Well, so that's a nuanced call, though. I mean, that's a nuanced call, right? I mean, Jonathan, you're making a nuanced call. You're saying you don't like consumer cyclicals, but you like the CapEx plays. So I think that you take that a step further and you say, okay, yeah, and I think the point you made is excellent. Right now, we're not seeing pricing. We're not seeing a margin squeeze. That's right now. But if you look at every regime model, like we have a regime model that basically tells you that right now, we're moving from the cusp of an environment where, pricing power has been great and companies have been able to offset rising costs with prices. But we're moving into an environment where inflation actually starts to impinge.
Any model that you use in an environment where this is going to be the strongest GDP quarter since 1952. So how did your models don't have any ability? None of us do. That's the key. You and I,
Jonathan,
and the Fed,
it's also going to be the biggest pickup in inflationary pressures that we've seen in our careers. And I don't think you can ignore that. I don't think you can sit in a vacuum and say,
no question. We've also never seen this amount of price pressure.
That's my point.
There is just it's okay to disagree, but I think that this environment, and this is really why I'm not recommending that you be more nuanced, and there will be a time for it, is the data is so large. It's so, with the seasonal adjustments on the economic data, we don't even know, they're just not as reliable as they normally are because of the disruption from coming into the into the crisis and out of the crisis. That the biggest thing to do is catch the big wave, ride it big, and then be nuanced later.
Well, okay, how about this though? Why do industrials always perform right in the middle of the pack? I mean, this is what we've seen every single cycle. So my point is, don't be a chicken. Buy energy, buy financials, go for the gusto, go for the reflation plays. I agree with you. I think the economy is going to surprise to the upside. I think earnings are already surprising to the upside, and that's likely to continue. But I don't think you need to be a chicken about it. I think you can buy the sectors that directly participate and avoid the market performers. I think you're right about tech, but I think industrials falls into that same bucket of a market performer. This is a sector where there's cost pressures, there's CapEx, there's, industrials is a very heterogeneous sector.
If we want to get more
really
nuance,
well in an economic recovery.
If we want to get more nuance, even on industrials, they're not the same. Defense contractors are almost like consumer staples. You don't want to be buying them. Would you buy someone who leases industrial equipment? They are like an energy company.
Well,
would you buy someone who makes the machinery and the engines?
You're getting nuance.
No, that's right. But if you're making the industrial call, even that needs more nuance. On
I've never seen two people who agree so much with each other who appear to disagree. But I've enjoyed the last 5 minutes. We've got to leave it there. Jonathan Golub of Credit Suisse, Savita Subramanian of Bank of America. Guys, always fantastic. And that was brilliant. Thank you very much. Coming up, the big banks facing a big test after the closing bell. That conversation coming up next. And the markets right now in and around record highs. From New York City for our audience worldwide, this is Bloomberg.
Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Freedom delayed 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly, and later this week we'll get unemployment, inflation and retail sales data that should all further illuminate the economic recovery.
Back.
We had a record first quarter. The strategy of balancing a wholesale bank or an investment bank with a consumer business anchored primarily in the UK and the US, I think paid off last year. I think it paid off quite strongly in the first quarter.
Barclays CEO Jes Staley weighing in on the strength of his bank during Bloomberg's Qatar Economic Forum. This is major US financial firms brace for the results of the latest Fed stress test results. Could we be getting a few more payouts? Let's bring in Bloomberg's Taylor Riggs for more. Morning, Taylor.
John, that is certainly the consensus here. Look, this is the first post-pandemic stress test results that we're going to be getting. A lot of hypothetical scenarios, of course, about what it looks like in an economic downturn. And then, of course, we've had some real-world examples. Let's think the Archegos blow up, for example, right? Some fat finger little mistakes. But overall, the consensus has been from Betsy Graseck over at Morgan Stanley, for example, look for an accelerated capital return plan in the second half of 2021. Let's take a look at buybacks. buybacks, for example. It doesn't look like anyone should fail. They all passed last year, and they've held on to a lot of capital since then. Banks can start to return that capital, which, of course, will be in buybacks. This is according to Jeff Hart of Piper Sandler. And, of course, expecting most to raise their dividend, too. We may not, though, get specific dollar plan amounts just yet, John. But that dividend story, if we take a look at the chart in the terminal, also an interesting one because you've had an extra dividend advantage of the financials. Now, some of that has been fading just a little bit in terms of what makes that sector attractive because year to date, you're still the third best performer. You're up 22%. We've heard from Jeff Hart this morning, of course, that June pullback wasn't really surprising given that massive run up that we've already had in the sector.
Taylor, another story for you and I to discuss tomorrow morning. I believe you're with us again
Yes.
on Bloomberg Surveillance, early doors. Bloomberg Surveillance tomorrow with Taylor Riggs, Lisa Abramis and myself. TK will be back with us on Monday. All-time highs in this equity market, 42.67 on the S&P, advancing 0.6% with the sector price action. Here's Dave Wilson.
Thanks, John. 9 of the 11 main industry groups in the S&P 500 are higher in early trading. Energy and consumer staples kind of being left behind here. Financial stocks up, but not nearly as much as big tech, whether you consider technology or communication services, where you find Google's owner Alphabet as well as Facebook, and the consumer discretionary category where Tesla is helping things. But healthcare really leading the way today, and specifically Eli Lilly, after U.S. regulators designated the company's proposed Alzheimer's treatment as a breakthrough therapy, kind of clearing the way for accelerated consideration of that drug, and Lilly planning to file for approval this year. So within healthcare, you're seeing a bit of catch-up for the drug stocks relative to the biotech companies, because Biogen, which got approval for its Alzheimer's medicine a couple of weeks back, is lower in response to what's happening at Lilly. So you look at the year to date, the biotech stocks have in general been doing better, but today, you've got a bit of catch up for the drug makers.
Dave, good to see you. Dave Wilson on the sector price action at the index level, all-time highs, 42.68 on the S&P 500. Coming up, the market moving events you need to be watching. That'll be next in our trading diary from New York. This is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
We're about 25 minutes into the session. Stateside, your equity market all-time highs on the S&P 500 up 0.6%. On the Nasdaq up by 0.75%. That's the price action. Here's the trading diary. As always, like every other single day that ends with a Y, we have a host of Fed speak kicking off at 11 a.m. Eastern with President Williams, Bullard, Kaplan and Barkley following throughout the rest of the day. President Biden holding bipartisan infrastructure talks at 11:45. The Treasury auctioning $62 billion of 7-year notes later on this afternoon. And, of course, we'll get bank stress test results from the Fed at 4:30 p.m. Eastern Time. Finally, personal income and spending numbers and the Fed's PCE deflator rounding out the week on Friday. From New York City, this was the countdown to the Open. We'll bring you some highlights of that conversation with Jonathan Golovitz of Vita Subramaniam a little bit later through the day, and, of course, tomorrow morning as well. We'll respond to that. From New York, this is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food, they're able to buy things, they're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication?
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. You know, I'm here by myself. So ¿dónde vive acá? En la parte de Rivera. This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through Jeevansathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. Jeevansathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you use the most to send to each other?
So there's a bear which basically we use for indicating a hug.
Yeah, that's our language basically. Bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you.
Millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law with its swagger and ill-fitting suits caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
So there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood, and he was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hack emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning. He used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the Collateral murder video.
2 traffic, 260.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats could face real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped in the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness.
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks!
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
When it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for 5th generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network factories where machines are just sat there not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
When people think of Vladimir Putin, they think of capital P, power. And that's exactly the impression he creates. Whether it's physical power, firing different weapons, riding in various James Bond-esque modes of transportation, or tossing hapless opponents in judo. Or political power, ruling his own country with an iron fist, crushing his political opposition, or, most recently, being accused of meddling in foreign elections for his own benefit. This is how Vladimir Putin went from a poor, tough kid in Leningrad to a KGB spy to the very symbol of modern Russia. Vladimir Vladimirovich Putin was born in 1952 in Leningrad, which is now St. Petersburg. His father was a factory foreman and his mother a homemaker. It is widely said that Putin's public-facing tough guy persona can be traced back to him getting into fights when he was younger, which paved the way for him to take up judo. After getting a law degree from Leningrad State University, Putin joined the KGB Foreign Intelligence Service. He spent 16 years in the KGB. When Putin returned to Russia, he began his political career.
He went to work for Anatoly Sobchak, who was then the mayor of St. Petersburg.
That's Leonid Bershidsky.
I'm a columnist at Bloomberg View.
Putin thrived in Sobchak's administration because
he was sort of considered pretty efficient city official at that time. He was very loyal to Sobchak.
So loyal and efficient that
he was noticed by Yeltsin's close circle.
And those people soon brought Putin over to Moscow to work in Yeltsin's administration, where he quickly climbed the political ladder.
Then, of course, he was promoted to Prime Minister of Russia.
That's Dmitry Trenin.
I am currently director of the Carnegie Moscow Center.
Around this time, Yeltsin and the people around him, the so-called family, decided that Putin would become Yeltsin's successor. And then this happened. The apartment bombings were carried out in 3 Russian cities, killing 293 people and injuring more than 1,000. Putin immediately accused Chechen separatists for the bombings and followed it up with action.
He was credited with having a very successful military campaign against the terrorists.
And it worked.
After that, he became an heir apparent in the eyes of the Russian people.
3 months later, Yeltsin resigned. And on his way out, a famous exchange.
He was getting into the car in the Kremlin, and the last words that he addressed to Putin before getting into his car was, "Take good care of Russia."
So Putin took over as president, and 3 months after that, won his first election. But just because Putin won the presidency, that didn't mean he had all the power. This is Michael McFaul.
I was U.S. ambassador from 2012 to 2014. In the 1990s, there was a fire sale of all the things worth owning in Russia, and certain people,
the oligarchs,
did better than others in that fire sale, sometimes called privatization, and those people tended to be well connected with the Yeltsin regime, and they weren't Putin's friends.
But they probably miscalculated, thinking that they could easily find a way to influence him. It became impossible almost from the start.
And from that very moment, there was warfare between him and the oligarchs.
That's when Putin gave the oligarchs a choice. Putin's way?
Some of those people from the 90s managed to figure out a new way of dealing with Putin and have survived.
Or prison.
Others could not find common vision, and so they lost their assets.
Khodorkovsky once was Russia's richest person, worth $15 billion, but he ran afoul of President Vladimir Putin and spent a decade in prison.
With domestic power consolidated, Putin focused on restoring Russia's global influence.
Putin is the guy who believes in the expansionist Russian state. Georgia and Ukraine and all the other Soviet republics that split off when the Soviet Union fell apart, he still believes that they're traditional Russian satellites. A lot of his strategy is about keeping them in the orbit. That Yeltsin line, take good care of Russia, that's how he understands it.
And he used annexation and invasion, as well as oil, gas, and trade to keep former Soviet republics in Russia's orbit. In 2008, Putin's 2 terms were up, and he decided to step down as president. Dmitry Medvedev stepped in as president, and Putin went back to prime minister. But really,
Putin never left power. He pretty much continued running the country, and Medvedev was a bit of a figurehead.
There was actually a period of cooperation between Russia and the U.S. that benefited both countries during Medvedev's presidency.
Because Medvedev did not have the same negative attitude towards the West as Putin did.
But when Putin came back to run for a 3rd term, in the lead up to the 2012 election, it was widely believed that both the presidential and parliamentary elections were rigged, and Russians took to the streets. Putin blamed the protests squarely on America, and more specifically, Secretary of State Hillary Clinton.
He believed that she had sent, and this is his words, a signal to demonstrators.
Still, Putin won by a huge margin and set about crushing the protest movement immediately upon his return to the Kremlin. Over the next few years, Russia's economy tumbled. Putin annexed Crimea, leading to sanctions. The price of oil fell drastically. The ruble hit a new low, and America played down Russia's influence, with Obama calling Russia
a regional power.
Despite all of that, Putin's approval rating remained sky high, and then an opportunity for payback.
I think I'd get along very well with Vladimir Putin.
In 2016, there was one candidate who called Vladimir Putin very smart.
Trump exhibited tolerance towards Putin's actions annexing Crimea and similar views on NATO and sanctions.
Secretary Clinton didn't support any of those views.
even though Putin denies any wrongdoing,
U.S. election.
Yes. The U.S. has accused Russia of being behind the leaking of 20,000 Democratic National Committee emails, which many say helped Trump beat Hillary Clinton in the presidential election. Which leaves us here with the possibility of a President Putin until 2024, positioning Russia to be the world power he always imagined it should be.
Jack Ma is Asia's richest man and most recognizable business tycoon. He's the chairman of Alibaba, China's e-commerce giant and one of the 10 largest companies in the world. Yet he still wants more.
We know where we're going. We want to be the 5th largest economy.
Big words from the man some call Asia's Jeff Bezos. He's confident, he's charismatic, and he's definitely not the average CEO. This is how a poor schoolteacher went from the classroom to being one of the most influential multi-billionaires in the world. Ma was born in China's southeastern city Hangzhou in 1964. His parents were traditional musician storytellers. As a teenager, he started to learn English from foreign tourists after China opened up in the late 1970s.
And then for 9 years, Jack Ma hung around outside the Hangzhou Hotel, which is now called the Shangri-La. He would get up at 5 a.m. to talk to travelers.
That's Bloomberg technology reporter Lulu Chen.
And I cover China Internet for Bloomberg.
Ma failed China's National University entrance exam twice before being admitted to local teachers' college. He graduated in 1988. He applied for 30 jobs and got rejected, including from the fast food giant KFC.
When KFC came to China, come to USA, 24 people went for the job. 23 people accepted. I was the only guy.
Then Ma got a job at a local university and taught English there for about 5 years, earning just $15 a month. On the side, he started a translation company with several friends. During a company trip to the US in 1995, Ma had his first encounter with the internet at a friend's place in Seattle.
I searched the first word, beer. I don't know why, because it's easy to spell, baby. And I see beers from Germany, beers from USA, beers from Japan, but there's no beer from China.
So he searched for the word China instead and still couldn't find anything. And that got him thinking. He wanted to build something that would put China on the world's map.
He started China Pages, a Yellow Pages-like website, but it didn't take off. Then Ma joined a government agency in Beijing to help set up a website. By 1999, the internet stock boom had gripped Wall Street, and back in his Hangzhou apartment, Ma decided to try again. With his wife and a group of friends, Ma raised $80,000 and set up Alibaba, a site that allowed businesses to sell stuff to each other.
人家美国人强就强它的硬件，强就强它的系统建设，这方面确实比你早。但是玩信息玩软的，中国人的脑袋绝不比你们长。我们在座的所有人的脑袋绝不比你们长。
By 2000, Alibaba had raised $25 million from investors, including Goldman Sachs and SoftBank.
He had no business plan and zero revenue, but his eyes was very strong eyes.
In 2003, Alibaba started Taobao, a platform for individual sellers to trade with each other, and publicly declared war against eBay, who had started to make a foray into China.
Jack Ma has this famous saying that Alibaba is a crocodile in the Yangtze River, whereas eBay is a shark in the ocean. And if they fight eBay in the ocean, then they'll lose. But if they fight them in the Yangtze River, then they have a home base advantage.
In 2007, just 1 year after it forced eBay out of China, Alibaba debuted its business-facing division on the Hong Kong Stock Exchange. But it delisted 5 years later as its performance sagged. But in 2014, Alibaba raised $25 billion in the world's biggest IPO in New York.
Everybody should have a dream. What if that dream comes true?
After achieving dominance in the business of e-commerce in China, Alibaba has been building an internet empire worth $472 billion, with businesses in cloud computing, online video streaming, movie production, healthcare, sports, retail, and even news media.
Alibaba buying into South China Morning Post really raised eyebrows. This is the largest English newspaper in Hong Kong, and it shows that Jack Ma's ambitions weren't limited to e-commerce. He wanted to influence not just Chinese users, but also overseas users as well.
The US has criticized Alibaba for allowing companies to sell counterfeit and poorly made goods, but in China, it enjoys the favor of China's government. It's part of Ma's company philosophy.
In love with the government, but don't marry with them.
Jack Ma's an extremely fortunate man for jumping on the internet sector so early. Note that this is a person who has no coding skills at all. He's a natural showman and a gifted public speaker, and really able to convince others to believe in his vision.
Ma's vision of growing Alibaba to be the world's 5th largest economy faces strong competition at home and abroad. It will require more than just naked ambition and charisma, but Ma is great at getting himself in the right place at the right time. So far, it's served him well.
Peter Thiel is a walking contradiction. He got his bachelor's and Juris Doctorate from Stanford, but speaks out about the horrors of higher education, saying college is
as corrupt as the Catholic Church was 500 years ago.
He's a staunch supporter of the free press, yet he bankrolled a lawsuit to bankrupt an independent media company.
But these were not journalists.
And most of all, he's an immigrant libertarian who's the most public supporter of Donald Trump in all of Silicon Valley.
What Trump represents isn't crazy, and it's not going away.
This is the story of how an openly gay, immigrant genius, libertarian billionaire went from tech contrarian to Silicon Valley's biggest Trump supporter. Peter Thiel was born on October 11, 1967 in Frankfurt, West Germany, to Suzanne and Klaus Thiel. Peter's family emigrated to Cleveland, Ohio when he was 1. An Ayn Rand devotee during his youth, Thiel attended Stanford University majoring in philosophy.
His Stanford experience shaped a really big part of who he decided to surround himself with.
That's Lizette Chapman.
And I cover technology and venture capital here at Bloomberg.
He and his Stanford friends made their first big splash in tech with PayPal. After selling to eBay for $1.5 billion, they would become known as the PayPal Mafia for each incredible success after PayPal. For Thiel, that began with an early, modest $500,000 investment in Facebook.
And in VC speak, early means big risk, but also big reward. He turned that initial $500,000 investment into more than $1 billion in cash.
But Thiel was just getting started with Facebook, and he went on to make a whole bunch of wildly successful investments.
From SpaceX to Airbnb to one of the largest, most powerful companies in the United States, if not the world, and of course that's Palantir.
The incredibly controversial secretive data mining startup he founded with his colleagues from PayPal. It connects data silos and then allows non-technical people to search that information for patterns. Data like
financial information, feeds from video cameras, biometric details, passport information, flight manifest.
Palantir doesn't talk much about how they collect this data, who has access to it, or what they do with it. But they have contracts with
the Department of Homeland Security and the CIA and the Department of Justice and the Securities and Exchange Commission
and several other federal agencies. It's the richest company you've never heard of, valued at $20 billion. But there are plenty of obscenely wealthy people in Silicon Valley. What makes him different...
He's a complex ball of multiple contradictions.
Take college, for example. Even though college was extremely important for Thiel, there's something called the Thiel Fellowship.
In exchange for dropping out and a promise not to pursue college, Thiel would give them $100,000 each.
You basically tell people that if you get a diploma, you're saved. Otherwise you go to hell. You go to Yale or you go to jail.
Also, his relationship with the press.
Here's another contradiction. He's donated to free press initiatives, including the Committee to Protect Journalists.
But he also secretly spent tens of millions of dollars bankrolling a lawsuit filed by Hulk Hogan over the publication of a sex tape and bankrupting the independently run Gawker Media. Why did he do this? Because in 2007, one of Gawker Media's blogs, Value-Ag, outed him as gay. And with the lawsuit, he
found an opportunity to get back at them by funding the lawsuit that Hulk Hogan was able to bring then, but he wouldn't have been able to do that without Thiel's money.
And finally, Thiel's biggest contradiction, his endorsement of Donald Trump.
When he was asked about his support for Trump, he was surprised at the outrage that came with it from many of his colleagues in Silicon Valley. He didn't want more of the establishment.
No matter how crazy this election seems, it is less crazy than the condition of our country.
After briefly supporting Carly Fiorina in the primaries, Thiel pivoted to Trump, donating $1.25 million to Trump and his associated super PACs in October 2016. And he didn't just help Trump financially. He gave a full-throated keynote speech supporting Trump at the Republican National Convention.
I'm not a politician, but neither is Donald Trump. He is a builder, and it's time to rebuild America.
And when Trump was finally elected, Thiel was given the reins to an enormous amount of power.
And I want to thank you, man. You have a very special guy.
He was named the transitional advisor. And in that role, he did a lot of interviewing and a lot of vetting to fill hundreds of cabinet positions and different jobs within the administration.
But it turns out Thiel's support isn't unconditional.
Talking to people who spend time with him, I have also heard that he is no longer a great supporter of Trump.
It was reported that Thiel was unhappy with the direction of Trump's presidency. Ever since, he's been mum, making no public appearances, no statements, and staying out of the spotlight altogether. Although there have been suggestions that Trump could tap Thiel for a top intelligence post or ambassadorship, there's no indication he'd accept.
He's described his relationship with politics as schizophrenic. He gets really involved, and then he runs away as fast as possible.
Whether Thiel takes a new position or simply continues as a board director at Facebook and Palantir, at just 50 years old, he's primed to wield some serious influence in technology and politics for decades to come.
Two 2016 was again the hottest year on record, and the previous 17 years have seen our 16 most scorching. Scientists overwhelmingly agree. Global warming is the culprit. And it's just getting started. Ice caps, extreme weather, wildfires, droughts, and the hits keep coming. What are we doing about it? In 2015, the world took its boldest step yet to stem climate change with a historic accord in Paris. But now comes the hard part. Nations must change energy policies and invest huge amounts of money, and they will likely do it without the United States. President Donald Trump announced on June 1st that the U.S. would withdraw from the accord.
The reality is that withdrawing is in America's economic interest and won't matter much to the climate.
Here's the situation. Decades in the making, the Paris Agreement united the U.S., China, and more than 190 other nations in a push to limit fossil fuel pollution. The The UN-sponsored plan secured pledges to cut greenhouse gases, the emissions that trap heat in the Earth's atmosphere, in an effort to avoid the rising seas and other environmental disasters that climate models predict. But even if all pledges are met, the globe is expected to warm by as much as 3.4 degrees Celsius this century, more than the UN target of well below 2 degrees. Meeting the Paris Agreement means that governments will have to offer more incentives for clean energy, scale back support for fossil fuels, make emissions more costly, and reduce deforestation. It's estimated that the deal will require $13.5 trillion of spending through 2030. Here's the argument. Unlike past climate pacts such as the Kyoto Protocol, each country set its own Paris targets and then promised to revisit and improve them. The U.S. was primed to play a lead role in climate change, but Trump's Energy Independence Executive Order reverses Obama-era rules and directives put in place to combat climate change, and expands production of coal, the dirtiest fossil fuel. The resulting policies threaten the global fight against climate change. Without the U.S. commitment to emissions reduction, other countries may join it in abandoning the Paris Agreement. This could make it almost impossible and even more expensive down the line to stop climate change. Optimists argue that the shift to a lower carbon future is already underway. Businesses, cities, and U.S. states such as California are already investing in wind and solar and taking other steps to make it work.
I've actually been called an environmentalist, if you can believe that.
There's an inherent attraction to light and being human. And I think on a very deep psychological level, light is this way in which we experience the energy surrounding us in a very personal manner. My name is Matt Dilling. I'm the founder of Light Bright Neon Studio, and we manufacture, produce, and restore neon works of art and design. origins of the creative content of a lot of the work at Lightbright comes from a variety of sources. Sometimes people come with a napkin sketch. Some people come with an Adobe Illustrator file. And we have a whole design team who then we kind of work together to help create layouts of what it might look like. Scale it up and create a paper template using a pen plotter. And that paper template actually becomes our guide for what we're going to bend the neon to. We take from the office into the glass shop. We pick out the right size tubing with the right color for the right size project. From there, we heat up the glass tubing. Molten stain. We heat up and bend the glass tubing to match the template. One of our chandeliers has over 100 different bends in it. So each one of those bends has to be marked for a heated up bend. We also have to allow the glass to cool between the bends so that the next area can be worked on and heated up in its own unique fashion. It turns into spaghetti, and then we have to make sure that that spaghetti lines back up and cools to the template. We use a blow hose to connect our mouth to the tube, create a volume that's closed, and we can control the pressure in there with our mouth. There's just a variety of challenges that come up inherently in working with glass. Glass can crack due to stress, and sometimes you'll just have a batch that all it wants to do when it gets near a torch is crack. After we've bent various components, we have to go in using the crossfire or the hand torch and actually weld all of those pieces together. The last step on that is then to weld on electrodes onto either end. Each one of those steps is very, very specific. I draw inspiration from so many different experiences. It's hard to come up with one thing that's particular, but one of the ways that I really am able to connect with the creative is to float. Floating is a similar experience to meditation, to psychedelics. Going into a blackened room and laying out in a body of water and salt that's heated to your body temperature, and it allows for all sort of external stimulation to fall away. And your internal world really begins to bubble up and manifest. You really get to experience a different relationship to your mind. I think I work with neon because I can't not work with it. It's so challenging and so rewarding. And those things are so intertwined that there's no way of separating it out. I learn so much and continue to learn so much by working with it. I find so much inspiration in working with it, and I just continue to experience new and different things through the medium. It's that close to me at this point. Once the neon tube is completed, we have to hook it up to our manifold for bombarding. The manifold is opened, a vacuum is drawn. We check the tube for leaks with our Tesla coil. We close the tube back off, and we heat it up using a very large and powerful transformer. As the tube is heated up, it releases anything that's not inert inside the tube, and we evacuate that out. We introduce the gas into it, and we seal the tube off, sealing into that tube whatever gas we introduced into it. I think my favorite part of making a neon light is when you see it lit up for the first time. Different gases, when electrified, emit different wavelengths of light. Neon gas is this very bright orange, fiery red color. Argon gas creates a very intense blue, but that light output that is produced can then be expressed in a different wavelength by coating the inside of the tubes with a phosphor coating that takes that one wavelength of light and emits a different wavelength. We bring it over to the aging table where we hook it up to an age-in transformer and allow it to settle, age the gas in that we've introduced to it. There's always a stray particle of something left inside the tube. But that time that the oxide coating can act to scrub whatever is left inside the tube while things are getting settled into place. Once the tubes are aged in, we move on to our process of assembling two halves of the fixture together in a jig, gluing up the center of the fixture to its spindle. Once the adhesive dried, we would connect the wires from the fixture together into a transformer, and we turn on power and it lights up. Part of what we love about what we do here is that we try and put out into the world the kind of things that we'd like to see. I still am surprised when it lights up. I'm still excited when I get to see it illuminated. There's an ineffable quality to it. To me, is this insight into the inner workings of the universe. It literally is. It's a way of looking at what is surrounding us in the cosmos in a new light.
a bit like an addiction. You've got to make something, you have to do something. It's borderline obsession. And every bike we build is my favourite bike at the time, and as soon as it's done, I want to build another one. It's Sven Cycles is something I've been thinking about ever since I started cycling in my late teens. We want bikes that ultimately you'll really enjoy riding. There's never a bike that's the same. There's always a slight change. And as we build them individually as well, they have the marks of a bike that's built by hand. Most people I know cycle have an idea of their dream bicycle. And it may be an evolving idea you've had in your head. And we've worked with a lot of people that have come to us with sketches and scrapbooks. It's really, really nice to build something that's just one-off and unique. I think a lot of people see a bicycle as two wheels and a frame in the middle. There are a lot of subtle changes and nuances in design which can change the riding characteristics quite dramatically. I'm a really big fan of modernist architecture, and the simplicity of a modernist building is really hard to achieve. And with some of our bikes, they may look very simple, but I think people should not underestimate the time and effort that goes into designing a product. Tubing is key to a bike's feel and ride. Reynolds tubing has been in my life ever since I can remember. Growing up, I could never afford a frame manufactured with their tubing. We can now put a badge on our bike saying manufactured at Reynolds, which is a sort of thing as a kid I just wouldn't have believed was going to happen. Every part of the bike has a specific tube. It's not universal. The first thing we do is get the tubes out, check they're correct, check the wall thicknesses, sand the edges, make sure it's all really clean, because if it's not clean, the tubes won't join together correctly. We build in steel because I still believe it's one of the best materials to use. It's been used in bikes since the late 1800s, and they're still using it now for a very good reason. It's the flexibility that we can replace the tube, repaint the bike, and you wouldn't know it's damaged. I just like working with it. It's very sculptural. This isn't sort of aerospace precision engineering. It's a steel rule and a marker. So when we're cutting the tubes, it's within a mil or two. But what we're trying to do is take the best from bicycle building in the past and add a little bit of modern flair to it. There's various techniques for building bicycles. We do a thing called fillet brazing, where you connect a pipe together. We use a bronze rod and a flame. We heat the tubes up to the same temperature and we fill the joint with bronze. And it gives a very, very sort of fluid, lovely, sort of quite sculptural feel. You've got to practice. You've got to be able to judge material temperatures. You've got to just look at it and you just get a feel for it. It's a stage where your tubes start to look a bit like a bicycle. My father's a jeweller. He'd make sort of very pretty things, which are lovely, but for me, they don't really have any function. What I love about bicycles, you can start on a Monday with a box of tubes, you can be riding it by the weekend, and it can last you for the rest of your life. Outside of the frame and forks, the other most important part is the wheels and tyres. When you build the wheels, you have to lace them, so there's little holes going all the way around the rim. You poke the spoke through. We do build all our wheels by hand here because a machine can't get 30 years worth of wheel building experience. Colour is very, very personal. With any of our bikes, you can have them painted whatever colour you want. We've matched one to a teapot, so we can get that scanned and we can match that, or someone's favourite item of clothing. I like to let the bike sit for 4 or 5 days minimum, just so the paint can have time to cure a little bit, and then we assemble it. We get out all the new components, and it's a case of putting them together. Some bikes you can assemble in 3 hours, some will take 3 days. And we've built bikes that cost in the £10,000 plus mark. Some people, they're saving up and this is their bike and they're going to own it for the rest of their lives. So we just want to make sure they get the right thing. I think the bike for me was the first time I had some freedom. So as soon as I had one, I was off. A lot of people still get that thrill as when they were a kid blasting down a hill, wind going through their hair. It's fun. Everyone has their favourite jacket or something that just makes them feel good. If you've got a bike that fits well, you actually feel part of it. Building bicycles as a creative outlet is fantastic. It's not something you do because you're going to get a big paycheck at the end of the day. You do it something you have a passion for it.
If you ever saw a wooden surfboard, it was probably hanging in somebody's house or underneath the deck. But kind of in the last 10 or 15 years, wood has made a big comeback. They surf wonderfully. It's beautiful and it feels great to be on one of them. I always had a love for wood and kind of passionate about things that went in the water. I've kind of been around wooden boats most of my life. There's just so much character. The way they're built, the stories that come with them, a lot of that has translated over to why we build surfboards the way we do. When we first started thinking about building surfboards, wood was the natural material we chose. They have a very high strength to weight ratio. Wooden surfboards have the longest history of use in the surf world than any other material. People have been surfing wooden surfboards since kind of the first documented history of people riding waves. The board starts in CAD, where we take a 3D model, break down the shape, and kind of create frames and templates and all the inner parts of the board that we get cut on a CNC machine. We take those frames and we just pop them out, assemble the frame into kind of a skeleton. We go out to our lumber shed, pick a bunch of cedar, and bring them into our mill shop, put glue along the edges, clamp it all together into a panel. Everything's book matched. You have symmetry in the colors and texture of the wood. Cut your outline. take our assembled frame, gently put it down right on top of the plank. Once that foundation is started, you're basically building up the three-dimensional shape, the outside part of the board, using lots of strips that kind of interlock and fit together. Every piece of wood is going to be different, and it's all going to react differently. There are frustrations with it, but I think that's one of the things that keeps it challenging. You learn to read the kind of what the grain lines are doing and what the color of the wood is telling you. Once those rails are cleaned up, we put our top planks on. It's a little bit like putting a lid on a box. It's like, this is it. Whatever's inside that board is staying inside that board. And by tensioning some rope, you can clamp the two together. It's like a time capsule. What makes our boards unique are they are built right here in York. They're built using material that grows right here in the state of Maine. They're built 100% by hand by local craftspeople and surfers. There's a lot of time that goes into these boards, between 40 and 60 hours, start to finish. We wanted to build surfboards that were as hollow as they could be, but still be strong enough to work well. Too light and they don't surf well, but too heavy and they don't surf well. So there's a balance point there, and that's where we try to be. Taking the board off the rocker table once the top has gone on, that is by far one of my top favorite parts. It's just you and a shaping stand, a board, and a hand plane. Everything else is out of your view. It's simple, it's pleasurable, it's quiet. You can be with your thoughts and you can just kind of be present. There's something about taking a nice sharp edge tool to a beautiful piece of wood and feeling the curls coming off and knowing that every pass that you're making, you're kind of getting it closer and closer to what you have in mind. Once we've shaped it down and the board's looking like it's supposed to look like, it's time for it to go into the glassing room. 4-ounce fiberglass, laying it over the board, draping it over the edges, cutting it, applying epoxy, and on the board. Once both sides are lamb coated, it's time to put in the hardware. Drill and router and install the fin box. And on the other side, we drill and put in the leash plug and a vent. There's a lot of air just naturally inside the board, and that air wants to expand and contract with temperature changes. And that vent has a little piece of Gore-Tex fabric in it, and it allows air to kind of breathe both ways, but it doesn't allow water to get in. Once all that hardware is put in, it goes back into the glassing room. We brush a nice, beautiful, thick coat of epoxy over the whole surface, and that we call a gloss coat. That's supposed to look beautiful and glossy and shiny and flawless. You get to see that board come to life. Whatever the colors in the wood, they really come out. It just makes it look like candy. You just want to touch it and run your hands down it, and it's just kind of the icing on the cake. Once everything is hard, we put it into what we call the oven, get that epoxy to cure, really kind of bake it, and just get it to harden. Put in the fin, screw in the vent, and ship it out. We just love the idea of building something that's sustainable and long-lasting and made by hand. It kind of gives you a deeper connection to the product over something you might buy on a shelf. When a customer gets the board, they feel it. They 100% feel the amount of work and the amount of passion that went into the board. So I'm not really looking at hours and efficiency. We're looking at like doing it right and enjoying it as we go.
Ma Baoli, better known as Gang La, is one of the 4 Grand Marshals leading New York's Pride Parade this year. But in the country he comes from, being gay is still a social taboo. The CEO of a Beijing-based internet company is on a mission to improve the lives of millions of gay men in China.
对于每一个 LGBT 人群来说，即使这个国家不允许你跟同性爱人结婚，但是你仍然要勇敢地去选择你自己的生活，你仍然应该拥有幸福生活的权利。
Ma's company Blue City runs an app and a website specifically for gay men. Blued is one of the biggest gay social networking apps in the world, with an estimated 30 million registered users. Unlike most other apps, Blued is more than just dating or hookups.
大家可以在我们这个软件里面找他自己的情感，然后可以阅读相关的内容，然后可以进行一些娱乐，比如玩游戏啊，比如看直播啊等等。
Back in 2000, when Ma studied at a police school in northern China, he realized he didn't feel like everyone else.
因为他们都找女朋友，然后谈恋爱，但是我对长得好看的同性的男生，我反而觉得对我更有吸引力。所以那个时候我就到互联网上去找这样的一些资料，然后希望能够告诉我自己，我到底是谁。互联网上所有的信息都是负面的，都是错的，就是说同性恋要 电击疗法，要被治疗，然后要吃药等等。
After visiting some foreign websites with different attitudes to homosexuality, Ma created his own site for a Chinese audience, encouraging people that
他们也是正常的，他们不用自卑，然后也不用自杀。
even though attitudes towards homosexuals are slowly changing in China, it's still a social stigma. The virtual world of Blued, where members can be open about their sexuality, is for most a striking contrast to their real lives. This is live streaming, a function added to Blued in late 2015, right as the internet craze was starting to take off in China. Many self-made stars like Jin make decent amounts of money by receiving audiences' virtual currencies and gifts.
我们不是彼此的初恋，初恋这种事儿都不靠谱。
For Kyle and Klaus, a couple who have come out, live streaming on Blued means something different.
其实我经常会收到很多粉丝的一些互动的留言，就是类似就是说你们让我们看到了同志情侣之间的一些希望啊。我看到这样的留言我是很欣慰。
The government's rules for acceptable content online may shift quickly in China, with LGBT material in a grey area. Many companies feel the chill of the recent internet crackdown, but Blue City still runs as usual. Ma has won the Chinese government's trust by helping with HIV prevention among gay men. A third of the company's staff are dedicated to screening pornographic and politically sensitive content.
我不太多的愿意去对抗，我更多的愿意去对话。 去改变他们的想法，我觉得这个可能在中国来说是更有效的。
In the past 5 years, Blue City has grown from a team of 7 people to a promising business with about 250 staff. Ma said the company earned over $15 million last year, mainly through advertising and selling virtual currencies to live streaming audiences. Now the company is expanding overseas.
我希望吧，通过我们的努力，Blued能够成为全球第一家在美国纳斯达克或者是纽交所上市的这样的同志互联网公司。
This is Rich Chigga. He's a Chinese rapper by way of Indonesia, and he's very popular on the internet. This is Joji. He's a Japanese-Australian singer, and he's also very popular on the internet. Plus, Joji invented the Harlem Shake meme. Let me say that again. This guy, Joji, in the blood bathtub, invented the Harlem Shake meme. But we'll come back to that. So Rich and Joji are both signed to 88 Rising, an entertainment company hoping to build a lasting global brand that will outlive singular moments of virality. They primarily create content combining Asian culture and hip-hop, a formula that apparently pleases the internet gods greatly. They've only been around for 18 months, but they're already putting up major label numbers.
I think that we have an unprecedented collective of talent, a group of predominantly Asian artists, really making waves globally, which from an independent point of view as well.
88's founder, Sean Miyashiro, cut his teeth launching Vice's electronic music channel, Thump. But quickly, Sean became interested in life beyond dance music.
I knew that after launching a whole content platform that I have kind of the ability and the know-how to do it again, but for what was the question?
So Sean moved to the Bronx to start over and figure it out. He couldn't afford an office space, so he worked out of his car at the top of a grimy parking garage.
Everything kind of started here. If you look around, this is my environment. This is my serenity, really. 88 Rising was built here. Built on the grounds of LA Fitness, residence in a parking garage. I was living in the Bronx. I'm just like, damn, where the hell do I go? So I just come up here and I just kind of figure things out every single day. Being like, okay, what the hell is this thing? Coming here was kind of like my own kind of private office, basically. To be honest, I would even go to the bathroom here. I would take pisses here, you know what I mean? It was, it's just too far to go back down there. When I need Wi-Fi, I'd spend a good part of the day at Dunkin' Donuts. Hi, how are you? Can I get a chicken snack wrap?
Before 88 Rising officially launched, Sean caught a surprise break in the form of a Twitter friendship with a funny 16-year-old kid from Indonesia named Brian, who taught himself English by watching Rubik's Cube tutorial videos on YouTube. Seriously, that's true.
I thought his Twitter was genius, from the future, just crazy, and just the shit that he was saying, the memes he was making. But I didn't know that he rapped or anything like that. I really didn't, and he came up with Dat Stick 2 weeks later.
12 in the morning, pop shells for a living and berry gon' smell blood trail every minute road.
Dat Stick was Brian's first ever attempt at making a rap song, and it immediately went viral.
Everything was great about it, but the one thing that I noticed is the song was hard as hell. Just everything about it, man. Just it was menacing, bro.
Soon after the video dropped, Brian signed with 88 Rising.
I'll FaceTime with Rich. Sorry for calling you Rich Chigga on my phone, Rich. Brian, he gets super pissed off that he's saved in my phone as Rich Chigga. He's like, dude, am I not a human to you? What's good, bro?
What's good, brother?
How you doing?
Doing great. I did the sound check.
How was it?
It was tight. Hold it stick blocks, but you've been a bitch, suck a thick cock.
So Brian could definitely rap, but some viewers understandably took offense at a Chinese kid satirizing rap cliches and calling himself Rich Chigga. But if a group of well-known rappers saw the video and genuinely liked it, that could at least help validate Brian as a legit hip-hop artist. Plus, it could be really funny.
It was just kind of an idea that I just had on the spot. Everything that rappers say is better and funnier and smarter and wittier, and it's just more entertaining. We just edited it as tight as possible, put it up, and it really worked.
12 in the morning, pop shows for a living in.
Yo, this nigga got a pouch on and a Reebok pouch.
This is the hardest nigga of all time.
You said when you come for a trigger like me, that was dope.
Like, it's just lit, and I think people will take it as a joke at first, but it's like if he ran with that and kept doing more videos like that, it's just lit.
You know, I'd never been to America before, and like all of a sudden, it's like I see like all the rappers that I listen to just like reacting to my stuff, and I was like, what? How did this happen?
The reaction video also went viral and even led to a remix of Dat Stick featuring Wu-Tang's Ghostface.
I'll get on that track. You know what I'm saying? Yeah.
Really, on the remix?
Yeah. Oh, you know him?
And yeah, the remix went viral too. Brian has since acknowledged the misstep in his name and claims he may change it. But for the time being, he's still Rich Chigga to his fans. An ever-growing global audience, hungry for more releases from emerging talent around the world.
I didn't know that it was gonna be this impactful and this important to people, and I'm very thankful and blessed that it has. And every day now that I wake up, it's like it's just like a new mission every day.
A major part of that mission involves Joji. Remember the bloody bath guy? He's a former YouTube personality in the middle of a career transition.
The sound of this song, Will He, it's like a trap song that you can like slow dance to. Awkward prom shit, you know what I mean? I used to do crazy episodic internet videos. It was going well. And one day, it was me and a few friends just in a room. We were casually chilling, and then someone plays the song, and it's brand new at the time. I happened to have a lot of costumes laying around, so I told the other guys, I was like, get in these costumes and let's just dance to it. Like, who cares? We were like, okay, let's just go crazy at the drop. So that video goes up. I go to sleep, and the next morning, everyone's doing it, like next morning. That taught me a lot about the internet, how people want to just be a part of something. And from that point on, something changed, and I was a little better at understanding demographics and people and what they want to see and what they want to hear. I was friends with a couple other artists who were affiliated with 88, and then I also started to realize that 88 is the bridge between Western and Asian entertainment, and I really wanted to be a part of that.
Joji just released the In Tongues EP, his first project as a serious artist.
Joji's In Tongues record came out a couple weeks ago. It's #2 on Billboard on the R&B charts, which is crazy for, independent release, and he's like a brand new artist.
And the success is even more impressive, knowing he went from creating something like this,
It's just Taco Bell. What could possibly go wrong?
to creating something like this, the newest music video for his song Demons. Tonight, Rich Chigga has a show in New York City. Tickets sold out in an hour.
I came here, I'm first online. I was here at 1. Yeah, I was the third person online.
So why'd you get here so early?
Because I want to see Rich I want to touch him.
What do you guys think of Joji?
He's
That's my dad, son.
Did you guys cop the new EP or like?
Yeah. I woke up at 6 in the morning just to cop that shit. And then I listened to it, and that shit started making me cry.
This is actually kind of exciting. Every time, this never gets old. Like, you live online and social media, but like, there's nothing like just being with the people.
More often than not, viral success happens by accident. And then after an appearance on Ellen or Jimmy Kimmel, the creator's star power fizzles out. But 88 Rising has figured out how to turn potential gimmicks into brands with an actual following that keeps coming back for the next thing.
Oh, shit!
So keep an eye out for 88's next move. But more than likely, it won't be covered on network television or terrestrial radio. Although, as they've already proven, nowadays that really doesn't matter.
Online retailer Farfetch is betting it can shape the future. This is its concept store, showcasing the latest in retail tech.
How do you capture all of that fantastic information that you gather in store with customers, touch and feel products? And we created a concept called the Connected Rail. And this is using a combination of RFID and ultrasound. The RFID signal recognizes the product, and the ultrasound recognizes the movement. Take the product off, and then you'll start to see your products appear. And essentially, it's like online browsing behavior. Whichever products you touch and pick up in the store are automatically sent to your app. This is effectively what you've created is your in-store wish list. In the middle, you'll see essentially a hologram of the product. What the customer sees, they control the experience on a touch device. What this allows the customer to do is take elements of products and then add their own style to it. Right, so this is the connected mirror. So in this example, I see my products. I select a coat, and that's tried it, and it's slightly too big for me. So what I can do is choose an alternative size and send a request to the sales associate, and they'll bring that size to me in the fitting room mirror. You'll also see that we've got some product recommendations here. Crucially, the sales associate's able to push items into the mirror from their device. If you wanted to, you could simply use the mirror and pay and go. Your items would then be packed and dispatched to you afterwards.
outwards? Yes, please. How about there?
First time we came out with B, Jade said, "It feels like I've been released from prison."
Do you want these, Mrs? Definitely.
Definitely. Right. And she could say hello to everybody, people she hadn't seen for months.
It's Jade.
Oh.
Hi, Katie. She's there.
Every time anyone's seen her, they want to know why she's there. And it's kind of the opposite of when you're in a wheelchair and people see you and they kind of go, oh, should I look? I don't know what the right protocol is. When there's a tiny robot with its bright little eyes going around just looking happy everywhere, it really opens you up for conversation.
You've got some friends here, look.
Hiya! When I saw her for the first time, I remember thinking, this is going to change things. This is one of those points where if this was a book, this would be the cliffhanger. called Ehlers-Danlos syndrome, which means that I have a lot of dislocations, there's a lot of pain, and a lot of seizures and whatnot. So I can end up on my own in my room for long periods of time. A lot of the time, with a condition like my own, of course there's the pain, and the pain is bad, and the dislocations are bad, and the seizures and being in paralysis and never knowing whether you're going to be able to wake up properly tomorrow, that's bad. But what's worse still is being able to count the number of people you see a day on one hand.
Are you ready?
Sure am, I'm just hoping the connection's going to stay.
Alright, here we go.
When you're used to just the same little metre by metre and a half window every day, and you've been there for months, being able to just see the sky from somewhere else, or the tops of trees, or a sign, is incredible. Or being able to have that kind of chat in the car that most people would probably take for granted.
I'm going to go past Grandma and Grandad so you can give them a wave. Now, if Jade is particularly seizure-y, she can still take part. And that's brilliant, really, because before she would just be left in a bed or in the house with just her carers. It's quite a small world, that.
Right, so there's one of them. Here, this costume I'm busy making at the moment. When I'm not on bed rest and I'm not just wearing pyjamas all the time, I enjoy being able to dress as different characters and go to Comic Cons and that kind of thing, because it just lets me show a different side of myself, and it's a bit of fun. If you can't go out that often, you've got to enjoy it when you do. Was that good? It's one of those weird things where I want to not have to use B because I want to be well enough to be able to go those places myself. Like, it really makes a big difference to me to be able to go into school. But the thing is, with my condition fluctuating all of the time, I can't go into school reliably. And so far it's interesting, still a few little things that we need to work out, but for the most part I think it's going fairly well, and it's brilliant because I can really tell the difference between today and yesterday. How yesterday I forced myself to go into school when I wasn't very well and I was really tired afterwards and ended up having loads of seizures, whereas today I've been able to do all of the work, I've been able to keep a clear head and not be ill, which means I'm able to be more focused on my schoolwork.
So there is my first step of working, is to simplify Route 8. The algebra test is next week.
Now I'm trying to make friendships which I'll be able to maintain with B. Before that, I've ended up letting people down quite often. B gives me hope, yeah. She's just always there. And if I can't do something, she can. And if I need sort of assistance to be able to make commitments, then she's there, and she means that I feel like a more valuable person because I'm more reliable.
4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for fifth generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg Tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network factories, where machines are just sat there not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
The cubicle represents a tyranny. It confines your imagination, your thoughts, into a small physical area. Imagine pretty much every software engineer or finance person being able to, disconnect from their desk and look at holographic monitors on a beach and doing their work from there. That's not going to be science fiction. It's the modern office place.
Silicon Valley is all about building the future. A startup called Meta thinks it's getting there first, thanks to a big bet that it's made on augmented reality.
How are you? Thank you. Welcome to Meta. Thank you.
Call it a 360-degree office where you can spatialize your thoughts as part of your workflow for education, architecture, design, engineering, etc.
People often mix up augmented reality with virtual reality. VR totally blocks your ability to see or hear the real world. AR overlays holograms onto what you already see. Meta has tried to make its version of the workspace feel familiar.
You grab the hologram instead of using a controller or a mouse, and your brain already knows how to do it. In other words, we've designed an operating system that humanity has always known how to use. So you can see this eyeball, which is, by the way, photorealistic. You can see my hand is occluding the eyeball, and now the eyeball is occluding my hand, right? You see those two circles? They get small, and then they turn into this glowing white ball, and then I can move my hand around supernaturally. I can do this with two hands and rotate the thing. I could stretch it. I can throw it back right into the shelving system, and that's all you have to learn to become a modern worker.
And to prove this, the employees at Meta have started to get rid of their computer monitors, trading them in for Meta's augmented reality headsets. Myron thinks that in less than a decade, we'll all be just wearing strips of glass that can project holograms.
In the early 80s, everybody had computers on their desktop, but no one was using them because they had a lot of work to do. So they were still using typewriters. And at some point, the CEO took all the typewriters away and everybody was forced to use their computers. So it's very exciting to see a new generation of technology, a new paradigm.
I consider us like pioneers in the holographic world. I'm pulling up my browser with my hands and sending out emails to colleagues and just kind of really acclimating to the new environment.
Putting on my computer, essentially. Our digital lives live on our phones. We have all of our pictures and notes and all these kinds of things. So why don't you write yourself a little sticky note? I like it. And go ahead and just take your fist right over the top of the sticky note and close your fist. And now.
Meta's own transition to augmented reality has run into plenty of unexpected problems. And it's still going to be a while before you'll start to see these devices in your office. But I think it's a future worth waiting for.
If we could see these holograms between us, we will have been able to share our work with one another more naturally, more efficiently, and more productively than ever before. Humanity will have evolved slightly.
sensational virtual pop star. She's released over 100,000 songs in multiple languages and performed sold-out concerts around the world. Her image has appeared in games, on TV, in car races, and is even etched on the side of a Japanese space rocket.
I came from Hatsune Miku, Carlos.
She's Lady Gaga's favorite digital pop star and opened shows for her in the US 3 years ago. Tens of thousands of fans attended her exhibition and live shows near Tokyo recently.
理想のアイドルっていうと、どの曲でもミクはすごい綺麗に歌ってくれる。
他没有缺点啊，没有任何让我们感到不开心的一些新闻。
She's everything to everybody. That's probably why she's so popular.
Miku's creator Hiroyuki Ito and his Sapporo-based company have been developing the virtual diva for over 10 years.
初音ミクとは、キャラクターとしてすごく、YouTube とかで検索すると、たくさんの初音ミクが出てくるんですけども、元々の、初音ミクのその原点は歌声を合成する、ソフトウェアなんです。
Both the software and character are named Hatsune Miku, meaning the first sound of the future. Originally based on Yamaha's Vocaloid technology, Miku the software has a sound bank containing voice samples and a huge array of tools. You input the melody and lyrics, then Miku the character sings them. To date, Krypton has sold 120,000 software licenses at $200 each to fans around the world who use it to create numerous songs and share them online. Some of the fan-created songs are chosen to be part of Miku's concerts, for which they're paid a royalty fee.
もともと初音ミクっていう存在自体がボトムアップって言いますか、中にはアマチュアクリエイターじゃなくて今もうすでにプロになって活躍している方もいらっしゃるんですけど。
The company also has other revenue streams. It makes money from merchandising, licensing deals, and concert ticket sales. According to the real-life musicians who perform with Hatsune Miku, the virtual pop star is interesting and surprising.
今年で3年ぐらい、ちょうど3年ぐらいになってきて、ライブを数十本数百本そういうことが演奏によって起こせるためのそういう器みたいな感じになってます。初音ミクらしさって僕はあんまりない。初音ミクって何だってあり。
Miku has the potential to change the way we think about music.
そういう新しいそのテクノロジーによって新しい音楽のあり方っていうのを模索していきたいと思っていました。
And for her fans, it goes even further.
ミクって魂がないので、だからみんな魂を作り上げるために存在しています。
of fitness gadgets out there. In my quest to get fit, I tested 17 of them over the last few months. At least one personal trainer I know was a little bit skeptical.
Yeah, I've been watching these new technologies come to the market for almost as long as I've been a personal trainer. They're just tricks and tropes. They're not much different than the Bowflex machines or, to be honest, the original Jane Fonda workout video.
But some of these gadgets that are just coming to the market do so much more than what they used to do, just tracking your activities. Out of all of them, this chest strap was my favorite. It comes with a robot coach that points to the future, one where you might not need a human trainer at all. And it works like this. You wear the chest strap so that it can read your heart rate, and that connects to Move's free app that talks to you.
Welcome to Move Heart Rate Hit Outdoor Running. Let's get moving and warm up in Zone 2.
Move's computerized coach tells you what to do at that exact moment, whether you're running outside or you're doing body weight exercises indoors.
Swing your arms faster to get your legs moving quicker. Let's crush this round.
And by reading your heart rate, she knows exactly how hard you're working. She keeps you honest.
Way to go, you are in the target zone. Keep pushing, you're almost at the end of the round. Don't give up.
I've been running for 7 years now, and my biggest problem is that I never push myself hard enough. I end up going on the same slow, comfortable 30-minute jog, but the Move HR Burn blasted me out of that rut. By the end of these half-hour exercises, I was drenched in sweat in a way that I never am when I work out alone. Training with a real person is great, whether that's your group instructor or your coach or your personal trainer, but humans, they're expensive. For the rest of us, this $60 gadget is all you need.
change the world. A big army, a cure to a pandemic, a revolution. All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hack emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning. He used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the Collateral murder video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped in the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons in all fairness.
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks.
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
based on a true story. When I do like motivational speeches or even tell myself like, love yourself and you should love yourself.
This is Lily Singh, but to fans all over the world, she's the YouTube star Superwoman.
What if everyone to girls? Superman, I know we can can change the world for the better, one positive day at a time.
My parents now know what I do. They didn't know what I did for a long time in the beginning of my career. I was just making videos in my room. They had no idea.
Mom, Dad, have you seen my keys? I can't find them anywhere. Because you're always on phone.
Until someone called them, like a family member from another part of Canada, was like, Canada, is your daughter making videos? And my mom was like, I don't know, Lily, are you making videos?
Just making videos grew into an entire career. Today, Lily's YouTube channel has some 12 million subscribers, over 2 billion views, and guest stars like Michelle Obama, Dwayne "The Rock" Johnson, and Seth Rogen.
I think a lot of young girls are raised to believe that you're going to go to school and then graduate and then get married and then get a job and have kids.
And Lily was on that path, all the way through a psychology degree at York University in Toronto. But when she started thinking about a career,
I started to immensely panic and think something was wrong with me because I tried to figure out my life and it wasn't working in that straight line.
It was 2010 and YouTube was only 5 years old.
I thought nothing of YouTube. I was probably the last person in my circle of friends to discover YouTube. And I remember when I did, I thought, this is so strange. There's people making videos in their rooms and other people are watching them.
So she figured, why not give it a shot?
I one day posted a video because I was sad and I wanted to be creative and happy.
She didn't know how to edit video or write scripts, so she winged it.
It was so bad and so cringe, and my expectation was literally nothing. I was like, I'm gonna put this video up, a couple of my friends are gonna watch it, probably make fun of me, and that's gonna be the end of this. The second and third video came from, wait, 70 people watched my first one, can I get 80 to watch the next one?
She kept creating, she kept posting, and the viewers kept coming. Lily had found an audience.
A lot of the comments were, oh my God, there's a brown girl on YouTube.
More specifically, Indian. Lily's parents immigrated to Canada from India, and Lily was born and raised in Scarborough, near Toronto.
My home life was awesome. My parents, even though I portrayed them to be quite strict in my videos.
Oh, Lily, where the rest of your skirt, huh? I teach you like this, to walk around like this, showing everything to everyone?
They actually aren't like that at all. They're pretty modern and pretty cool.
Your dress is short. Don't know what for.
And were pretty lenient with me. I mean, I got away with a lot of things. I was a brat. I was a brat.
She had a different idea of what she wanted out of life than other kids. In a grade school graduation slideshow, her classmates said they wanted to be lawyers and doctors.
And then I came up and I was like, rapper.
Making out with your friends, man. But then you say that you hate hoes.
I could just feel my parents being like, why?
Because that's just not something women really did in the Singh family.
I know there was a ton of people that weren't happy about my birth being a female, so I think, and that's some real-ish, but it's a real thing. The best thing I could have done to prove to so many people that didn't want my mom to have a daughter was to become Superwoman.
What up, everyone? It's your girl, Superwoman.
It was the name of Lily's favorite hip-hop song by Lil Mo featuring Fabulous.
I love the song so much because it was one of the only songs at the time that was an empowering female song, where Lil Mo's going on about, like, I will save guys with my superpowers, and I will save girls with my superpowers, and I am Superwoman. I thought, this name that I've had for so long that empowered me when I was younger, I'm gonna make this my screen name. Maybe there should be a new series.
Superwoman didn't just burst onto the scene overnight with a viral video. It was a steady climb fueled by hard work.
The moment that I thought this is going somewhere and this could be a career was the first time I performed internationally. It was in India. And it was the first time where I was truly across the world and people knew my videos.
Singh has transformed herself from a bratty kid to an internet personality to a media mogul. She starred in a feature film, A Trip to Unicorn Island, in 2016. And her book, How to Be a Boss, hit the New York Times bestseller list in 2017 while she was on a 30-city international tour. Lily started out with the goal of getting millions of subscribers and financial security.
Hurry the hell up!
But after surpassing those goals, success has new meaning.
I've really come to terms with the fact that my definition of success is what's the best legacy I can leave behind. And it's not the number of views and the number of subscribers. It is the number of people that can say, this girl changed my life or changed something in my life positively.
in the brains of deceased athletes, military veterans, and others with a history of repetitive brain trauma. Hundreds have donated their brains to the VA Boston University Concussion Legacy Foundation Brain Bank.
This is a former NFL player who died in his early 70s, and this is a veteran who also died in his early 70s.
Dr. Ann McKee dissects these brains.
The hippocampus and the mammillary bodies are very important for memory. I can see that they're slightly affected.
McKee recently dissected the brain of former New England Patriots player Aaron Hernandez, who was convicted of murder and later committed suicide.
You'll see right away that the brain is showing signs of shrinkage. You can see the crevices in the brain that you can't see in the normal.
McKee says Hernandez's severe case of CTE impacted his decision-making, depression, and ability to control rage and aggression. Right now, she thinks we're underestimating how many people have CTE.
We were able to distinguish between CTE and controls and CTE and Alzheimer's disease. The next question is, can we do this in the blood, and can we do this in living people? And we aren't there yet with those answers.
But the need for a diagnosis in the living is motivating companies such as Quanterix in Lexington, Massachusetts, to work faster on technology that could diagnose concussions and CTE in as few as 30 minutes. Kevin Rosovsky is the CEO.
It's like a high-powered microscope. And so by doing that, we can see little biomarkers that you couldn't see before in the blood.
Quanterix received a grant from the NFL and just went public. Since then, its stock is up more than 40%. The company sells a machine called Simoa for $175,000 to other biotechs, hospitals, and researchers.
And for the first time in history, we're able to see brain health in blood, and that's a major breakthrough, and that's leading to less invasive testing, and we've already been able to see evidence of concussions, and there's the beginning evidence of being able to see the accumulated effect of concussions.
Quanterix is also trying to detect Alzheimer's disease, multiple sclerosis, and ALS. Rosovsky says he thinks diagnosing concussions will be easier than diagnosing CTE.
Diagnosing CTE in the living probably is a couple years away. We're real excited to see the progress, but reducing some of that work into actual tests in a laboratory takes time. There's regulatory approvals. There's a lot of red tape that you have to go through.
Also in this race to diagnose CTE in the blood are Athlon Medical and Exosome Sciences. And New York's Mount Sinai Hospital is scanning for the disease in the living. But it's just one step in a series of questions for those with serious head trauma. There's still no cure for CTE.
Even if we had a great idea for a treatment, there's no way to test whether it's effective or not. So that's the enormous advance that we'll get if we can develop a biomarker for this disease.
In Boston, Ann Mostu, Bloomberg News.
Wine is a $300 billion global industry where one person's opinion can make fortunes or break them. That's because of this man, Robert Parker, and his newsletter, The Wine Advocate. For 3 decades, he dominated as the world's most influential wine critic. Now Parker's protege is building an empire of his own. Antonio Galloni runs Vinous.
Antonio, tell me, what are you trying to build at Vinous?
Well, at Vinous, we started with the idea in 2013 of building a world-class platform. We have a database of about 250,000 professionally written reviews. On Delectable, we have 7 million user reviews. Through Delectable, we also have a partnership with Whole Foods and several other partnerships that we can't announce just yet. When you put that all together, what we have is something that no other company in our space can even come close to.
Do you think of yourself as the next Parker?
Not at all.
Why?
Because Steve Jobs said you can't live your life trying to be somebody else. So he's one of my biggest influences, and I've never wanted to be a replica of somebody else because a replica is never as good as the original. Bob is a genius, fantastic, one of a kind. We're going to be something completely different, and I have no desire to be some version of somebody else.
Different in what way?
Every decision that I've made at this company is completely anathemic to what Bob did with his company. I want our writers to be partners. All of my senior people are locked into the company. They all have equity or they have a path to equity based on business results. That's something that we never had at Parker. Our benefits are world-class, and everything that we've done at Vinous is completely different from that model. When Steve Tanzer, who is the most experienced active wine critic in America, wants to work with us, that says something. When Alessandro Masnaghetti, who's the best cartographer of vineyards, wants to work with us, that says something. When Neil Martin, who's a superstar wine critic with enormous experience in Bordeaux and Burgundy and the former lead critic at The Advocate, wants to come and be part of our team, that says something.
You make it sound like The Wine Advocate was a disaster as a company and a miserable experience as an employee.
No, it was great because I got to work with Bob Parker when he was in his prime, and Bob was like a second father to me, and we talked on the phone all the time, and he gave me great advice.
Can anyone's palate dominate the wine criticism business the way Parker's did? And should anyone's palate dominate it the way his did?
I just think the world is very different today. It's just a totally different world. It's probably not healthy to have a single person dominating the world.
It's not even wine criticism, it's the wine industry.
Yeah, that's probably not the healthiest thing in the world. But I think that there's just such an opportunity right now with social media and technology to reach such a massive number of people that I think it's possible that 1 or 2 people will actually have more influence than Bob Parker did, because they will. Again, this goes back to your first question, not trying to be a version of somebody else. You see this in sports all the time. It's like, nobody will ever beat this record. And then somebody comes along, it was like tennis, Pete Sampras. Nobody's ever going to win as many Grand Slams. Now you have 2 guys who are ahead of that and 1 knocking on the door. And so I think a lot like that.
You're a former investment banker. How does that inform and influence what you're doing and what you've done?
My generation has had to deal with a lot more challenges. That's why I think we're actually much better poised for the future. My first job in finance, the first thing that happened was long-term capital, 1998. Then the tech bubble melted down. Then there was a mutual fund trading scandal. That was all like within about 5 or 6 years. And these are the things that I had to deal with as a young executive. My peers who were 20 years older didn't know how to manage in crisis. They'd only seen Black Monday. They'd just been in a big bull market. It's very different. So I'm very lucky. People of my generation or a little bit younger have actually had to deal with a lot more crises. I think that's actually good for learning how to cope with challenges in business.
From the outside, it kind of looks like you're trying to demolish the house that Parker built, right? You left The Wine Advocate.
Yeah.
You merged with one of his chief rivals.
Yeah.
And you just hired a successor, Neil Martin.
Mm-hmm.
So are you?
I think what that says is that all the best people want to work at our company. And that's really what we strive to create starting in 2013. We wanted to create a world-class company that would attract the best-in-class talent, and not just on the content side, on the technology side, on the digital side, our office, and at every level, what we're trying to, we only hire superstars, and we're looking for those superstars.